A very warm welcome, everyone. This week, our Finance Minister Nirmala Sitharaman presented her eighth consecutive budget in the Parliament. This year's budget presents a vision of unique opportunity to realize Sabka Vikas, stimulating balanced growth of all the regions and sectors. At the core of this vision, four powerful engines are agriculture, MSME, investment, and exports. The budget outlines critical policy initiatives across six key domains that will enhance India's growth potential and global competitiveness. And the domains are taxation, power sector, urban development, mining, financial sector, and regulatory reforms. This budget also acknowledges the strength of India's growth provided by the middle class and focuses on the middle class by revising tax slabs in the new tax regime. For the individuals opting for the new tax regime, no tax is payable if the income is up to rupees 12 lakh rupees. And this is done by increasing the rebate under section 87 to rupees to 60,000. This limit will be 12 lakh 75,000 for the salaried taxpayer due to the standard deduction of rupees 75,000. Finance Minister also proposed to introduce a new income tax bill under GST. As expected, a retrospective amendment has been introduced. A retrospective amendment has been made to Section 17(5)(d) to replace the phrase plant or machinery with plant and machinery to affirm the government intent to disallow ITC on buildings, negating the relief provided by the Supreme Court to infra-sector in safari retreats. I, Divya Jain, a chartered accountant by profession, delighted to welcome you all to the fourth edition of a budget marathon. Carrying forward the legacy, Taxmann presents a series of live events consisting of 10 plus sessions to decode the budget proposals. The budget marathon features renowned industry leaders and tax experts who will provide detailed and comprehensive analysis of the corporate and tax changes introduced in the budget. So, as a moderator for today, I would like to inform you all that the 8-hour budget marathon will feature 11 sessions. Each addresses the analysis of budget proposals made in different laws. You can access the full schedule and agenda at taxmann.com/budget. This webinar is broadcast live on Zoom, taxmann.com, YouTube, Facebook, LinkedIn, and Twitter. So please submit your questions using the chat box or comment box, and our team will respond. Additionally, selected questions will be answered by our esteemed speakers at the end of each session. Now, we are commencing the budget marathon with the focus on direct tax laws. It is our privilege to welcome our extreme speaker, Vishal Anand, so co-founder at Tax 𝐂𝐿𝐴, who will deliver the keynote and overview of Budget 2025. Mr. Anand brings three decades of experience in taxation with core expertise in corporate and international tax. Before embarking on his entrepreneurial journey, he was a senior partner at PwC, advising numerous clients on tax matters. His mission at Tax 𝐂𝐿𝐴 is to share his vast industry knowledge with young professionals and guide them through the ever-changing tax landscape. Good morning, sir.
Thank you, Divya. Thank you for this warm introduction. And a good morning to all of you, my fellow professionals, esteemed speakers, and distinguished guests and friends. It's really a pleasure to, interact with all of you and share my perspective on this budget. And more so, considering the challenging times we are in. And very honestly, the government did recognize the importance that, there is lack of consumption. And that is where they have made actually far-reaching, prop changes in the personal taxation. If I were to really look at the budget, budget to me is not just about numbers. It is actually about the vision. It's about the roadmap, and it's about where the government wants the country to be after a defined period of time. So it is really much beyond numbers, but very honestly, numbers do actually give an indication as to where we are reaching. Now, in this perspective, it's also important to appreciate that, the common man obviously has always wondered in the last 5 years, what is the budget in it for me? And, every time he feels that, mera number kab aayega? And really this time, the finance minister in her speech in the last part actually hit a six, which was really out of the park and which has made far-reaching changes to the personal taxation. All of you would agree that the way the budget is structured, even a slight change in a particular clause could actually impact our industry. And that is where the relevance and importance to analyze the intricacies around the finance bill is very, very important. And I really appreciate Taxmann actually taking this initiative to have a day-long session wherein distinguished speakers come and actually share their perspective and explain how it impacts the common man, the business at large. So setting this as a context, what I propose to do is over the next 20 minutes, share my perspective about really, how do I see the economy moving? What has been the pluses and minuses or the challenges which we have in our economy? The importance of the budget for the economy, uh, time permitting, an overview about the tax laws, and definitely my perspective on the hits and the possible misses which I see in the budget. So setting this as a context, this is the way I would actually, uh, take forward. Divya, can you see my screen?
Yes, sir, I can see it.
Okay. Okay, so this is the way I want to share my perspective. One, talking about the broad overview, ongoing reforms, focus area of the economy, and then about the tax proposals, but definitely spend some time about the hits and possible misses. Now, starting with the broad overview, India does have a mission or aspiration that I need to be Viksit Bharat by 2047, which is 100 years post-independence. And Viksit Bharat is actually a well-rounded growth for the economy. It is not about, a desired number, but it is about, zero poverty, creating employment opportunities. 70% of women need to be in our workforce. You need to have well-quality schools. So that's what the aspiration is, what the government is aspiring to. Now, it's good to have an aspiration, but obviously an aspiration also needs to be, measured. And what the government feels is by 2047, our economy should be at the range of, say, 38 to 40 trillion dollars. And our per capita income should be in the range of 25 to $30,000. So that's really what the aspiration is. It is definitely a bold measure, no doubt on that. But I personally feel, you need to have a very high aspiration if you really want to achieve something big in life. Now, in this context, I think so it's also important to reflect where we are as a country, what is the world situation, which will really help us appreciate, what are the steps we need to take as a country as a whole to achieve our goal towards Viksit Bharat. Now, taking a pause here, if I look at the global economy today, the global economy is $115 trillion, out of which US is 30, China is around 20, and India is around 4.3. India does figure in the top 5 countries, but broadly, if you see, China and US put together constitute almost 45%, and we are at 4.3. So clearly, as a percentage of the global, we are only around, say, 3.5 to 4% is the broad number I would put at it. From a per capita income perspective, US is almost around $90,000. China is around $13,000 to $14,000, and India is somewhere around $2,500 to $3,000. So broadly, what the government is aspiring is that in the next 22 years, we should actually have a tenfold increase in the per capita income and almost a 9 to 10 times increase in our GDP. Now, obviously, one does get impacted by, such huge numbers. But I personally feel, it is very, very important. Your goals actually need to be very high because higher the goals, higher the efforts you're going to take to reach to that level. Now, from an other perspective, you can also appreciate that possibly in around 2 to 3 years' time, India will be amongst the top three, definitely. So currently we are at fifth, but in 2 to 3 years' time, we will actually leapfrog Japan and Germany to reach at around uh, plus 5 million is the way I look at it. Now, setting this as a context, it's also important to reflect how are things currently and where do we need to move forward from this. So the economy is expected to grow 6.3% to 6.8%. We will continue to be the fastest growing economy in the world. This is considering the global headwinds, which we are all aware of, the way the countries have actually moved towards protection. They want to actually preserve their interests first. So that has been the driving factor which has been there in the last couple of years. And it is becoming more and more rampant with the US president coming on board and the threat of tariffs being imposed on countries. So keeping that as a context, which if you ask me is not in our control, the focus on building or focusing on the consumption to my mind is a great approach because that is only something which you can control. That's point one. Two, I'll subsequently in my slide, give you very strong, cogent reasons as to why this approach of government to reduce personal taxation actually is also reflective of the efforts which each individual is contributing towards the economy. So on the economy part, I think so we are fairly reasonable to grow at 6.3 to 6.8%. And I believe we'll also be growing around 6.5% in the current fiscal year. So to my mind, this looks on track. Inflation, the good part is it has eased to around 4.5% due to the policy measures which have been taken. And hopefully it is expected to continue at the same level. Fiscal deficit, it's the finance minister is doing a great job. It is reduced. For financial year 25, it's around 4.8%, expected to be 4.4%, which, if you ask me, in the overall economics, is really a great result because due to pandemic in 2021, our fiscal deficit was almost to the extent of 9.2, 9.3%. So bringing it down from that level in almost 5 years to 4.4% is a commendable job. Having said so, these levels are still high, but I feel 2015 to 20 we were somewhere in the range of 3.5 to 4%. So clearly more effort needs to go in this aspect, and I feel the government is taking a lot of steps. The next point on gross tax to GDP, it's expected to be around 12%. And I feel there is a scope for improvement. The developed economies, very honestly, are somewhere in the range of 25% to 35%. And the OECD benchmark is around 33 to 34%. So we have some catching to play up on this. But I guess one of the most important things is 12% does not factor in any tax on agriculture because, it's a tax-free. So while agriculture contribution to the economy is pretty high, but there is no contribution towards the tax part. So I feel somewhere down the line, possibly in the next 2 to 3 years, the government will have to look at measures as to how to bring even agriculture within the tax net. Otherwise, there will be a challenge as to how to increase this tax to GDP ratio. So overall, to summarize, the focus of this budget has been to trigger a consumption-led growth, considering the global headwinds we are facing. Now, having said that context, I thought it's also important to look at, how does the tax collection look like and what are the plans for the next year. Now, tax collections comprise almost 82% of our revenue receipts. And the broad tax heads are income tax, corporation tax, GST, and customs. So broadly, if you look at the numbers which are there on the screen, they're almost to the extent of 37 to 38 lakh crores. which after reducing the state share actually comes down to almost around 25 lakh crores. But tax collection comprises of 82%, and the government in its estimate has only factored in a nominal growth of 10.8%, which to my mind is definitely achievable, considering a growth rate of 6.3 to 6.8%, and also factoring in inflation of 4.5%. Now, the other part which I actually wanted to share a perspective is on the tax collections, the way it has moved. So if you really see, income tax is actually one of the key contributors there. A 12,57,000 crores and a target of 14.4% growth in the next fiscal year. Now, to my mind, 14.4% is not really the right reflection. This actually is 25% because the base of 12,57,000 will get reduced by almost a lakh crore, which the government is going to arise because of changes in the tax rates in the slabs. So what you're looking at is a significant jump of 25% in effect from the previous year. Corporate tax, at 10%, 10.4%, GST broadly same level, and customs and excise 3%. So if you look at the broad numbers, the main thrust of the government continues to be how do I increase the collections from individual tax. Corporation tax and GST is being kept at the optimal level. So, one of the questions could be, do these numbers look reasonable or aggressive? Very honestly, if I were to look at it in totality, it is a very reasonable number. The impact of the tax benefits given to individuals of 1 lakh crore will actually definitely flow into the economy and cause a result in more increase in corporation tax and GST. While income tax does look to be a stretch, but to my mind, overall, the corporate tax and GST will actually offset it should there be any default. So that's the first point. Secondly, on income tax, and if I were to compare, how does it pan out with corporation tax? So if you really see, the gap between income tax and corporation tax is almost to the extent of around $260,000, $270,000. If I go back into time 10 years ago, 2014-15, we had a situation where almost a receipt of around, tax receipts of around 7 lakh crores. Corporate tax was around at 460 and individual taxes at 240. So that was the difference between the two taxes. The income tax, that is the personal tax collection, has grown almost to the extent of 5 times, whereas corporation tax has grown almost to the extent of 4 times. Yes, the only aberration definitely could be in corporate tax. In 2019-20, there was a significant reduction in the tax rates. And obviously, we had the pandemic in 2021. So those are the two anomalies which could have brought the corporate tax rate down. But to my mind, the personal tax is still actually very, very robust. And even if in this fiscal year 24-25, as compared to the preceding year, the growth is almost expected to be around 20%. So that's where the government possibly has taken an aggressive approach to factor in an effective 25% rate increase. But I still feel, the overall numbers are quite achievable. Moving to the next part, which is also a very important part, is around the expenditure. Now, the expenditure, if I were to really look at it, in a nutshell, your state share of taxes and duties and interest put together is almost around 45%. And then you have a capital expenditure of around 16%, and then defense and major subsidies. So this is a very key component. Now, to my mind, this is actually a structural challenge which we are dealing with, because really, the interest cost continues to be pretty high. Essentially, it means we are actually using a lot of debt to service the overall actually investment. Capital expenditure, 16%. Government is really playing a great role to actually, increase or focus on investments in infrastructure and the overall economy. But what it does is it actually poses, what are the key structural challenges which we are dealing with? Because see, we cannot be, unaware of the fact that we actually have, there is an India and there is a Bharat. So it is India which is actually contributing, but Bharat still needs a lot of support. Until the time the two do not converge, we will never be able to hit the aspirational numbers. So that is where we need to have an inclusive approach towards the growth. Implementation challenges continue because at a ground level, it is the states who are playing a great role, and we need to fix in the accountability. The budget does talk about an index to measure states, but to my mind, this aspect needs a very, very close watch. Personally, I feel government is doing a lot by, sharing a lot of burden in capital investments, and private sector does need to now actually come forward and shoulder the burden. So overall, despite the structural challenges, all of us would agree that there is a perceivable difference in the last 20 years in the way, India has evolved, and the journey needs to continue. And for the journey to continue, the reforms need to be ongoing. Uh, the proposals are, reforms in the financial sector, whereby, uh, there's an FDI liberalization of 100%, uh, subject to some conditions. Uh, Expansion of roles of the post office, whereby they want to, the approach is they should be catering to a larger needs of the rural India. Then it's about credit rating for people in the villages. So these are the broad sectors or the aspects from a financial perspective. The government has talked about introducing the new income tax bill. Uh, the intention is clear. They want to reduce the number of sections and bring it to half, simplify the language, make it easy to appreciate and understand, and thereby reducing litigation. Personally, I feel uh, I do not see wholesome changes. I only see changes in the numbering or the structuring part. Very honestly, the law itself is actually evolved in a manner whereby they are actually simplified the law. If one were to just pause and reflect, salary taxation under the new regime has become very, very simple. The expectation of government is almost 90 to 95% people are going to move to the new regime post the recent changes announced. House property is very simple. Capital gains also, the complexity has been removed last year. So we are moving towards a step, or we've already taken steps whereby the law is getting simplified. It's only the redundancies in the sections which need to be actually removed. GST, there are talks about rate rationalization, though it's not part of the budget, but that's something which is going to be dealt by the GST Council. But clearly, I feel there is some focus which needs to go. GST law, the intention of it being a simple law is actually getting more and more challenging. Uh, you will all have read about the rate classification challenges. And to my mind, that is all being driven because of focus on numbers rather than simplicity. So I think so GST is something which the government, at least the government should nudge and focus that the states should actually follow an approach whereby we are able to come up with an approach whereby the law gets simplified rather than becoming very, very cumbersome. The ease of doing business initiatives continues, but I feel decisions of the past needs to be implemented in a much faster pace. Hopefully, the labor laws which were announced should be enacted pretty soon. Fast track court mergers, and then the reforms for the power sector, mining, and urban development. So overall, to summarize, for India to grow, the reforms need to continue, and it should also continue keeping in mind the way the economy is evolving. Now, having given an outline of the reforms, I also thought which Divya also alluded to, talking about the engines for development, which is around agriculture, MSME, investments, and exports. So what I thought is it's also very good to share a broad perspective as to how do I see, the overall economy. And that does actually give, good indication as to the way the government is working on is pretty good. So if you were to look at the broad contours of the economy, it's the service sector, which is the workhorse, which contributes almost to the extent of 55 to 56%. The industry, which includes the manufacturing part, is somewhere around 27, 28%, and it's the agriculture is around almost 16 to 18%. And interestingly, agriculture, it's contributing 16 to 18% towards the economy. It is almost, 11 to 12% it contributes to the global output. So to my mind, agriculture, while it's not contributing towards the tax collection, the focus of the government should continue as to how do we actually improve or get better outputs for agriculture. Because in India, the challenge for agriculture still continues because of the poor yields, etc. So that is where the focus of developing better output, better seeds, make better availment of credit facility to farmers. To my mind, that should continue. The MSME sector is actually, if you ask me, contributing a lot. It's almost contributing to 45% of the exports because MSME factors in both the industry part as well as the service part. So scope and providing facility to this sector is very, very important. And boosting jobs and entrepreneurship in sectors like toys, footwear, and leather is really, wherein you actually want to create or improve the foothold of India in the world market. Investment should be an ongoing journey, investments in people, economy, and innovation. Though personally, I have a different take, which I'll address in the last part, is around focus on the innovation part. I feel there it needs to be a lot more. Mere contributions of 500 or 1,000 crores, to my mind, will not suffice. On exports specifically, it's a great plan to have a national plan for states to promote global capability centers, because global capability centers in the last 4 or 5 years have actually really given a good boost. They're almost about 1,700 GCCs in India, and given the dynamics of India, you will find more and more foreign companies or multinationals wanting to set up GCCs in India. And this, in the next 5 years, is expected to almost double. So I feel GCCs is something which requires nurturing, but yes, purely from an inclusive growth perspective, it is important to focus on tier 2 cities because that is where possibly you have trained talent which needs opportunities. So overall, to summarize, in to a large extent, the approach of the government on aspects around agriculture, MSMEs, and exports looks to be right. Investment is something which I feel needs to be addressed more carefully, especially on the innovation part. Now, setting this context, quickly moving to the tax proposals, and considering the paucity of time, I will actually, and again, keeping in mind also we have reputed speakers who will be taking the in-depth proposals. Just from a broad headline perspective, personal tax, significant revamp. We had a exemption limit of around 2.5 lakhs in 2014, which is now increased to 4 lakhs. No income tax up to 12 lakh for resident individuals. All this change will possibly result in almost a crore of taxpayers moving out of the tax net purely from a tax payment perspective, though still they will continue to file returns to claim rebate. You will have almost 90 to 95% people moving to the new regime. That is one part. The other changes on IFSC and startups, very good initiative because clearly, you see the government's focus because they've given this benefits extended for 5 years. So very rarely we see that, the government extends a scheme, and the message is very, very clear. IFSC, something which was set up in 2016, needs a lot of focus, and India intends to use this as a global hub for financial services. So that's a very good approach. Startups, yes, the government wants startups, and that is where the innovation will continue, and tax benefits to be extended for another 5 years. Updated tax return. Personally, if you ask me, when this was launched in 2022, I had my own share of apprehensions, but this has actually produced a great result. The finance minister in the speech also talked about almost 90 lakh taxpayers availing of this benefit, and extending this from 2 years to 4 years, obviously with additional taxes. To my mind, this could be a great tool whereby government could nudge few taxpayers to actually file returns rather than going down the route of 148, which to my mind becomes very, very cumbersome and does have a lot of litigation. Tedious provisions rationalized, threshold amounts increased. TCS provisions, definitely, a couple of them were pretty challenging and they have been removed. Transfer pricing, they've introduced a concept called block provisions for a period of 3 years. Though personally, if you ask me, one of the key issues which relates to integration of customs and transfer pricing, which is a huge challenge for the industry at large, has actually gone largely unaddressed. Then there have been other changes, tax benefits or presumptive taxation for non-residents for providing services to electronic manufacturing. Clarification in the sense they very, very clearly clarified that in case of amalgamation, the losses of the predecessor entity can only be carried forward for 8 years. You can't get a fresh lease of life. Penalty proceedings timelines have been more clarified. That is, they've used a threshold of 6 months from the end of the relevant quarter in which the action has been communicated. So to make it more simplification, much more easy to understand. Taxation of ULIPs clarified, and some other small changes around, how does securities for an investment fund, how will it be classified, and reporting requirements for crypto assets. So broadly, these are the changes from a direct tax perspective, but very honestly, the thrust is on the benefits given to the personal taxes. So that's GST and indirect tax. GST is broadly aligned with the decisions taken by the GST Council. And on customs, the focus is how to make in India. And there have been rationalization in the custom duties and the tariff structures to make it easy for major sector-specific industries related to electronics, telecommunication, and on imports of life-saving drugs and medicines. So that is the overall, theme, the way changes have been made. And yes, there are detailed presentations which are going to be taken by the esteemed speakers, which will give you a more insight. But what I also wanted to share my perspective was on, what is my personal take on hits and possible misses. So definitely, to my mind, the hits are, consumption story, give the benefit to the individual taxpayers who will drive consumption and will drive the economy. A great step in the environment in which we are in, wherein I feel there's a lot of global challenges. Two, sticking to the fiscal discipline is also a very good step because from a long-term perspective, it gives stability and also ensures that the rating of the country could improve in the coming years. Clear roadmap to simplify the income tax law, though I feel, the actions were taken almost 2 to 3 years ago. So these are the good parts, but what I also wanted to talk about is the possible misses where I feel something could be done. And a couple of them, very honestly, flow from the economic survey, which was more scathing and more direct, which I found missing in the budget. So the first part is on, I didn't see any concrete action as to how to reduce litigation at the CIT appeal levels. While the threshold limits for ITAT, High Court and Supreme Court, yes, were revised. But this is one area where I feel a lot of litigation is pending and there's a pain point, which I feel the government could have done better. Two, uh, is private sector really contributing a lot for the overall growth of the economy? I feel there needs to be a nudge from the government. The government has done all the heavy lifting post the pandemic, very honestly, and private sector needs to be nudged more from investments. And also one of the key areas is, which the uh, economic survey did point about is the growth in profitability of companies. Is it keeping pace with the growth of salary, which is being paid to the employees? So that is, to my mind, some concern which really needs to be addressed. Next, I didn't see any bold action on, innovation. Uh, if you really are aspiring to be 9 or 10 times in the next 20 years, there needed to be a bold investment plans. You need to have higher investments for innovation, and it has to be in conjunction with the industry at large. It can't be only that the government is actually making the investment. And the last part is about the challenges in the skilling and the job market. We need to appreciate that the skills which majority of the labor force has is not commensurate with the changing world. India is still focused on, I feel the low value or the medium value, wherein with the automation and with artificial intelligence and the AGI, you will soon have a situation where these jobs may no longer be required and technology is going to take over it. So that is where the skilling needs to be done at a much, much faster pace, because the economy cannot be divorced from the technological changes. So this is to summarize that few steps are good, but I feel action on innovation and clear focus on skilling and job creation could have been a better result. But overall, this is only a roadmap which the government has set. It cannot be the responsibility of the government alone. It needs to be in conjunction with the businesses, with the policymakers, and the professionals to actually set India on the roadmap for economic growth. So, with this, I wish all of you a great learning session and have a great day. And hopefully, you will be enlightened by the intricacies shared by the various speakers. So thank you, Divya. Sorry, I know it was about 9 minutes more than anticipated, but that's it.
No worries, sir. Thank you so much for covering everything in detail. Thank you so much. It's a pleasure having you.
Okay. Thank you.
Thank you so much, sir.
Yeah.
Now we will proceed for the next session on the changes in personal taxation. Joining us we have Aarti Raote, partner at Deloitte India, as a subject matter expert. Ms. Aarti Raote is a chartered accountant with over 17 years of professional experience in ex parte tax. As a partner in Deloitte Global Employer Service in Bangalore, she has advised clients on diverse tax areas such as ex parte taxation, assignment planning, social security, and stock awards. Her industry experience spans technology, consumer business, and GICs, where she focuses on structuring compensation, managing short-term travel, taxation, and optimizing social security compliances. She also derives technology solution for HR mobility to help businesses improve efficiency and reduce cost. Welcome, ma'am. Good morning.
Good morning.
Uh, the stage is all yours now.
Okay, thank you. Thank you, Divya.
Thank you, ma'am.
Thank you so much for having me here. I hope my screen is visible. Can you
Yes,
see?
your screen is visible. Please put it on slide share mode.
Okay. Yes,
Yes, it's perfect now.
right. Yeah, is it visible now?
Yes, yes, it is visible.
You can see the slide, right?
Yes, yes.
Okay, great. So thank you all and it's a pleasure to be here. And I think Mr. Anand has done a great job in setting the context for this discussion. This year, indeed, the finance minister has put a smile on everybody's face, and especially the individual taxpayers, by providing a substantial tax saving. The finance minister has announced changes in the tax slabs as well as income tax rates. And we see these changes after a gap of several decades. And it's likely that the taxpayers have more money in the pocket and it will boost the consumption as expected by the government. So let's see some of the changes that will impact individuals. We will start off with the tax rates and proceed to see what kind of savings are available if the taxpayers opt for the simplified tax regime. And then we will look at comparisons between the regular tax regime or the old tax regime and the simplified tax regime to see whether it's still relevant for people. We'll also touch on some key provisions in the budget proposals that will impact individual taxpayers. So now let's turn to the tax rates. Firstly, there is absolutely no change that is done in the normal tax regime. Since 2000, when the simplified tax regime has been introduced by the government, there have been several, what I would say, carrots or concessions that were provided in the budget for the simplified tax regime. They have increased the standard deduction in the earlier years or reduced the surcharge rates and so on and so forth. And this year too, the changes have been announced only in the simplified tax regime. Now, as per statistics last year, there are 72% of the taxpayers who chose simplified tax regime. And with the changes in this budget, it is likely that it is going to increase even further. So the first change in the simplified tax regime is that the basic exemption for income tax has increased from 3 lakhs to 4 lakhs in the new regime. So up to 4 lakhs, there is nil tax. And then you have the slab rates, which have also undergone a change. So 4 lakhs to 8 lakhs will now be 5%. Earlier, it was 7 to 8 lakhs, which was going into the 10% bracket, but there's 1 lakh, which is still now in the 5% regime. Then you have 8 lakhs to 12 lakhs, the next 4 lakhs that will be subject to tax at 10%, and then the next 12 lakhs to 16 lakhs, which will be taxed at 15% now, and 16 lakhs to 20 lakhs, which will be taxed at 20%, 20 lakhs to 24 lakhs of total income, which will be taxed at 25%, and anything above 24 lakhs, income above 24 lakhs will be subject to a tax rate of 30%. A phenomenal change for any taxpayer, because now this slab rate has jumped from like 15 lakhs at 30% to 24 lakhs at 30%. So there has been this huge jump, which will result in more money in the pockets of taxpayers. There is a tax saving up to a maximum of 1,10,000, which is available for the income, a person earning income of 24 lakhs and above. This is excluding surcharge and cess that is available. So this is the bare minimum that any person who's earning 24 lakhs saves. In the case of resident individuals who have total income up to 12 lakhs, there will not be any tax. This limit was 7 lakhs earlier, and now this limit is 12 lakhs. So this means a significant tax saving for such taxpayers of 80,000. So that is 80,000 more in the hands of the taxpayers going forward. So one needs to know that the limit of 12 lakhs will apply only to regular income. The finance minister also clarified this. So the limit of 12 lakhs has to be applied only to regular income, which means the income for which the slab rates apply. It cannot be applied to income which is subject to special tax rates. Like, for example, you could have cryptos or capital gains. For such income, this 12 lakhs limit will not be counted, and you will have to pay tax at special rates irrespective of their level of income, right? However, there is marginal relief that will be available to taxpayers who are, just at the cusp of a changeover. This means that any amount of incremental tax should not exceed the amount of incremental income. That is what marginal relief means. So let's look at an example, because there has been a lot of confusion in the minds of people because to check on whom this provision really impacts, right? So firstly, to clarify, this provision is applicable only to resident assessees, right? And if we have a taxpayer whose total income is less than 12 lakhs, and this is from a regular source of income like a salary income or income from other sources, then the person will not have to pay any taxes. However, let's take another example where the taxpayer has 10 lakhs of regular income and 2 lakhs of capital gains. In this case, the taxpayer would have to pay tax on 2 lakhs of capital gains because it is income subject to special rate, but not on the 10 lakhs. Now, let's take a slightly different example where we have a taxpayer who has total income of 12.5 lakhs, just 50,000 more. Now, in this case, the income is comprising of say 11.5 lakhs of normal income and 2 lakhs of capital gains again. In this case, the taxpayer would not be eligible for the rebate, even though his regular income is only 11 lakhs, because his total income now exceeds 12 lakh threshold, right? But in this case, the person will be eligible for marginal relief. I hope in all these examples you've understood the comparison between the three, that if you have income from a regular income from a normal source on which slab rates apply, and that is less than 12 lakhs, then you are eligible for a rebate. Yes. So with this, let's move on to the next slide where we see the tax savings, right? We just compare the tax savings for different levels of income. If the proposed tax rates are applied, and then we compare that to the current tax rates under the simplified tax regime only, and on the screen you will observe that there is a saving for everybody irrespective of their income level, right? So right from the low taxpayers to the higher taxpayers, everybody has something to save in this proposal. The saving range is from 31,000 to as high as 1,43,000 for a higher income slab. And the higher income slab, there is a change only because on account of the cess and surcharge which is applied. So all these rates have been computed after applying the cess and surcharge to you, right? So you see, as a comparison from the current simplified tax regime rates to the new tax regime rates, there is a significant change or a significant saving to the taxpayers, which of course the government expects that it will be used for consumption. Let's go on further to see whether the significant reduction in tax rates makes the regular tax regime actually irrelevant or redundant, right? Because you all would know that you as an individual, you have an option to choose between the old tax regime or the regular tax regime and the simplified tax regime. And the old tax regime rates are much more higher, but they permit traditional deductions and exemptions like an HRA, LTA, housing loan, or Chapter 6A deductions like 80D, 80C, 80E, all of those. The simplified tax regime, on the other hand, gives you reduced rates but does not permit any deduction. So, as you might observe, what we have tried to do here is that we have the income levels of 10 lakhs, 14 lakhs, 16 lakhs that you see on the left-hand side, and the possible deductions. Now, this deduction, if you see the number of 4,50,000, this deduction is basically your HRA or your LTA or your ATC, housing loan. All this makes up these deductions that are there. So, for an income person having a total income of 14 lakhs, right? He is better off in the new tax regime unless he has a total deduction of about 5,18,750. So If a person having a total income of 14 lakhs has deductions more than, say, let's say 5,20,000, then in that case, the old regime still will be much more beneficial to him as compared to the new regime. And in a similar manner, we have computed the deductions, possible deductions for different levels of income. So for a person earning an income of 16 lakhs, the amount of deduction would be around 5,70,000, and so on and so forth, right? After the level of 50 lakhs, there is surcharge which kicks in. So those calculations become a little different, right? But at the base level, this is the comparison. So in just to summarize, what we kind of can conclude that a normal level simplified tax regime is definitely beneficial. But if you have significant amount of deductions, housing loans, maybe a 80E loan, then in that case, you really need to make sure and check whether the tax, with the tax calculation between the old tax regime and the new tax regime, and take a decision of which is the regime that is most beneficial to you. And each one to it's their own, but do not presume that the simplified tax regime is much more beneficial. It would be beneficial for a lot of people, but not to everybody, right? So this is something which I want to leave you all with. Moving on further, let's look at another provision, which is in house property income. This is a welcome change, though it is clarificatory in nature. There is no change or no additional benefit which is extended to the assessees here. But the current provision allows the taxpayer to treat two houses owned by him as self-occupied and consider the annual value as nil. Okay, any house, the third house, even if it is not occupied, even if it is not rented, it will still be deemed to be rent. But up to two houses, you can provide a nil value, a nil annual value. However, there are two conditions which are there currently. One is that either the house is occupied by the owner for his own residence, or the owner is not able to occupy it due to employment, business, professional commitments, and he is at some other location. Now, these two conditions, while they look very simple, they were causing a problem because it is possible that the houses are not totally vacant, but the house owner's parents or spouse is staying in that house. And this was proving out to be a litigious issue where the, tax officers were reading these provisions as very strictly, and denying the exemption of a nil annual value, right? So because of that, this proposal is welcome, where it says that the property value, annual value, will be deemed as nil if the owner resides there or if he is unable to occupy for any reason. So the conditions that are stipulated are no longer applicable as long as the owner is residing or the houses or he is not able to occupy it, but he's not let it out, then also you will have nil value. So this is much more what I would say, this is to reduce the amount of litigation. This will help, right? The next one is on the updated tax return. Now, I would say this is a significant change to the taxpayer because it provides you opportunity to correct or rectify your tax returns for a longer period of time. Today, the provisions mention that you can you file an updated tax return up to 24 months from the end of the assessment year to which the income relates to. However, there is an additional payment of 25%, which is applicable if you revise in 12 months, and 50% if it is revised in less than 24 months, right? This is extended for another 2 years so that the taxpayer can still file updated return within a period of 4 years from the due date of filing the tax return. And this is done with payment of 60% of taxes if the revision is within 3 years, and 70% if the revision is within 4 years. Now, one needs to note that a tax return cannot be updated if any assessment is going on, or if there is any show cause notice which is issued under 148, which are the concealment provisions which have been triggered. Also, updated returns, as the law reads today, cannot be filed unless you have some income to be declared. There's some additional tax payment to be done. So currently, it does not provide a chance to the SSC to file an updated return only if you want to correct some data, or maybe some ask for more brought forward losses or things like that. For that, updation is not possible. But if there's some income which has been missed to be offered to tax, or if there is some kind of change in the tax rates that are applicable, then yes, you can file an updated tax return. This is very important in the case of, let's say, the employer notices some kind of a change in the tax position, or some income which has been wrongly classified, and on account of that there is a revenue leakage. Then in that case, he goes and files the quarterly tax return, refiles, and there's Form 16 which I issued. Obviously, there's a mismatch with what the employees have already filed, right? And this particular provision enables the taxpayer to go and revise his tax returns. In the speech, the Honorable Finance Minister did highlight the importance of trust for the taxpayers. And this is one move that enables the taxpayers who want to rectify their returns an opportunity to do so. So this is a welcome change for the taxpayers, to ensure that there is correction, so that any penalty and prosecution kind of measures are avoided in case there is significant income which is escaping assessment. So this is something that people have to take cognizance of. Moving on to other amendments, one of the key amendments that we see is in respect of ULIP. Again, this particular provision is clarificatory in nature, right? ULIP enjoys a tax exemption today, where the premium in any of the years during which the policy term is there, it does not exceed 10% of the total sum assured, or the total premium or paid during the policy's term is less than 2,50,000. If these conditions are met, you will have your ULIPs exempt under Section 1010D. Now, ULIPs not falling in this category, that is, ULIPs which are not exempt, it has now been clarified that this will be treated as capital gains, and they will be taxed similar to equity-oriented funds. So they will be either long-term or short-term based on your period of holding, but they will be treated as equity-oriented funds. This is a clarification which will reduce litigation and provide the taxpayer complete clarity on how they have to offer their income to tax. The next amendment or the next proposal is on perquisite taxation, where the government will notify certain income levels for taxation of some benefits. The government had not touched the salary threshold, so government is likely to enhance the salary thresholds under the perquisite provisions to tax certain benefits like overseas medical treatment. This is applicable for income, people having income in a very low income group, and these income thresholds were not examined for a while, so it is expected to be notified by the government shortly. The third key provision could be for people who have invested money in NPS Vatsalya accounts, where you invest for your minor kids, and there was no tax benefit available for parents or guardians who were contributing to NPS Vatsalya account. So it is proposed to put it almost at par with the current NPS accounts. And what has been proposed is that up to a overall limit of 50,000, the deduction will be available for the old for those who apply the old tax regime. Also, partial withdrawals for specified contingencies like a medical treatment or disability or education, up to 25% will be exempt on withdrawal. The balance will be taxable in the year of withdrawal. And in case of, the minor passing away earlier, the parents or guardians will not be subject to tax, right? So this is one of the clarifications that have been issued. The other last part was on gig workers. This is very important because we are seeing a sizable increase in the population of gig workers across industries. It's not just restricted to platform companies. It is kind of what I would say applied by all employers across the globe. So this is really important, and because it is emerging as a larger workforce, government is planning to facilitate the issuance of identity cards and ensure that gig workers have the coverage of social security. The labor code, which was announced about 4 years back, which is still not effective, by the way, that had support reference to gig workers, and the government is going to be extending healthcare benefits through the PM Jan Arogya Yojana. So people are requested to kind of register on the eShram portal, and this is going to benefit something like 10 million gig worker and platform worker. Of course, government has not yet come out very strong and very clear on the labor code. We understand that most of the states, up to 33 states and union territories, have already come up with some rules. So there is a buy-in from almost everybody from the state level. So we know that is the progress that has been done on labor code, but unfortunately there was the date is yet to be announced for it to be effective. So this is one of the misses that I feel it could have been spoken about. The ELI schemes also, we are awaiting the final details on the scheme. So those are some things which could affect employees at large, employers as well as employees. But overall, I would say there's a very, very positive sentiment on this budget as far as individuals are concerned. At least more money in the hands of the individuals, which could help beating inflation and increasing the consumption. There is also a very strong statement which the finance minister mentioned about trust, which is clearly indicative of what is expected from the from the what I would say taxpayers, because the government wants to reduce litigation. They also want to reduce the fraudulent practices today that are there. So, and that's why the trust on simplified tax regime. So looking at a combination of this, there is a nudge to the taxpayers to make sure that you are filing your tax returns and filing your tax returns correctly. Yes. With that, I will pause here and hand it over back to Divya.
Thank you so much, ma'am, for covering everything in detail. Thank you so much. Before we let you go, there are a couple of queries. Should I take it?
Yes, please.
Yeah, just let me have a quick look. Just 1 second. The first one is, should special incomes be included in the rupees 12 lakhs threshold for sections 87A rebate eligibility, given that the tax on such incomes don't qualify for the rebate itself?
Yeah, you cannot, as I clarified, if you have income which is subject to special rates, that really does not qualify for rebate. That is something that you will have to pay taxes on. So if you have the only source of income that a taxpayer might have is capital gains, then even if you have, say, 10 lakhs of capital gains, you will, end up paying tax. You will not qualify for the rebate.
Okay. Okay. The next is Government focusing on new tax regime under Section 115 PAC. Do you think the old regime will be scrapped off in coming years?
So definitely, as I said, based on the last statistics, 72% people have opted for the new tax regime, which means
Okay.
that at least last tax season, 28% people saw that the old tax regime is still beneficial. And if you see, I have given a comparison also here, right? Now, whether the people will have so much of deductions is a question, right? Because you will have to invest into ATC. We see a lot of people now, newer employees, Gen Z, millennials, they prefer not to even invest in provident fund, which was kind of a mandated solution or mandated option which was given earlier. So given these kind of changes, whether the people have these kind of deductions is a question mark. The definitely, if the takers like this 72% increases to 90%, 95%, then we will see that the government will ease out the old tax regime because it will have no takers as such, right? So it depends on the interest of the taxpayers as to how much they are interested in really claiming that deduction. The second part over here is more specifically, if I have to kind of say, all these deductions require certain kind of administrative discipline, right? Both for the employer and employee. Employee will have to submit supporting documents to the employer in time, and then the employer has to kind of verify this, permit this, approve, disapprove, all those kind of things. If you go under the simplified tax regime, all this is just given weight, right? So this is a second thing, whether you can, really look into those kind of aspects as well. And the third aspect is when you file the tax return, let's say you miss out something to be given to the employer. Let's say your HRA receipts, you don't give it to your employer, and you want to claim HRA in your tax return. What happens is that immediately there is a mismatch which is thrown because you're claiming HRA deduction outside of your Form 16, right? So there is a what I would say trigger to the tax authority saying that this person would not have given HRA receipts to the employer, so they call for this additional information. So it goes into a loop over there of additional scrutiny, additional verification. In the last press release, or rather a news report, there was something like 90,000 taxpayers who refiled their tax returns, withdrawing additional claims. So, as I said, the government spoke about trust, and this is where the finance minister was hinting at. So it is likely that in the coming years, if there are no takers for the old tax regime, it will be, eased out, and the government really intends to do that.
Okay. Ma'am, don't you think in that case the schemes will lose their shine as many people invest in them to get to benefit of deductions only?
Yes, that is definitely a drawback. The small saving schemes, you have a lot of these, right? Your Provident Fund, your post office saving schemes, and a lot of things that people invest in, like your saving certificates and things like that. And one aspect of this, Divya, is that all these are very long-term investments. You don't keep withdrawing these on and off, right? So
Yes.
these savings go a long way in building the infrastructure for the country. Because like you invest in PPF, okay, even if you are investing something like as small as 10,000, there will be countless people who are doing that, and this you cannot withdraw up to 15 years. So which means for 15 years your money is locked up, and it is put to good use, hopefully, is what we can assume. So definitely there is a little less shine, or as you said, it loses the luster that is available on these small savings. But the other side of it, we see a lot of individuals who say that you don't force me to invest into, things which are approved under ATC. I don't want that. I want to invest, but I want to invest freely. That also is there. So there are different, what I would say, facets to the same challenge.
Okay, thank you. Ma'am, there's one more question. If a person has a salary income of rupees 10 lakh and capital gain of rupees 4 lakh, will he be eligible for rebate?
So, okay, what it refers to is 14 lakhs of total income, right?
Yes.
So, if
Yes.
your total income is 10 lakhs plus 4 lakhs, 14 lakhs, so you're out of the threshold for rebate. But what you could possibly look at is marginal relief, which means you don't pay additional tax more than what you have got additional. So that can be available, which is really marginal, honestly. But the biggest thing, okay, if you want a 12 lakhs rebate, you have to have a threshold to meet that 12 lakhs.
Okay, thank you. Let me have a quick other more queries. There's one query in chat box. Does dividend income from shares qualifies for special tax rates?
Uh, Sorry, please come again.
Does dividend income from shares qualifies for special tax rates?
Oh, it would be in the normal tax rates because you see what is normal income? Normal income is something which you apply your slab rates to, right?
Yes.
The slab rates are there, right? You apply the slab rates to that income, that is your normal income. Where there's a special rate which is specified, like you have your for capital gains 12.5 and all 15%. So that is different. That doesn't come in these special tax rates.
Okay. That's all from our side. Thank you so much, ma'am, for the insightful session. Thank you so much. It's a pleasure having you.
Same here. Thank you.
Thank you so much. So we will transition to our next anticipated session on the changes in charitable trust by Dr. Manoj Fogla, Suresh Kejriwal, and Tarun Kumar Madaan. Dr. Manoj Fogla is a senior partner at SAGA Law LLP. He is a fellow chartered accountant, law graduate, and PhD holder from 𝐒𝐿𝐵 University. Dr. Fogla has devoted over 3 decades of taxation, CSR, and FCRA governance. He advises diverse charitable organizations in education, religion, and environment, providing advisory services, compliance management, and litigation support. He is the author of Taxmann Trust and NGOs and has produced multiple FAQs on GST and FCRA for the ICA. A frequent speaker at national and international forums, Dr. Fogla is recognized for his extensive contribution to NPO governance. And the next speaker is Suresh Kejriwal, partner at Kejriwal Agarwal and Company. With over 30 years of experience, Mr. Kejriwal is a chartered accountant and founding partner of Agarwal 𝐾 in Kolkata. He specializes in the NGO sector across India, Bangladesh, and Nepal. He is a faculty member for the Diploma in Financial Management and Accountability at Tata Institute of Social Sciences in partnership with the Financial Management Service Foundation, formerly part of ICS Cooperative and NGO Sectors Committee. Suresh is an associate author of Taxation of Trust and NGO by Taxmann and has contributed to ICS GST FAQs and NPOs. He is a seasoned speaker leading workshops and seminars on NGO related topics for numerous organizations, including the ICA. Tarun Kumar Madaan, lead business advisory at Coherent Advisories. Mr. Madaan is a qualified chartered accountant focusing on taxation, startup, consulting, and NGO advisory. Over the years, he has mentored multiple startups and consulted for NGOs across India, offering guidance on organizational setup, accounting process, tax compliances, due diligence, and fundraising. He regularly contributes articles on income tax and NGO matters to prominent publications. Tarun also holds a diploma in international taxation from ICI and is a commerce graduate from Punjab University, Chandigarh. Previously, he has served as a faculty for the income tax module of TAP course and Taxmann Academy. A very warm welcome to three of you all.
Yeah, good afternoon.
Good afternoon, sir.
Yeah, so Tarun, today we will be talking on charities. Budget 2025, if you look at the amendment, it will give an impression that not much has changed as far as the taxation of charity is concerned. There are few amendments, but in the larger context of the charities, these amendments also will have far-reaching implications. And the structural change which the government is promising in the recent past and through the proposed finance bill, how they actually help the charities will try to discuss. We have structured today's session in such a manner that I'll provide an overview of the amendments, and then we will technically try to understand the actual interpretations and the implications by going through the statutes and the exact changes, because there are many things which has to be read between the lines and which are not apparent from a plain reading per se. But before that, let me give you a context. This year, the charity amendments have come with regard to the smaller charities. Primarily, the amendments say that smaller charities which have registration under Section 12AB will be allowed to continue their registration for 10 years. And there are two, three other amendments which talk about there was a weird provision in the Income Tax Act, an archaic law, that a charitable organization has to report about the donor who has contributed 50,000 rupees or more, not only in the previous year, aggregate over past 20, 30 years. And even the relative of such donor information was required to be given, which was a practically infeasible provision. So that also has been deleted. And there have been some additions regarding the change, the powers of the commissioner with regard initiation of cancellation proceeding. But if you look at the charities, this year amendment suggests that smaller charity will have a longer duration of their registration certificate. The intent might be good, but in reality, they would not be getting that benefit that we are going to discuss. But if you see, the structure of our law in India is such that charities are regulated based on their registration certificate. They are not regulated based on the amount of money they are mobilizing or amount of income they are using or the type of work they are doing, which ideally should have been the manner for regulating a charity. Today, a charitable organization having 12AB registration, it comes under regulations the moment its income exceeds 2.5 lakh rupees. And with a 2.5 lakh rupees income, it is subject to a hell lot of compliances, Form 10BB, ITR 7, books of accounts under Rule 17A, which are virtually a myriads of books and documents are prescribed. So it was quite unfair to expect very small, tiny, micro charities to be subject to various kinds of compliances, because the regulatory scheme is such that it is based on the registration of charity rather than the quantum of money they are using or the nature of activity in which they are engaged, which ideally should have been the criteria for regulation, which is the criteria for regulation for other SSCs. For instance, tax audit and various other audits, special audits under Income Tax Act are basically based on the nature of that particular transaction or the quantum of that particular transaction. But that is not the case in case of charities. And that is the root cause of various kinds of problems which the charity sector is facing. I will give you one or two examples. For instance, a charitable organization receiving substantial grant from government is exempt from all kinds of compliances except filing return. So you are a charitable organization, whether government control or a private charitable organization. If you receive even 100 crore rupees grant from government, you are not subject to any regulation under section 1023C, 3AB and 3AC, where substantially funded organizations are totally exempt. This is weird because an organization working, managing on public fund is not subject to any compliance or oversight. On the contrary, a charity working from its own private tax-paid fund or funds collected through tax-paying SSCs is subject to so many conditions the moment it crosses 2.5 lakh rupees. So it is a kind of paradox. You manage hundreds of crores rupees. If you are government funded, you are not subject to any regulation. You manage 2.5 lakh rupees, you are subject to so many regulations. Similarly, if you are an educational institution, so up to 5 crore of your rupees, you don't even need registration, and you are virtually unregulated, and you are not subject to the condition of utilizing money for charitable purposes to a particular limit. For instance, charitable organizations are required to apply up to 85% of their income. So these kind of arbitrariness in the act needs to be addressed, and we hope it will be addressed maybe in the finance bill or in times to come. And maybe government is also mindful of this kind of arbitrariness, and a step has been taken to weed out some of such arbitrariness in the budget 2025. And the primary step which the government has taken is giving the smaller charity a bigger tenure. They will be allowed to a 10-year registration so that they don't go through the grind of getting themselves renewed every 5 years. But the amendment is structured in such a way that all existing charities cannot avail this benefit. Most of the prospective charities cannot avail this benefit. The organizations who will avail this benefit of 10-year certificate for all practical purposes will be not getting any benefit out of it, because they will have to do the same grinding for ATG every 5 years. So basically these amendments, and similarly we have these kinds of issues with the other amendments, and because they require technical attention, I would we have structured, and I would request Suresh ji to run us through the exact amendment and the exact issues which are arising out of these amendments. So with these brief words, I invite Tarun and Suresh ji to first run us through the amendments.
Suresh sir, you are on mute.
Thank you, Manoj, for setting the tone for today's discussion. And in this year budget document, at least ministry has recognized by mentioning that the registration requirement are uniform across all the organizations, and even a charity of 10 lakhs are going to have a same process with a charity of 100 crores. So the ministry has recognized that there has to be some leeway or some area of comfort for a small charities, and based upon that, I think this year charity exemption certificates have been proposed. Now let me share my PPT. This is clear, Tarunji?
Yes, sir. Perfect.
Okay. So there are basically three major amendments. The one amendment is the period of validity of registration for small charities, which they have defined which charities shall be called as small charities, where the registration period shall be 10 years instead of 5 years. Secondly, they have also modified the provisions for a specified violation leading to cancellation, and they provide that minor default will not result into a specified violation, which will result into a cancellation. And they have also provided for modification in relaxation in the definition of a specified person under section 17(3). That is basically the the substantial contributor. Earlier it was 50,000 per year. Now they have modified this limit, and some additional implication may be on the updated returns and the TDS provisions. In these two amendments will also have an impact on the NGO sector. Now to start with the period of validity of registration for smaller charities. Now, the budget document has recognized on record that the currently regular registration to a trust or institution is granted for a period of 5 years, and provisional registrations where activity has not yet commenced are granted for 3 years. And they have gone mentioning that the registration requirement are uniform for all the organizations, meaning a small charity with an income of 10 lakhs is subject to same compliance requirement as a charity with an income of 100 crores. And based upon this understanding, the ministry has proposed an amendment, and they have inserted a proviso in section 12AB1. 12AB is a process of registering an organization and giving a certificate of registration. Under 12A1, the application is made. Under section 12AB, the CIT exemption issues the certificate. And here the proviso says, where an application is made under subclause 1 to 5 of the said clause, and the total income of the such trust or institutions without giving effect of the provisions of section 11(12) does not exceed rupees 5 crore during each of the 2 previous years preceding the financial previous year in which the application is made. The provision of subsections shall have effects. For the words 5 years, the word 10 years shall be substituted. That means they are providing, if the total income of the trust, applicant trust, is less than 5 crore, now doesn't exceed rupees 5 crore in each of the 2 previous year, then the registration shall be granted to such organization shall be for 5 years, shall be for 10 years instead of 10 years. So what is the proposed amendment? The proposed amendment says the validity of registration period from 5 years to 10 years, provided the income before exemption under section 11(12) doesn't exceed rupees 5 crore in each of the 2 previous years preceding the year of application, and application is made in section 12A1 AC 1 to 5. That means only for the application made in 1 to 5 clauses, this small charity relaxation has been given. So the condition is the income doesn't exceed 5 crore in the 2 previous year preceding the year of application. Suppose you are making application in the financial year 25-26, then the preceding 2 years, that means 23-24 and 24-25, the income has to be doesn't exceed 5 crore. Then only this relaxation will be granted for certificate for 10 years. Now the first issue is whether the benefit extend to all categories of applicant. The sections itself says, newly inserted section says, the registration applicant under subclause 1 to 5. What is 1 into 5? Clause 1 says re-registration for 5 years for existing 1/4/21 registered organizations, which we have in most of the cases, this has already been completed. Now, renewal of registrations, 1 year registration period expires. Every 5 years, you have to apply for renewal. So for such renewal, this relaxation shall be available provided the charities are small charities. Then the provisional registrations are also need to be converted to a regular registration within 6 months of the commencement of charitable activity. In such cases, the subclause 3 application shall also be subject to the relaxation. And reactivation of the inoperative registration under subclause 4 shall also be under the relaxation provisions, and also for the registration on the modified objects. So basically, renewal, conversion of provisional registration to regular registrations are all covered under the new relaxation proposals. What they have not covered is the subclause 6. And the subclause 6 where the first time application or the new applications are made for registrations. So I don't know why they have not covered this, but technically they have not covered this 10 years relaxation to NGOs who are applying first time for the registration under clause 6A or clause B. Now the second issue is what shall be the effective date of amendment. The amendment says it shall be from 1/4/25. And therefore it is unclear whether this applied to the registration certificate granted on or after 1/4/25 or to applications made after this date. As per our understanding, the amendment has been made in section 12AB1, which outlines the procedure for registrations or cancellation of registration by the principal commissioner or commissioner on receiving an application under section 12A1AC. So the applications are made under 12A1 and the process of registration is done under section 12AB, and the amendment has been made under section 12AB and not under 12A1. And that's why, as per our understanding, the registration certificate issued on or after 1/4/25 will be valid for 10 years if the organization meets the specified criteria, irrespective of the date of application in which the application has been made. And therefore, consequently, all pending applications for 5-year registration, including the application for regularizing provisional registration, should be issued for 10 years if these are processed and granted on or after 1/4/25. That means all the pending applications for renewals, all the pending applications for conversion to a regular registrations, if they are processed after 1/4/25, then we understand the certificate granted should be for 10 years. Now, what are the implications for the different type of registrations? For re-registration under clause 1, this was a window for making a fresh registration under section 12AB by an existing organizations under section which are registered under section 1/4 on 1/4/21. Now this window, this timeline has completed, but still after the last budget has given a window to apply for this registration after condonation of delay. We understand if anybody is applying for a 5-year registration because they have not yet applied after a condonation of delay, and if the delay is granted, and if such certificate is granted to them on or after 1/4/25, then this certificate shall also be for a period of 10 years. Now, renewal of regular registrations, again, all these applications having validity for the assessment year 26-27, we need to apply application by 30th/9/25, meaning thereby all the charities, if meeting the criteria for small charities, meaning thereby in most of the cases, if they are submitting 10 BB audit report, meaning thereby they have a turnover, they have an income less than 5 crore, I think those charities may be covered by this small charities and they should be granted a 10 years registration. Now, conversion of provisional registration to regular registration, again covered under the relaxation of 10 years, provided they meet the criteria. Now, the new registration where the charitable activity has not yet commenced. And we all know in such cases, provisional registration shall be granted and there is no change in the period of registration for the provisional registration. And in all such cases, the provisional registration regular registrations, once the activities has been commenced, in such cases, the 10 years registration shall be granted if these are processed on or after 1/4/25. Now, where charitable activities have commenced, the new cases, but the charitable activity has already commenced. In such cases, as clause 6 has not been covered by the amended provisions, in such cases, even be submitting form number 10AB, even if our total income is less than 5 crore, the new registration shall be granted only for 5 years. Only when they go for renewal after 5 years, then only they can apply for they can get a 10 years registrations. And ironically, there is no consequential change in ATG approval. So the 12AB may be for 10 years for small charities, but the same charities, as because no consequential amendment has been made for ATG, that shall be only for 5 years. And that means ATG approval needs to be revalidated every 5 years. Tarun ji?
Sir, now a very important question comes that the scheme of registration is such that entity can apply directly even before the commencement of activities or after the commencement of activities. If they are applying before the commencement of activities, they have to apply for provisional registration. Then after commencement of activities, that provisional registration has to be converted into regular registration. The another option is that they can apply directly for the regular registration. Now, after this amendment, which route is beneficial for them?
And we have to understand that we are not sure why clause 6, under which first time application is made, whether for regular registration after commencement of activities or provisional registration. This clause has been not covered. So once this clause is not covered, both type of organization at the time of making application are not eligible. But what happens if an organization applies for provisional registration, then later on it is required to convert that provisional registration under clause 3. And because clause 3 is covered under 5-year benefit, so the organizations which will apply for provisional registration first and then later on get it converted in clause 3, they will get 10-year certificate. But all organizations applying for the first time under clause 6 are not covered under this clause. Now the problem is that most of the charitable organizations, except barring exceptions, when they come for application, they would have commenced some activity. They would have spent some money. So if you see, for all practical purposes, existing organization cannot get the 10-year benefit. The existing organization will get 10-year benefit only when they get their certificate renewed, whenever 5 years are completed. And new organization, most of them will not get the benefit, because once you have commenced the activity, you will get your regular registration under clause 6 itself. So all practical, so there is a very small window of organization who will apply for provisional, then get it converted. Only those organizations will be benefited out of this provision, and the organization which will be benefited in future when they get their 5-year certificate renewed. Barring that, no organization in the country will be benefited out of this amendment. So that is why it is slightly surprising, in the light of the impending finance direct tax code and the new finance bill, why this benefit was given in the interim period, which is not available in the interim period.
Sir, another important question, which is regarding the effective date of this amendment. The reason is that, suppose if I have filed an application today, or if I am supposed to file application in the month of February or March, will I be granted the registration for 10 years or 5 years? Or ideally, NGOs should wait to apply after 1st of April, or they can apply today and they will receive registration certificate of 10 years after 1st April 25.
Suresh?
As I told, that the amendment is made in section 12AB, and the 12AB is the section where applications are, when the applications are received, then how the CIT will process that application. Okay, so there is no change in section 12A1, which provides for the requirement of submitting application or the timeline for submitting the applications. And the period of 5 years, and 5 years was mentioned only under section 12AB. And this is the power of the CIT to grant approval for 5 years or 3 years, as the case may be. So we understand, as a section, as a proviso has been aided only under section 12AB and not under section 12(1) is C. I think this the amendment shall be on the basis of the date of the order. If the order date is after 1/4, on or after 1/4/25, I think the amended provisions shall apply, irrespective of the date of application being made.
Sir, now after the amendment by the Finance Act 2020, wherein all the NGOs which were registered prior to 1st of April 21, they all were required to get themselves re-registered, and the due date was extended to file application multiple times, and the latest due date was 30th of June 24. They all were granted registration certificate for 5 years period till assessment year 26-27. Now, will their existing registration certificate will get extended from 5 years to 10 years, or they need to apply for renewal?
Now, as we understand, the organizations have been issued a very specific certificate which specifies the assessment years for which the certificate is valid. And the certificate was issued in the past. There is nothing in the Act to suggest that it will have a retrospective applicability. That certificate issued in the past for smaller organization would automatically get converted. And otherwise also it would not be possible, because this benefit has come with some riders. Because this amendment says the small organization should have turnover of less than 5 crore in 2 preceding years. So now an organization which was given a renewal certificate in the past for 2 year, 3 year, 5 year, those certificates cannot be amended without a due diligence and verification whether the turnover exceeded 5 crore rupees. So therefore, in our understanding, neither it is provided in the Act, nor it is technically possible to extend the existing certificates. Therefore, the existing organization will continue to have a 5-year registration unless CBDT, exercising its power under 119, converts those certificate into a 10-year certificate.
Sir, now under this amended proviso, the one-off condition is that in the previous 2 years, your income should not exceed 5 crore rupees. Now, which 2 years has to be seen? That comes a question. For example, we are applying in the month of April. So in the month of April 25, we have to see 24-25 and 23-24, or the years for which audit report and income tax return has already been filed and accounts have been finalized. So which 2 previous years have to be seen to qualify an entity as a small charity?
There are 2 aspects to this query. One is that what would be the compliance requirement, which audited statement we should be uploading at the time. Suppose you are applying in April or May, you might be aware that your turnover is less than or more than 5 crore, but your audited statement would not be available with you. So to our understanding, at the time of the passing of the order, the immediately preceding previous year, financial year, would be relevant as far as the issue of certificate is concerned. But if you are applying in April, April or May, you may upload the 2 years preceding to that. But the 2 years preceding to the date of the order, 2 financial year preceding to the date of the order should be technically relevant. It cannot happen that you had 2 years and in the subsequent year you have more than 5 years and you still will get the certificate. This question becomes more important because nothing in the Act is mentioned about once a charitable organization gets a 10-year certificate, what will happen? Our understanding is that even if its turnover exceeds 5 years during this 10-year period, there is no provision to convert or withdraw or reduce the tenure of the certificate. So to keep it simple, uploading requirement as per the Act, if your audit timelines were not due, you need not upload that particular year's audited statement. But on the date of the issue of the order, this CIT has to see the immediately to preceding financial year whether you have exceeded 5 years, 5 crore or not. Suresh,
I go by your understanding. But the problem is that in the present form, there is no such 2 years conditions in the when we submit the form. And maybe at the time of getting it registered, the CIT by way of a questionnaire may ask for all these details. What is your total income preceding the year of applications? The issue will come up when you have made application in suppose next year February, and then the previous 2 years shall be 23, 24, and 24, 25. But the CIT makes processing the next subsequent year. So I think 2 years from preceding the year of application, that should be the these 2 years should be examined. Suppose CIT process your application in the after April 26. So in this year, this 2 years challenge might be there. Otherwise, I think at the time of giving the certificate, the CIT should examine whether the preceding 2 years conditions have been followed or not.
So now another important question is regarding that 5 crore limits. It says that your total income before exemption under section 11 and 12 shall not exceed 5 crore rupees. Now, how to compute this 5 crore limit? Like whether the incomes which are exempted, like the corpus donations, if invested into permissible modes, are not form part of the total income, whether such income shall be excluded for the purpose of checking the limit of 5 crore. And these questions become more relevant in the context of filing of audit reports as well, because like whether audit report has to be filed in form 10B or 10BB, a similar criteria has been mentioned of regarding the total income of 5 crore, that how to compute this 5 crore limits.
Look, to compute the 5 crore limit, the simple thumb rule you have to apply that whatever was subject to 85% application should determine that limit. But when we try to apply this thumb rule, the confusion comes that corpus donation is not subject to 85%. So therefore, will corpus donation be excluded? No, corpus donation will not be excluded because corpus donation was also subject to 85%, but it has been specifically exempted. So corpus donation is treated as deemed contribution, deemed application under section 11(1)(d). So for that simple reason, so whatever is your total income, the problem again or this confusion persists because the total income for the purposes of charitable organization is not the total income which we understand under section 2 subsection 45 which is computed under 5 heads of income, because charity's income is computed in a commercial sense, and that commercial sense and the scope of that commercial sense has not been defined anywhere in the act. So we take a constructive and common sense definition of this total income is that whatever is otherwise applicable. So for instance, agricultural income is not subject to 85%. If you see section 11(7), so it has been specifically excluded to be added to the total income. So whatever forms a part of the total income, even if it is exempted, to be excluded at the threshold itself. So corpus donation is one income which is excluded at the threshold. Therefore, it creates a confusion, but corpus donation should be included for the purposes of determining this 5 crore limit.
Sir, now this provision has been introduced, and Finance Minister, while reading a budget speech, said that this benefit is specifically mentioned for the small charitable organizations. Suppose NGO has been granted a registration certificate of 10 years. Now in the 3rd or 4th year, its total income surpasses 5 crores. Whether it need to get a 5-year certificate fresh or the existing certificate of 10 years shall continue.
Suresh?
Because there is no change in the compliance mechanism on the basis of a 10 years registration certificate. In the case of a 1023C, up to 5 crore and beyond 5 crore, there are two specific provisions. And beyond 5 crores, there are different provisions to apply. And there, the approval was necessary. But here, either you are 5 years registration charity or a 10 years registration charity, your operational mechanism are same. So there is no fundamental change in the compliances other than the 10BB and 10B report. Okay, so I don't think there will be any change requirement for getting the certificate again redo for 5 years.
So now charitable organizations are mostly registered under 12AB, and also they get ATG approval to collect the donations and to pass on the benefit to the donors. The amendment for small charities has been proposed under 12AB, but no corresponding amendment has been proposed in section ATG approval categories. So what exactly would have been the intent of the government, or whether they have been missed out passing on this benefit?
No, this is a bit surprising because smaller charity, because the compliance requirement for ATG registration or renewal and 12AB registration or renewal are similar. in such circumstances, making ATG a 5-year certificate and 12 baby a 10-year certificate doesn't help the organization in real sense, because in our understanding, this is specifically only for 12-year registration and not for ATG. So ATG certificates will continue for 5 years. The intent for the department could have been that they don't want to give ATG for 10 years. ATG, the intent is to have an oversight, maybe 5-year oversight before renewal, that whether the ATG was properly used or not, whatever. If that was their intent, then the ATG compliance should be routine in nature. ATG renewal should not be subject to extensive questionnaires, extensive documentation. So once a organization is continuing the 12-year registration certificate, then the ATG should have been a oversight renewal rather than a comprehensive scrutiny-based renewal. So in that sense, there is some kind of arbitrariness about not extending, and it is not fitting to the intent also. Even if the intent is to give a lesser tenure to ATG, then the compliance also should be lessened.
And sir, like we have discussed it multiple times, that the intent was to pass on the benefit to small charities, but like they have missed on ATG category, and they have missed on to pass on the benefits who are applying directly for regular registration. So whether the intended benefit has actually been passed out to NGOs or not, that has to be seen in the times to come.
No. Our understanding in the past has always been that the compliances for the charity sector made with the wisdom of the revenue are too extensive. So even if these compliances are to stay, it is practically not possible for small charities working in grassroots in villages to prepare a Form 10 BB, to prepare documents as prescribed under the rules, which there are 17, 18 categories of books and documents. So it is quite unfair, and in that sense, the income tax laws don't promote smaller charities, the work of the smaller charities, which defeats the larger intent of our country and the government, is that the development should come from the grassroots, or the Gandhian idea of Swaraj. So the law is creating deterrence to smaller charities. So there has been a long standing need that a smaller charity should be subject to smaller compliances. So there are no relaxations as far as how smaller charities are concerned. Even a tenure of this certificate is not a relaxation in compliances. It is not a relaxation in that sense. And that also is not available. That also is not available to almost all the charities, because existing will not get, new ones cannot get if they have commenced activity. Only at the time of renewal, after 1 year, 2 year, 3 year, 4 year, some will get. So in that sense, it is more symbolic in nature, the amendment, but it does not endure any real benefit to the smaller charity. The government has to do more to address to the issues and the structural problem in the law, which is in some sense victimizing the smaller charities. Suresh, you want to add something?
Yeah. Sir, the only clarity the government has tried to give in is to define what can be the small charities. And at least, so at least up to 5 crore income, without giving benefit of Section 1112, they are time and again saying that can be categorized as a small charity because 10 BB and now this registration period. And we hope in the income tax code, which is going to come, if they are giving some relaxation, the relaxation shall be for a small charities. That means which are having less than 5 crore income.
For that matter, even a much lesser limit of 1 crore rupees go a long way to smaller charity if some compliance relaxations are given. The way we give them under tax audit. Tax audit also we have a considerable financial slab below which smaller businessmen are not troubled. So similar kind of a corresponding slab is necessary, because the Form 10B and the audit is more or less as or more complicated than the other tax audit which we are doing. So in that sense,
Yeah.
it is an impending thing which has to be addressed.
So rather
Yeah,
than
right.
just extended the validity of registration period, it would have been made more sense. They could have introduced a presumptive like scheme wherein they would have exempted from the requirement of audit and simplified ITR form. The ITR 7 is so complex that even the professional face trouble in understanding the how to fill the information and where to fill the information. They could have made some relaxations like that.
Yeah.
So now we shall move on to the next amendment, next proposed amendment, that the minor default in registration application shall not constitute a specified violation that is subject to cancellation. What is the present provision? Section 12AB4 of the Income Tax Act provides that the Principal Commissioner of Income Tax can cancel the registration if they notice a specified violation occurring during any previous year. And according to the explanation to Section 12AB4, the different type of violations are specified to constitute a specified violation. And this includes, among other things, the cases where applications referred to in Section 12A once AC, that is when the NGO is applying for a registration or renewal or converting the provisional registration to a normal registration, if those applications are incomplete or contains false or incorrect informations, only on those basis that constitute the specified violation and subject to cancellation of the registrations. Now the proposed amendment, what they have done away with, they have deleted the word is not complete, meaning thereby, if in the application is not complete, then this will not constitute a specified violation subject to cancellation. But they have intact the word, if the application contain false or incorrect information, then still this will constitute a specified violation. So at least by removing the word is not complete, at least gives some relaxation to the charities, because the cancellations means 115 TD means you have to pay tax at the fair market value of the entire asset. In that way, this is a welcome provision. But by retaining the word false or incorrect, we have to analyze what shall be the implication for this amendment being made.
Sir, as you suggested that under clause G, they have deleted the incomplete word, that even if the application is not complete, it should not constitute as a specified violation, but they have retained the words false or incorrect information. Now, what shall be the implication of it? And what will be the consequences if there is incomplete information in the application and that results in the incorrect information? Because the words were used differently, incomplete or false or incorrect. Now they have just deleted the incomplete, but they have retained the word false information or incorrect information. So how the applications are to be handled in such cases?
Now, let us spend a minute or two on the larger intent of the law and the amendment thereof, and whether it is making sense at all. If you see, the charity, this amendment has been made under specified violation. What are specified violation? That if you do these violations, we will cancel your registration. So on one hand, if you make payments to specified person, if there are reports of misappropriation of fund by specified persons under section 13(1)(c), that has been deleted as a specified violation. So, and you will be taxed for that particular year for whatever specified. You make violation under section 13(1)(d) regarding investment, that is not a specified violation. You don't fulfill the conditions of registration, audit, filing of return, maintenance of books of account, that is not a specified violation. But if you don't comply under any other law, that is a specified violation. And it is not stated in the act that what kind of non-compliance under any other law. So it is quite contradicting and paradoxical, the law which has been. So the idea of cancellation has always been that the commissioner should ensure that the organization continues to be a genuine charitable organization. If that condition is fulfilled, then all other violations should be left to the assessing officer. So that was the original intent when we had the cancellation provision under section 12A or even prior to that when it was. But now by adding so many violations, specific violations, we have created situations where ingenuine organizations may continue. For instance, an organization is misappropriating funds. In the name of the trustee, the commissioner may feel that this organization is not a genuine organization in the light of the misappropriation made, and the money was used for the benefit of breach of trust to the benefit of trustees. That is no longer a violation, but smaller things, incorrect information, false information, and incomplete information. Incomplete information was quite weird. So that provision should have been deleted. It should not have been there in the first place. Incorrect information can only become a cause of action where the organization deliberately misinforms the department, and that incorrectness of the information has resulted in some benefit under the act or registration benefit. Unless that happens, how can an incorrect information be a reason for cancellation? So this continuing the word incorrect information will again be a bone of contention and maybe subject matter of future litigations. It would have been better to delete all these. False information is in any way covered. You don't need a special provision to initiate cancellation proceeding. If the organization provides false information, if the organization on oath or on affidavit is giving you wrong information, the department doesn't need a specific clause to cancel the registration. So in that sense, the intent of this clause is not understood and it is not serving any purpose.
Now we are coming to the third proposed amendment, and it is in the definition of a specified person under section 13(3). Section 13 of the Income Tax Act provides that section 11 and 12 shall not apply to exclude any income from the total income of a trust or institution if the income inures or if any income or property of the trust is used or applied directly or indirectly for the benefit of any person referred to in section 13(3). That means if the income of the trust and organizations applied for the benefit of any person as referred in section 13(3), then the section 11 benefit is being withdrawn and the amount is subject to tax on the amount of the benefit. What are the current provisions? Any person on section 13(3), among other things, they have also includes the person who is substantially contributing, and that is and they are also one of the specified person. And as per the current law, any person who has contributed to the trust or institutions of more than rupees 50,000 up to the end of the relevant previous year shall be regarded as a specified person. Meaning thereby, if any person has given in any year more than 50,000, he continues to be a specified person for all the years, not only in the year in which he has donated the money of more than 50,000, but in the subsequent years. And not only they becomes the specified person, but also their relative and also their concern in which they have substantial interest were also considered to be specified persons. So it was very difficult for a part of the NGO to collect these informations for a donor who is giving amount donation to us, to ask for their relative, ask for their concerns in which they are substantially interested. So this budget has proposed the definition of this significant contributor, and they have proposed that they have provided for the revised contribution limit, and as per the revised contribution limit, the person shall be classified as a specified contributor only if it exceeds rupees 1 lakh in the relevant previous year. That means the limit of 50,000 has been modified to rupees 1 lakh or rupees 10 lakh in aggregate over the preceding years. So earlier rupees 50,000 was in aggregate as well, but now 1 lakh in a relevant financial year or rupees 10 lakh in aggregate over all the preceding financial years. They have modified the limit, they have increased the limit, they have also excluded the relatives of the specified person to be a specified person for the purpose of section 13(3). by amending the relevant section. And they have also excluded the concerns with substantial interest in which the specified person or this donor has an interest, that shall also be excluded from the definition of significant contributor, meaning thereby after this amendment, only the person who is donating the money shall be the specified person, not his relative, not his concern, any concern in which he has a substantial interest.
Now, sir, there is amendment in the meaning of substantial contributor, and even these details are to be reported in audit report in Form 10B and 10BB. And even the revised limit says that we have to see the contribution during the lifetime of the trust for a specific donor if they exceeds the limit of 10 lakh rupees. But there was a circular issued by CBDT 17/23, which says that for the submitting of information in audit report, only the contribution during the year has to be seen. Now, whether this circular still holds relevance after this amendment?
Suresh.
Actually, this circular 17 was given to address the once this inconsistency between the income tax ITR 7 and the ITR Act, and also the difficulties faced by the NGOs to collect all these informations. Okay. I understand even if the limit has increased to 1 lakh or 10 lakhs, still it is very, very difficult to collect information for the past donors and to make it and complete in the written form. I understand by that is the spirit in which Sector 17 was issued should also hold good even in the revised limit. Because the 1 lakh limit is not a big limit, and 10 lakhs limit in the present scenario in aggregate is also not a very, very big limit. So what I understand, Circular 17 should apply, but as the Act has changed, has been modified, I think Manoj can add whether that circular will still hold good or not. And that is the...
No, because first we should see that the Act has split the limit now. So now the Act segregated, the Act specifically provides an aggregate limit and a one-time limit. So earlier we did not have a segregation of a 1 year and an aggregate limit, and CBDT, using its exemplary powers, exempted organization from the cumbersome requirement or practically impossible requirement of reporting donors and the relatives of donor in all the past years. But now, since the Act is dividing two limits, if we apply this circular, then the second limit will become meaningless. So, to my understanding, and because the second limit also is 10 times more than the 1 year limit, I think unless the further clarification or a modified circular comes, this rule, no matter how bad it is, I think it would be safe to assume that aggregate detail, in case now the universe has been reduced. Earlier it was donor who was given 50,000, there would have been thousands and thousands of cases. Now 10 lakh and more, the universe would also be very small. Donors who have given more than 10 lakh rupees in the past. So in that sense, the requirement and furnishing the requirement has become little more easier and practical, and therefore it may not be very wise on our part to presume that the circular is not applicable. Maybe a modified circular is expected. Till then, we should keep on reporting donors beyond 10 lakh as far as past
Yes. I also see the validity in your argument, because the universe will be very, very less, because relatives are excluded. There is no relatives. The substantial contributor concerns are excluded. Only the name of the donor and that are available with the organization itself. So with that logic, the universe becomes very, very less and limited only to the donor, which are the knowledge of the organization. I think Circular 17 should not apply if in that logic.
Sir, now what will happen if HUF is one of the substantial contributor if it exceeds the specified limit? Now, what things the auditor and the NGO has to keep in mind?
Suresh ji?
As per our understanding, substantial contributor, donor, they have not defined, they have not characterized which type of substantial contributor. He may be individual, he may be company, he may be HUF. It doesn't make any distinction. Even if the HUF only, they are the donors. They are not representing in other capacity. They are not the settler. If in the capacity of a donor, this modification even apply to the HUF.
So
But
in one sentence, all donor, whether it is HUF or not, will be covered under this new amendment. HUF, the relatives of HUF, also that benefit also is available to the HUF only if the HUF is in a dual capacity. It is apart from the donor is holding some other capacity, then the other compliances will apply.
Tarun, you can now take up.
Sir, you can continue the PPT. Yes, sir.
Okay.
Now we have discussed the amendments which were directly impacting the charity sector. There were mainly 3 amendments. One was relating to the extending the validity of registration period. Second was amendment in the specified violation, and third was substantial contributors. Now there are another amendments which are not directly related to charitable sector but have an indirect impact on it. One of such amendment is extension in the time limit to file the updated return of income. So as we see to the conditions of registration, so under section 12A, one of the condition is that to claim the exemption under section 11 and 12, the income tax return has to be filed within the time limit prescribed under 139(1) or 139(4). Meaning thereby you can claim the exemption under section 11 and 12 if you submit your income tax return by the due date to file original ITR or belated ITR. Now, 2 years back, they have introduced a special provisions under section 1310 and 1311, which gets attracted on specified violations, which states that if you don't file your ITR, then your income has to be computed as per the provisions of section 1310 and 1311. Now, in that cases, your ITR shall be subject to updated return category. So now, since the time limit to file updated ITR has been extended, so that shall be relevant for NGOs as well. So earlier, the time limit to file updated return was 24 months from the end of assessment year. Now it has been extended to 48 months from the end of assessment year. Now the additional tax has also been correspondingly increased. If you are filing within 1 year, the additional tax shall be 25%. If you're filing within 2 years, additional tax will be 50%. If you're filing within 3 years, additional tax shall be 60%. And if you're filing within 4 years, the additional tax shall be 70%. So in that sense, it is relevant for NGOs as well. The another amendment, which is in the favor of NGOs, that is increase in the threshold limit for TDS deduction, because the provisions of section 40A IA mutatis mutandis also applicable to charitable organizations, meaning thereby they have to deduct TDS if they are making payment to the resident assessees. Otherwise, 30% of the application shall get disallowed. So these are some of the common sections in which the threshold limit of TDS has been enhanced. These are common section, like in commission, now it is 20,000. In rent, it is 50,000 per month. And for the fee for professional services, it is 50,000. So again, that will breather for NGOs. So these are some of the amendments which are not directly impacting, but has an indirect impact on the NGO sector.
Just to add, Tarunji, on the rent, they have now made 50,000 per month for a part of a month. So
Yes.
Suppose you are taken on rent on February at a 1 lakh. So during the entire financial year, paying only 2 lakh. Earlier, you were exempt to deduct TDS because 2,40,000 was the limit. But now 50,000 per month, that means you have to comply with the TDS provisions.
So the limit is not annually 6 lakh, but it is per month 50,000 has
per
to be
month.
seen.
Yeah.
Sir, there are 2-3 questions which have come. Like one of the queries, if renewal of section 12A certificate, which was due in March 24, is not done, now what is the way out?
Suresh.
March 24. March 24, it can be only conversion of provisional registration to regular registration, because
Yes.
So provisional to regular registration, now contribution power has been given to the CIT exemption. They can apply for a contribution petition stating the reasons, and once the contribution is granted, they can apply. Or again, otherwise we have to see the reasons why it has not been.
all category of registration, if they have missed the timeline, now can avail condonation benefit. In the Act itself, the condonation provisions have been provided.
Yes. So Finance Act 24 has given the power of condone the delay to the Commissioner of Income Tax. So you can avail of that benefit and get your registration renewed. So another question is, if the income of the trust is less than 2,50,000, is he required to apply provisional registration or regular registration?
Is not required. So Suresh, you want to add?
Yeah, if they don't want to raise funds in future, because their income is less than 2.5 lakhs today, but it may go on increasing on subsequent years. So just by having 2.50 lakhs, they are covered under exemption limit. So technically, they are not required to be registered.
Sir, another common question which is going around after this limit of 5 crore, like classifying it as a small charities. Now, this limit has been used at 3 places. One is in the recently amended proviso, which says that they will be considered as small charities and their registration certificate shall be valid for 10 years. Second, it is used at like choosing the appropriate audit form, whether the audit report has to be filed in form 10B or 10BB. And similar quantum of 5 crore is also used under section 1023C. Where under the non-approval categories, the income of certain class of NGOs is exempt. Now, what is the relevance of this after this amendment?
No, this part has not been addressed. 1023C is with regard to the nature of the activity. A particular type of organization, educational and medical, are totally unregulated for that matter. Under 12AB, everybody is regulated irrespective. There is no limit available. So this limit is for registration requirement. There is no real. So it is a big area of discussion, but because we are running out of time, maybe we may not be in a position to address this at this point of time.
So I think
Tarun, only one clarification. One should not assume that where the audit report in 10B has been submitted, there becomes more than 5 crore. On the case where only 10BB is submitted, they becomes less than 5 crore. So 10BB is okay, the less than 5 crore, but 10B cases is also there because of the FCRA contribution. So even for the 10B cases also, they have to examine whether their limit is less than 5 crore or not, and they are eligible for 10-year registration.
So form is not the criteria, but the quantum of income is the criteria. So I think we can conclude now. I'll hand over the session to Divya if there are any queries, or we can.
Thank you so much to all three of you for this much anticipated and in-depth analysis. Thank you so much. Tarun, as of now, there's no queries as you have covered everything already.
Okay. Thank you.
Thank you so much.
Thank you.
Moving forward, we now begin with our fourth session, focusing changes on TDS, TCS, and crypto. We are excited to welcome Raghav Bajaj, Counsel at Khaitan & Co. to share his insights. As counsel in direct tax practice group at Khaitan & Co., Mr. Bajaj specializes in income tax, corporate taxation, cross-border tax, digital economic taxation, cryptocurrencies, transfer pricing, and dispute resolution. A chartered accountant with a strong academic background, he has advised clients in diverse industries and regularly contributes to professional publications and events. Recognized as a finalist in BW Legal World's 40 Under 40 and listed in World's Transfer Pricing Ranking, Mr. Bajaj is also an active member of Rotary International. Welcome, sir. Good afternoon.
Good afternoon. Can you hear me?
Yes, sir.
All right. Thank you for that introduction. And firstly, congratulations for having this kind of a platform and a marathon webinar series. Intrigued by attending the earlier sessions also, especially the not-for-profit charitable trust taxation section. Now, without any delay, let me go on to my session. Now, the budget has come. Of course, there are the whole increase in the slab rates for non-corporate taxpayers, the announcement about the new income tax bill. Those are the most talked about provisions of the income tax law for at least part of this budget. But if one looks at the ambit of TDS, TCS, and also very important amendment proposal in relation to the crypto assets, then it becomes a very interesting space to watch out for. So for this is what I am going to cover, the amendment proposal in relation to the virtual digital assets. Now that is the term which has been used for crypto assets or cryptocurrencies in the income tax law. Then with respect to the TDS, TCS provisions, what is going to happen? And also a small update in relation to the startup community. What is the amendment proposal that has been announced with respect to the startup ecosystem? Now, if we talk about virtual digital assets, before 2022, there was no specific regime which was provided in the income tax law when we talk about the gains arising to a person from virtual digital assets, cryptocurrencies, etc. And at that point of time, there were a lot of discussions, debates, because the prices, this is a very high fluctuating asset. So there were a lot of discussions as to what is going to be the nature, characterization of the income which a person earns from this asset class. After all those things, in 2022, we had a special regime for taxation of this asset class. Number one, it was defined specifically as virtual digital asset in the income tax law. There were 3 to 4 categories of that particular definition. It was a very widely worded definition. Number two, there was a 30% flat rate tax, 30% plus applicable surcharge and cess, which was imposed on a taxpayer if it earned income from transfer of virtual digital assets. There was a prescribed manner of computing the computing the gains also from that. There was a prescribed manner also for computing the gains arising from this particular asset class. For instance, only the cost of acquisition was to be allowed as a deduction. No set off, etc. was to be there. Then it was also introduced in section 56.210, which states that the receipt of a VDA for nil or inadequate consideration would be taxed as ordinary income in the hands of recipient, just like other classes of section 56.210 tax trigger. And most importantly, there was a 1% TDS, which was introduced in relation to the transaction value when a person would make payment to a resident seller on transfer of VDAs. Now, what has happened is that after that particular amendment, there has been a lot of development and movement when we talk about the crypto assets. Now, globally, there is a lot of talk and discussion as to the transparency and disclosure aspect of this asset class. And it is interesting to note that the OECD is also working towards this crypto asset reporting framework. Now, it is a global tax transparency framework wherein jurisdictions have come together for the development of a framework whereby they can have an automatic exchange of information when we talk about crypto assets. As I understand, it will be, I think 2027 might be the first year when this is when the information exchange starts happening. Because ultimately, all tax administrators want visibility with respect to whether the transactions are appropriately reported, disclosed, and offered to taxation in the relevant jurisdictions. Interestingly, India is also part of it. India is also actively in developing this, and it is eagerly making steps to ensure a political commitment to implement this CARF. Now, if we talk about what have been the amendments proposed. Number one, the definition of VDA, virtual digital asset, is proposed to be widened, and this is the extract of the proposed new VDA category. That any crypto asset being a digital representation of value that relies on a cryptographically secured distributed ledger or a similar technology to validate and secure transactions. This is a new category in the definition of VDA, which is in the VDA definition, which is proposed to be inserted. What is the outcome? There is a new section 285B, which has been introduced, which is proposed to be introduced. And what it does, it inserts a new reporting requirement for this new VDA category. What it will do, it will require reporting entities to report transactions, details, informations, etc. in relation to transactions pertaining to this new VDA category. The section also envisages that there will be detailed rules which will be introduced, which will be notified by the government in relation to this reporting requirement. For instance,
which all persons will be required to comply with this requirement, what will be the scope of the nature of information, and the manner in which such information will have to be maintained by reporting persons, and most importantly, the due diligence which such reporting persons will be required to carry out for the purpose of identifying who is the crypto asset user, who is the crypto asset owner. So there will be a lot of obligations, a lot of changes in business modalities which the reporting persons will have to comply with. As of now, this proposal has been there. There is a new category of VDA and there is a new reporting requirement in relation to this proposed new VDA category that has been proposed. Secondly, uh, we all know that there is a concept of block assessments in the context of income tax searches. There is, in that context, there is a term undisclosed income. So virtual digital asset has been included within the definition of undisclosed income also. If we see, this time there have been FAQs also which came along with the finance bill. And if we see, there is a FAQ number 23 which talks about the obligation, this reporting requirement. And if we see, I've reproduced on the screen the relevant question that, why is it being made obligatory to furnish information of crypto asset? So this is the response that they've given in the FAQ. So India is listed in as part of the 52 relevant jurisdictions. Also, if one goes back in history, the G20 leaders' declaration had also called for the swift implementation of the CARF. And to enable this particular framework, this particular implementation, this amendment has been proposed so that the prescribed reporting entities will be can furnish the details and information in relation to crypto assets. What timelines, what periods will be covered, what kinds of information, details, KYC details, etc. Those are the things which will come into, which will be notified in time to come. But a very important update which people should be aware of, because this is going to be a reporting requirement and automatic exchange of information is going to happen once this reporting framework or this reporting requirement comes into being. Just for context, since I said that this VDA taxation regime had come in 2022, and there were as such no rulings for any period prior to that. But recently, an ITAT ruling had come with respect to a pre-2022 period. And again, the question was, the main question as to what is going to be the nature and classification of income which a person earns from transfer of a cryptocurrency. Again, capital gains or income from other sources. The reason being, capital gains gets the long-term capital gains tax at least gets a concessional rate, whereas income from other sources gets taxed as per the ordinary rate. Now, this case pertained to a period prior to the VDA regime. Typically, typical contentions, the taxpayer said that it is a capital asset because it would qualify as property, and therefore the gains arising from its transfer should be treated as capital gains. Whereas the tax department's allegation was that, look, cryptocurrency lacks the inherent value or utility which is required to qualify as a property in the first place, and therefore it should be taxable as income from other sources. The Honorable ITAT has ruled in favor of the taxpayer, and they emphasize that the legislative acknowledgement of cryptocurrencies as assets through the 2022 amendment, in fact, reinforces their classification as property. This was an important one. Of course, there will be a lot of people who would have earned VDA gains prior to the 2022 period. So helpful ruling in at least that context. The second update or the second set of proposals that I'm going to talk about are the TDS TCS provisions. Now, there is a whole bunch of amendments every year that we see every year when we talk about TDS TCS provisions. One thing that we must be mindful of is that TDS and TCS provisions are there for 2 to 3 reasons. Number one, it aids in it, advance it advances the collection of tax which the government gets. Number two, and most importantly, it ensures that there is a tracking mechanism, because the moment a transaction is subject to a TDS or TCS, it falls within the net of a particular reporting mechanism. And therefore, many a times, what we will see is that the TDS TCS rates are kept very low. For example, 0.1%, just so that the transaction comes under the reporting net. Of course, there are other scenarios also wherein one will see TDS, TCS rates, I mean, a rate as high as 10%. And there, and of course, wherever there are those high rates, there will be a lot of hue and cry, like we saw in the case of 194R. Now, what has happened in this year? There have been quite a few changes, not just in the context of monetary thresholds, but also to make the ease of doing business very easy. For example, there are provisions in the income tax law which stipulate that every section has got their stipulated TDS TCS rate. Some will say 5%, some will say 1%, some will say 0.1%, whatever it is. And then there are overarching sections which state that if certain violations are there, if certain conditions are breached, then the TDS TCS rate will be applied at a higher rate. Now, what are those situations? Number one, if the PAN is not furnished by the deductee or the collectee. If the PAN is not furnished, then whatever is the rate which is prescribed in the section, we ignore that, and there is a specified formula to compute the applicable rate, which is a higher rate. The reason, so that people are disincentivized from not obtaining PAN or not furnishing PAN. The second category, where the deductee or collectee has not filed its ITR for the preceding financial year. Again, a higher rate will come into picture. And the reason being so that people are incentivized or motivated to file ITRs, because if that is not done, there will be a higher withholding tax rate which is applied. Now, see, these provisions have been inserted in the last few years. And when we talk about the second category of violation, which is the non-filing of ITR, practically, while it is good in concept, what was happening is that for the deductor or collector, it was becoming difficult to implement, because no one will know whether the other person with whom one is transacting, whether that person has filed his or her ITR. For example, if I have to receive a payment from Mr. A, Mr. A will not know whether I have filed my income tax return or not. And therefore, it becomes difficult for that person to comply with this provision. As a result, what happens? The payer will end up deducting tax at a higher rate, because TDS provisions, as we all know, come with penal consequences for non-compliance. As a result, what happens? A larger quantum, a larger portion or a proportion of capital gets blocked. The working capital cycle gets blocked. And at the same time, it also increases the compliance burden, because the payer is now required to ask the recipient as to whether you have filed the ITR also or not. So to ease this compliance burden, to ensure that there is no unnecessary working capital blockage, so that people can use that money in their business efforts, the Finance Bill 2025 has proposed to omit these two sections. That is 206AB, which talks about TDS, and 206CCA, which talks about TCS. And the provision, and once these two sections will be omitted, there will be the higher rate will not apply in case of non-filing of ITR. Mindful that the non-furnishing of PAN category, which leads to higher TDS, TCS, that section will continue. That section has not been tinkered with. So therefore, that particular non-compliance or the breach or penalty, whatever one can call it, that will continue to apply. But as of now, it's a good move that at least the non-filing of ITR by the recipient by the deductee or collectee will not lead to or trigger a higher TDS or TCS. The second important update in relation to TDS TCS is with respect to section 206C1H. Now here we'll have to be mindful of two sections in the TDS TCS regime. There is a TDS section 194Q, which states that when a person is purchasing goods from a person in excess of INR 50 lakhs, the payer is required to do a TDS at the rate of 0.1%. There is a condition that this will apply if the buyer's business turnover exceeds 10 crore rupees in the preceding FI. As you can see, the rate is very small, very less, but it was done so that the tracking mechanism gets triggered. Along with this, there is a TCS section 206C1H, which stipulates a 0.1% TCS requirement. Again, the thresholds are same. Consideration exceeding 50 lakhs, applicable if the seller's business turnover exceeds 10 crore rupees in the preceding financial year. So on same transaction, there were both the things which were applicable. Of course, there is a carve out for TCS provision, because the TCS section states that if the buyer is liable to deduct TDS, And if the buyer has actually deducted TDS, then the TCS provision will not apply. So there was a clarity in the law that on any given transaction, both TDS and TCS will not apply. But what was happening is that it is getting difficult for the seller to know whether the buyer has actually deducted TDS or not. Because see, ultimately, again, even though the rate is less, but this was ending up in creating unnecessary compliance issue and administrative hassle for the transacting parties. Because both the parties were asking, okay, whether you have done or I will have to do. If you have not done, then I will do. If you have done, then I will not do. So this led to a difficulty in implementing or doing business. So the government has proposed to omit this particular subsection also, and therefore this TCS provision on sale of goods will not apply. As a result, what is going to happen is that if there is a purchase of goods, only the TDS section will be there. The TCS provision applicability will not be there. Interestingly, many a times this provision comes in, and there are a lot of things on which TDS, at least the TDS part, becomes in negotiation. Of course, what happens is that the rate is so small, and the amount is so less that many a times people actually end up uh, doing TDS or TCS just because the amounts are very less. For example, shares, people ask whether it is applicable on slump sale, but at least this one part of it will not apply, that at least in the case of a sale of goods, the TCS provision will not apply. This is a very important one and a good one, good amendment from the perspective, amendment proposed with respect to the ease of doing business. The third important amendment in relation to TDS TCS provisions has been that there has been a relaxation which has been provided with respect to prosecution for delayed TCS payment. Now, here we have to be very careful in understanding this particular provision because uh, prosecution for TDS defaults or TCS defaults have been on the rise, at least in the past few years. And many times what happens is that for companies, corporate taxpayers, the directors at least come at as a as a low hanging risk elements. What the law states is that if there is a delayed payment of TDS or TCS to the government, there is a potential prosecution which can be launched. And it can range from 3 months to 7 years, along with a fine. In the current law, there is no relaxation for minor delays. For example, if I have delayed by 1 day, 2 day, technically that particular provision gets applicable. What will happen if there is a person who has delayed, who has made a delay of, let's say, 20 days, realizes in the next installment that, okay, last month's TDS, TCS was not paid. And by the time the TDS or TCS return comes, they have made the payment because, as we all know, the TDS, TCS returns are quarterly, they have a quarterly time limit. What is going to happen if a person has complied with or regularized this particular default? So there was no particular relaxation for small minor delays in relation to TDS or TCS payments. Now, this last year, a relaxation was brought about when we talk about delayed TDS led prosecutions, which was to say that if the person has actually paid the amount to the government within the timeline prescribed for filing the quarterly TDS return, then the delayed TDS payment will not apply. The delayed TDS payment will not lead to a prosecution. Mind you, I'm saying delayed TDS because I mean that it has been paid. But if it is paid after the quarterly TDS return, this relaxation was not applicable. Now, similar thing has been introduced, or similar relaxation has been made applicable for TCS also. What this will mean is that if there is a delayed TCS payment, the prosecution will not apply, provided the TCS gets paid within the timeline for filing the quarterly statement. For example, if there is a monthly TCS which has to be deposited by, let's say, the 7th day of the next month, if the person deposits it within the 7 days, no problem. If a person deposits it on 15th day of the next month, as per the current law, there was no relaxation. But under the proposal, this particular person will be saved from any potential prosecution because this person has paid it before the timeline for filing the quarterly TCS statement. Now imagine a situation where a person has not paid it within the stipulated timeline of 7 days, not paid within the stipulated timeline of for filing the prescribed quarterly TCS statement, but after that period. So for that particular violation, even though it might qualify as a delayed TCS payment, but in those situations, this particular relaxation from potential prosecution will not be available. Now, this is important because many a times in big corporates and big organizations also, or maybe in smaller ones also, minor TDS TCS payments sometimes can get delayed. Of course, nowadays these all system-driven processes, delayed payments of TDS or TCS are generally not happening because there is enough administrative backing or systems in place to ensure that these things get automatically flagged. But one will have to be mindful that, and there are consequences in the tax auditor report also. So there are enough checks and balances. But one will have to accept that these kinds of delays are possible. Smaller delays, smaller delays, smaller amounts, etc., can also lead to TDS TCS prosecutions getting launched. And therefore, it is very important for taxpayers and for taxpayers to know, and for advisors and consultants to make the clients aware that whatever happens, at least there should not be any delayed payment of tax, be it normal advance tax, corporate tax, TDS, or TCS, because all of those delays come with a preset of potential consequences, penalties, prosecution. There are these kind of relaxations which are there, but one will have to be mindful of the ultimate outcome. Because one more important thing that we should be mindful of is that in case of corporates, when there is a change in directorship, sometimes if at all there is a launch of prosecution, the department launches it with whatever data is available with them, and then a person has to go through the hassle of saying that, look, I am not the director, I am not the person in charge, I was not there, etc., etc. So while all those things are done, but in the first place, if we are able to ensure that there is no delayed TDS or TCS payment to the government within the prescribed timeline, in the prescribed mode and manner, etc., one will be saved from a lot of those administrative difficulties. The next one with respect to TCS amendment proposals is an important one. It talks about when this was introduced a few years back, there was a lot of discussion as to how will it, apply, whether this is in fact a tax whether it is in fact a correct tax to apply in the first place. But be that as it may, it stands on the statute book. And now I'm talking about the TCS, which is applicable on payments under the RBI's liberalized remittance scheme, with LRS as it is popularly called, or the TCS on payments in relation to overseas tour program package. Now, this comes under 206C1G, and two kinds of persons are obligated with this requirement to collect tax. One is an AD bank when it receives an amount for remittance under LRS. And second, the seller of an overseas tour program package. Tour program package, which has been also defined in the law like a combined tour program package. There is a monetary threshold of 7 lakh rupees, which is prescribed in case of LRS. There is no monetary threshold as such, which is prescribed in case of overseas tour program package for the purpose of applicability of this section. TCS ranges widely from under this section from 0.5% to 20%, and we'll go through under which situation it is 0.5%, in which situation it is 20%. Now, what the proposed amendment there is, which has been done by Finance Bill 2025, what is it doing? It is, number one, increasing this threshold of 7 lakh rupees to 10 lakh rupees, and how that is going to impact or affect is something which we'll see in the next slide. And a very important one is that they have now proposed to remove this TCS requirement on remittances for education purposes. But this removal will apply for remittances which are made out of a loan taken from specified financial institutions. There is a section 80E. So this particular exclusion will be linked to section 80E. So two amendments are proposed. Number one, the threshold of 7 lakhs is proposed to be increased to 10 lakh rupees. And number two, TCS on remittances for educational purposes is proposed to be removed, provided that certain specified conditions are satisfied, which is that the remittance is out of a loan taken from a specified financial institution. Very important, these two amendments. Now, if we see how is it going to affect, or what is it going to pan out? See, if we break it down, let's first talk about an overseas tour package. The current provisions, as I said, there is a threshold of 7 lakhs. Now that 7 lakhs is not a threshold for applicability. That 7 lakhs in case of overseas tour package is in relation to the TCS rate. If it is up to 7 lakh rupees, it is 5%. But the moment it crosses 7 lakh rupees, it becomes 20%. Now that is a very big limit. I've seen many times, people come and ask us, okay, is this, I am booking a tour program, my cost is, let's say 9 lakh rupees. It is asking me 20% more. Is it there a law or what? So we have told that, yes, there is this particular provision is applicable. Of course, one will get a credit of it when they file their tax returns. But 20%, of course, is a sizable amount. It can lead to working capital blockage, etc. also, but it is currently applicable. What is being done? This threshold of 7 lakhs is going to be increased to 10 lakh rupees. What will it mean? If a person is buying an overseas tour program package for 9 lakh rupees, 9,50,000 rupees, they will still get the benefit of the lower rate of 5%. The moment now the 20% higher rate will kick in when the tour program package cost is above 10 lakh rupees. So that 3 lakh delta, which was earlier getting taxed at 20%, let's say 3 lakhs into 20% would be 60,000. That 3 lakh rupees, the difference between 10 lakhs and 7 lakhs, will now be taxed at 5% only, which is like 15,000. So to that extent, like in a extreme situation, a 45,000 rupees delta will be saved and ultimately help in a working capital situation. If we talk about LRS, under the current provisions, as I said, up to 7 lakh rupees, there is no TCS, regardless of whatever is the purpose. The moment it exceeds 7 lakh rupees, the rate could be either 0.5%, 5%, or 20%. The 0.5% rate was there if the remittance was done out of a loan obtained from financial institution for education purpose. So a 0.5% TCS if the condition was satisfied. If it was for medical treatment or other education purposes, then the rate was 5%. And for any other purpose, the residual purpose, the limit was 20%. Again, a very high limit, but be that as it may, the rate stands in the statute book. As per the proposed amendment, what is going to happen? Number one, this 7 lakh threshold is going to increase to 10 lakh rupees. Now, as I said, this 10 lakhs in case of LRS is an application threshold, is an applicability monetary threshold, unlike overseas tour program package where 7 lakhs was not the applicability threshold. There it was only with respect to the lower rate and higher rate, but when we talk about LRS, it is in relation to applicability. So under 10 lakhs, whatever purpose, no TCS. But above 10 lakhs, remittance out of loan obtained from financial institution for education purpose, the rate will be nil. So if you see, from 0.5%, it has been removed with respect to specified education related remittances. This is a very important one because ultimately India being a young country, people have educational aspirations, etc. So to promote that, this TCS requirement has been done away with. For medical treatment or other education purposes, the rate remains same. The rate remains same at 5%. Of course, subject to this threshold of 10 lakh rupees. And for any other purpose, for residual purposes, the rate continues at 20%. Again, the threshold changes from 7 lakhs to 10 lakh rupees. So in TCS on LRS or OTP package, number one, the threshold of 7 lakhs has been increased to 10 lakhs. As a result of which, people are going to save some money. The advancement of tax payment is going to reduce. And second, in case of LRS, the specified education related remittances have been exempted from TCS applicability. Earlier it was 0.5%, now it is nil. So in the OTP, 3 lakh delta, they're going to say 15%. And in relation to LRS, the delta will differentiate because depending on the nature of remittance. But at the same time, if it relates to specified education related remittances, then the delta will be from 0.5% to nil. So that is going to be a saving for people who are making those LRS payments or purchasing overseas tool program package. Then the TDS rates and the TDS thresholds have been reduced. As I said earlier, there are monetary thresholds which are provided under the law in different sections. For example, 193, which talks about interest on securities, 194, which talks about dividend, 194A, which talks about in the other kinds of interest, 194B, which talks about winnings from lottery, crossword puzzle, horse race winnings, etc. So on the table, these are not very significant or sizable thresholds or rates, but for completeness, I have put them on the screen for as current threshold or proposed threshold. For example, in case of dividend, it is proposed to be increased from 5,000 to 10,000. In 194A is something which I'll talk about. See, currently it is 50,000. The limit is 50,000 for senior citizens and 40,000 for non-senior citizens. Generally, the typical ones which fall within this category would be FD interest, because that is something we just talked about most. Now, this is a very big amendment because the rates for senior citizens have been doubled. So senior citizen will not get TDS hit if the interest is 1 lakh rupees. For non-senior citizens, the rate has been increased by just 25%. So 50,000 will apply to them. At least for senior citizens, this is a big one. And if people are interested in this space, post the budget, there has been an article also that this might lead to increase in term deposits in banks by a substantial amount, because ultimately for a senior citizen, TDS can be TDS can be a bottleneck in terms of what money comes in their bank accounts. But with this increase in limit, there can be an additional inflow of term deposits for banks. Now, one has to read this and understand this in light of Section 80 TTB also, because see, this limit has been increased for TDS applicability. But when we talk about the final taxation or the exemption, that comes under Section 80 TTB. So there, the limit has not been changed. So what will happen is monthly, quarterly, annually, the senior citizens or the people will get they may get a higher portion of interest. But eventually, while filing the tax return or while doing their advanced tax, etc., they will have to be mindful that the deduction limit under that section, which is available for senior citizens, has not been changed. Then with respect to commission, brokerage, fees for professional services, there the limit has been proposed to be increased from 30,000 to 50,000. In case of rent, again, an interesting way. Right now, the TDS is not applicable under 194I if the aggregate payments in a financial year do not exceed 2,40,000. Generally, people understand, okay, 20,000 per month, but it is not per month, it is annual. So even if one makes a one-time payment of 2 lakh rupees, it is not subject to TDS because the limit is not one time or per month or quarterly, it is annual aggregate limit. This limit is proposed to be increased. Now I'll say increase also, or maybe someone can say decrease also, because now the proposed threshold is 50,000 per month. So if one annualizes it, it becomes 6 lakh rupees. But if one looks at it at a monthly basis, if one is making a payment of, let's say, 75,000, and if that is the only payment, then in the current threshold, the TDS trigger does not apply. But under the proposed method, the TDS trigger will apply because now the limit is 50,000 per month or part of month. So these are, at least with respect, of course, good that the thresholds are increasing or getting rationalized year on year, day by day, because of, again, multiple reasons, the economy value, the size, the value of money, etc. But in terms of TDS, TCS rates, at least for this year, I think interest one and this rent one is something which is important, which people should be mindful of. And last, the startup related amendment, there is, as we all know, that there is a profit link deduction which is available to eligible startups for 3 consecutive years. So out of their first 10 years, they can choose which 3 years they want to opt for this profit link deduction. Again, this has been introduced in law to ensure that startup community ecosystem is motivated, incentivized, or developed so that ultimately there is wealth creation, job creation, economic development. Uh, Eligible business there is a concept of eligible business also. Not all startups are can get this benefit. Only a startup which is doing eligible business. As you can see on the screen, I've written eligible business is defined to mean a business which is carried out by an eligible startup which is engaged in innovation, development, or improvement of products or processes or services, or a scalable business model with a high potential of employment generation or wealth creation. Now, this definition can also be subjective sometimes. In the past, we have seen clients come and ask, okay, will our business model fit into this particular category of eligible business? So there also is scope for analyzing the definition, analyzing this particular definition legally, whether a particular business model qualifies as an eligible business. And once it is there, then the startup can get the profit link deduction provided the conditions are satisfied. Number one, eligible startup is a company or LLP which fulfills these conditions. Its turnover does not exceed 100 crore rupees. Most importantly, it holds a certificate of eligible business from the Interministerial Board of Certification. And the date of incorporation, basically the period within which that particular startup is incorporated, should fall within 1st April 2016, but before 1st April 2025. So that is the incorporation cutoff date which is there in the law. And if anyone who is following up this particular section or space, they will know that this cutoff date is being annually extended because the government is seeing the kind of benefits or the kind of talent or data pool which is getting developed in this space. So this cutoff date was being extended every year, let's say by one year. But this time in a major boost, what has happened is that the proposal is to increase this incorporation cutoff date by 5 years at one go. Not 1 year, 2 year, 3 years. Now this time this extension is proposed by 5 years. So now the cutoff date will become 1st April 2030. What this will mean is that if a startup gets incorporated up to 31st March 2030, next year, the year after that, etc., it will still be eligible for the benefit of this particular profit linked tax deduction. Of course, subject to the other conditions to be fulfilled, etc. If Even if it gets incorporated up to 31st March 2030. So this is a big welcome move. And as I said earlier, this, the personal income tax slabs, the proposed amendment to increase this cutoff date, the rate rationalizations in terms of TDS. These are some provisions which I think this time the government has taken a multi-leap forward, and the amendment proposals are not just one year, two year, but taking into account or considering the needs, aspirations, etc., for the next 4 or 5 years of our economy and country. So this was a brief summary in relation to the TDS, TCS, and the virtual digital asset related proposals of this year's budget.
Thank you, sir. Thank you so much for this insightful session. I think the audience must have benefited from it. There are a couple of questions. Should I take it?
Sure.
Just 1 second. The first one is whether crypto derivatives such as crypto ETF would fall within the definition of virtual digital assets.
So crypto, I think this question is going on lately post this amendment, crypto futures, crypto derivatives. It will have to be seen in detail. Let me not give an answer here as of now, but it will have to be seen in detail. The definition is very wide. But the crypto asset reporting framework is also something which we should be taking a look at, because there the definition and the meaning of excluded assets or the included, like they have a concept of closed loop crypto assets also. So it will have to be seen. It is not clear as of now.
Okay, correct. The second is one user has asked whether Section 194F would be applicable on waiver of loan which is obtained for purchase of capital asset.
Before?
For purchase of capital asset.
No, can you repeat 190 which section?
194R.
So there was a circular also which was there. So I think they should definitely refer to that particular circular. It was dealt with in that. And as I said, 194R has created a lot of trouble. I mean, trouble in the sense people are now required to ask a lot of details with respect to that TDS trigger.
Thank you, sir. Thank you so much. That's all from our side.
Thank you. Thank you. All the best.
Thank you, sir. So we now proceed to our next session on the changes in transfer pricing and international taxation. We are pleased to welcome Aseem Chawla to guide us through this critical topic. Mr. Chawla is a senior advocate, fellow chartered accountant, and member of the Bar Council of India. With over 2 decades of experience, his specializes in estate planning, international tax, corporate advisory, and dispute resolution. He serves as a senior standing counsel for Income Tax Department in Delhi and holds leadership position in various legal and industry bodies. Widely recognized in the Asia Pacific region, Asim continues to be ranked among the top legal professional for his expertise. Welcome, sir.
Thank you, Divya, for that very kind introduction. In fact, we've all been students and will remain students all along. And in this journey of learning, I think Taxman has played an important and continues to play an integral role in making sure that all of us are up speed in terms of our knowledge curve and remain relevant. And Grateful to yourselves, the entire editorial team, Naveen, Rahul, yourselves, and Cynthia for helping us in being able to share our views on your very illustrious platform. And your collective erudition speaks the love for law which all of you have.
Thank you so much, sir.
I think you have the slides for the viewers available, and I'll request yourselves and your IT team to navigate the slides if those are going to be disseminated to the audience now or later. I would
Okay.
leave that to your collective wisdom. I think very broadly, the most talked about change insofar as, or the proposal, if I may use that word, has been with regard to introduction of a block period for the purposes of transfer pricing assessment, and some streamlining or ironing out creases insofar as the definition of capital asset is concerned, and aligning the definition of or the inclusions on in with regard to uh, the exclusions with regard to, my apologies, not inclusion, but exclusions with regard to the scope and ambit of significant economic presence when compared with the Indian recognized concept of place of business, which is the business connection. And then, of course, to give a fillip to everything surrounding the electronic component manufacturing space, which is pretty much the talk of the town, so to speak, with raising capabilities in and around artificial intelligence, in development in the field of high tech. I think what India has done is given a position with regard to providing a certainty in terms of incorporating a provision of incorporating a provision in its domestic tax law with regard to providing a presumptive rate of taxation to the ecosystem. I think that's something which has been widely hailed all around, and I think it was a big ask, and the relevant nodal ministry also did recognize the uncertainties which the tax provisions sometimes do bring in when it comes to its implementation. The last piece which we are going to cover is the rationalization of taxation of capital gains on transfer of capital asset by non-residents in terms of aligning the rates so that there is no arbitrage in terms of rates. So if we could move to the next slide, please. Yeah, just the next slide, please. Yeah, so these are the broad 6 topics which we thought were relevant for today's discourse. And of course, in the coming weeks, if there is any particular area which we need to delve it in terms of a better deep dive, I think that we could do. But as part of the ongoing day-long marathon, I think suffice to suggest that if we could very quickly in the given allotted time can wrap up this. So let's look at the first big proposal, which is with regard to harmonization of SEP concept with reference to business connection. Yeah. Yeah, let's move to the next slide, please. So Section 9 introduced the concept of significant economic presence a few years ago in line with the tenets or the commandment which we did get in terms of the base erosion and profit shifting proposal as a good advisory. And to preserve the source base, we did introduce the concept of significant economic presence, which widens the ambit of a source-based taxation or the ability to tax something on a source base. Suffice to suggest that the treaties so far have not been amended. So, therefore, if something does fall within the ambit of significant economic presence for the purposes of domestic tax law, or let's say a foreign entity's activities in India do constitute a significant economic presence, but that foreign entity is entitled to claim the benefits of the tax treaty. Considering that SEP as a concept has not been introduced in the treaty, that particular entity may take treaty refuge and, excuse me, that particular entity may take the treaty refuge and would continue to be taxed in accordance with the provisions of treaty, read with wherever there is an impact of MLI, so to speak. So put it in simplistic terms. Now, all along, our Income Tax Act has recognized the concept of business connection as a virtual projection of a foreign entity's affairs in India, whether it constitutes a business connection or not. No, no, don't change the slide. Just explaining the. Go back, please. Go back. I'll let you know when I need to flip the slides. So if a foreign entity has some taxable presence in India, under the scheme of the Act, that taxable presence is given the coinage of business connection. Now, business connection over a period of time has been interpreted right from the days of R.D. Agarwal, the seminal judgment, and it is wider in scope as compared to permanent establishment. So business connection is expansive in scope. Permanent establishment is it's a concept which is not as wide as business connection. So if you have a business connection, but you are entitled to tax treaty benefits and you do not constitute a PE, then by virtue of treaty, you can safely ride home. Similarly, you have a significant economic presence under the scheme of the Act, but you do not have a permanent establishment, then still you can ride home well. The incongruity which was being felt was that, well, there is a concept of SCP which has been introduced. There is a concept of business connection, but in so far as the activities are concerned with regard to purposes of export, whether mere purchase of goods in India for the purpose of SCP would tick the box, whereas for the purpose of business connection, there is a specific exclusion which has been provided. I think that was just to align the fact that merely purchase of goods would not constitute an ACP because it does not constitute business connection. So that was just to bring parity to both the concept. Suffice to suggest that in situations where a treaty benefit is not available or you're uh, indulging in a transaction from a country which is not which does not have treaty benefits, or for some reasons you are not entitled to treaty benefits, then the exposure of SCP would loom large. And therefore, in the present world of uh, tax treaty entitlements and principal purpose test, whether the intent and purpose of the benefits being claimed under the tax treaty, etc., are being uh, are likely to be challenged by revenue, or if they are challenged, then in a worst case scenario, the activities should be such that if they are in a nature which are vulnerable to a constitution of significant economic presence that must be seen. And therefore, uh, if the foreign company is transacting from a treaty country, then make sure that the basic checklist in terms of claim of benefits of tax treaty and the entitlements are met good, so that the shield of tax treaty in terms of affording concessional tax treatment holds good. So that's the limited purpose. And this little longish background was for those of the viewers who wanted to just get updated with the latest prescription. Of course, suffice to suggest that the recent executive orders pronounced by the Trump administration would, if not derail, at least sidetrack the progress which the world was making in terms of Pillar One and Pillar Two. So the momentum may receive a hiatus for a little while. There may be a pause button, and in fact, India's Honorable Finance and Revenue Secretary also has gone on record that in view of the US decision to sort of revisit the global minimum tax, even India would act in a circumspect manner. That is why in this budget, as well as in the last budget, we did not have any legislative changes with regard to enabling provisions on Pillar 1 and Pillar 2 global minimum tax and taxation, which inures some source base to market jurisdictions in terms of the Pillar 1. Whether the new income tax bill forthcoming will take those into consideration as an enabling measure, I would be a little tentative or less certain about it, because the globe itself, when I say the word globe, not global minimum tax, the world at large is facing some sort of an uncertainty with regard to the disposition of United States in buying in this. Remember, it's one of the largest technology exporting countries of the world, and they also need to preserve their tax base, especially when it comes to the Pillar 1 as well as the global minimum tax, which will be applicable to big companies exceeding revenues over 750 million euros or so. Yeah. Next slide, please. Yeah, this is the game changer or the highlight of the tax proposals dealing with international tax, insofar as the tax proposals announced by the finance minister on 1st of February 2025. So Finance Act 25 will be remembered for this very enabling provision. If we go a slide back, we have a concept now where a taxpayer can exercise an option of electing that insofar as transfer pricing is concerned, it may seek an option. And if we go a slide back, that the international transactions for that given block would be considered at one go, so that you don't have to reinvent the wheel. So if we go a slide back for a moment, please. Yeah. So at one go, you could have a situation where the determination of arm's length price shall be applicable for a period of 3 years. And given the guidelines which are expected within a period of less than 3 months before the audit process really gets kicked in, there would be a certain set of guidelines or certain prescription which would be unveiled by CBDT basis introduction of some rules or instructions. And if the taxpayer does comply or wishes and believes that the prerequisites of those guidance or instructions are met, and basis that decides to elect the option that at one go let the transfer pricing be determined for a given period of 3 years, then he shall submit having elected or chosen that option in a prescribed format, and the filing shall be done in accordance with those rules. As I said, the guidance and the amendments in rules are expected within a period of 3 months. The CBDT has gone on record to make that statement day before yesterday, if you would have seen the press. So once you elect the option, then the transfer pricing determination is done, and that's applicable for a given block of 3 years. And therefore, instead of reinventing the wheel every year for the same set of facts, the same comparables, etc., I think this economizes both the effort of the revenue as well as of the taxpayer. Suffice to say that in that period of block year, you are looking at international transactions which remain consistent. Your MAMs, the most appropriate methods, your comparability analysis, your selection of filters largely hover around the same baseline of a common, consistent international transaction, and you don't expect too much of corporate restructuring or change in the manner in which you are doing international trade in terms of your transactions with associated enterprise. So if the baseline remains the same, and especially helps those industries where they are on a set sort of a template of doing business, which does not get revisited every year. If the business is passing through a very dynamic phase and you're not sure about the next year in terms of your outlook of your international transactions, then I don't think this would help awaiting the fine print in terms of the amendment in rules and instructions. I think this is more for those businesses which are pretty much in that autopilot mode and are gliding along nicely. Yeah, we can move to the next slide. So this is not applicable for those where search has taken place. The enabling provision in terms of subsection 21 to section 155 has already been introduced. Reference will not be made again for transaction for which option is exercised. So the department is stopped. They will not make a reference under 92CA. And the TPO, the transfer pricing officer, by an order within 1 month from the end of the month in which the option is exercised, declare whether the option is valid, again subject to certain uh, preconditions, etc., which I think would be apprised either in time, or the guidance and the instruction would be such that it's pretty much fathomable to understand that what would be those likely preconditions, so that a taxpayer is not caught by surprise in terms of what comes forward and he finds himself in a in a cornered situation where, though he wanted to exercise the option, but the preconditions are such that he's been caught by a surprise, and therefore the CFO and the tax head and the management of the larger company, including its international affiliates and associated enterprise, do stumble upon some sort of unpleasant surprise. Yeah, next slide, please. Yeah. Now, this is again a very sort of helpful or a welcome amendment insofar as making the amendment in the amendments made in capital definition of capital asset have now been uh, extended insofar as the alternate investment funds are concerned. If you remember a few years ago, in case of FII, the whole uncertainty with regard to taxation of FII, and we had the whole stock market getting wobbly, and then to set it right, the amendment was made within the Income Tax Act that for the purposes of foreign institutional investors, it would form part of the capital asset, so to speak. And capital asset is a defined term under Section 214 of the Act. And to now provide the same enabling characterization for investment funds which are AIF Category 1 or Category 2, or the funds which are governed under the Gift City International Financial Center, so to speak. The same prescription would follow. So the uncertainty with regard to characterization of income for the purpose of 115 UB, which is applicable to AIFs Cat 1, Cat 2, and IFCA is concerned, they would be regarded as capital asset, and therefore any income arising would partake the character of capital gain. So as a result thereof, what happens? Uh, by virtue of this, the transfer of securities shall be taxed as capital gains, and therefore the income shall be treated as a pass-through and will be taxed in the hands of the unit holder and not in the hands of investment funds. This was a long pending ask, uh, which on which the positions were being taken by tax experts, but now there is a legislative certainty prescribed in the act itself. So I think that's a very welcome legislative change which has been proposed, considering the ask of the industry. And BFSI is pretty much driving the economy. The more investments are being made in formalized sector with the SEBI regulated AIFs, I think the more monies are going to get channelized into formalization of economy. Yeah, next slide, please. Next slide, please. Again, this particular amendment in terms of IFCA related amendment is concerned. So, with a view to facilitate the operations in the IFSC, International Financial Services Center, there is an amendment which is proposed in clause 4 capital E of section 10, which provides now that income of non-resident on account of transfer of non-derivative deliverable forward contracts or offshore derivative instruments or OTC entered into by IFC shall not be included in total income. So this is again to provide certainty to the prescription of transactions which the non-resident was undertaking with the IFC is concerned. So I think again this makes the whole proposition of doing business in the offshore financial center in Gift City far more attractive and provides such uncertainty. But remember, this exemption is available to non-resident and not to the FPI. So this is an important aspect which one needs to uh, consider in mind, that these benefits are not extended to transactions entered into with a foreign portfolio investor. These exemptions are available to the end investor who is the non-resident. Remember, these schemes are available for non-residents as such, and it is the non-residents who are eligible to participate in such schemes and in such dispensation, and not a resident. Suffice to suggest that IFC, for all legal purposes, is an offshore territory, although geographically located in Gandhinagar in Gujarat, but for legal and tax purposes and for exchange control purposes, it is regarded as a territory outside India. So therefore, these schemes and these dispensations which are available, they are available to non-residents who are non-resident for exchange control FEMA purposes and non-residents for tax purposes. So therefore, when you think of IFC or Gift City, keep in mind that this is catering to the offshore business, and therefore offshore business means business being done offshore, and therefore per se, on first principles, these are not enabling Indian businesses, so to say, insofar as this particular line of business is concerned. Of course, Indian businesses can set up their nominated entities within the gift city to carry on offshore businesses. That's a different aspect of discussion altogether. But when we are looking at things like entering into forward contracts or offshore derivative instruments or OTCs, etc., uh, which are with an offshore banking unit of an IFC. So IFC may have a Deutsche Bank or a State Bank of India, and I am a non-resident residing outside India. Instead of transacting with Deutsche Bank Germany, I'm transacting with Deutsche Bank in Gandhinagar, and therefore just because it is in Gandhinagar doesn't mean that it will be subject to tax. The taxation treatment will depend upon the prescription provided. And here, in terms of clause 4E, such particular kind of exemption is being made available to the non-resident and not to the foreign portfolio investor. Yeah, next slide, please. Yeah, this is again one of the big highlights of the budget. I think the industry, MeitY, Ministry for Information Technology, could realize that foreign companies are a little tentative in terms of setting up greenfield projects in India with regard to electronic manufacturing, enabling space, be it chips or supercomputer. Today only you saw in the newspaper the big proposals being announced with regard to investments in AI in India. You had the OpenAI, the CEO in India meeting the Honorable Minister Vaishnav, who's leading from the front insofar as India's development and pacing forward in AI as part of the initiative under information technology. So what the certainty has been provided is that okay, we can give you a presumptive regime, which we all understand is available for historically oil and gas and other notified industries, that if you have issues with regard to permanent establishment, constitution of service PE, technical personnel coming out going out of India, coming into India, constitution of PE, and the biggest challenge is the attribution that okay, I may have a PE in India, but how much you're going to attribute income has always been a vexed issue with the revenue. So to sort of give a comfort, a new provision in terms of Section 44 double BD has been introduced, which deems 25% of the amount received or which is payable to a non-resident as business profits of such non-resident. So it is deeming provision with regard to 25% of the aggregate amount. It doesn't say 25% of the tax. Now you apply the tax rate on 25%. The government on record has gone to state that it will be a very attractive regime in terms of the net tax payout. Uh, yeah, so this would facilitate all the big IT and AI players who are keen and have expressed interest in terms of making huge capital investment in such fields. Yeah, next slide, please. Now, coming towards the almost the fag end of the broad highlights which which the budget dealt with insofar as dealing with headline uh, amendments on international taxation is with regard to the amendments in provisions of Section 115 AD, which now has been amended uh, to provide that long-term capital gains for all securities except those are referred to in 115 AB shall be taxed at the rate of 12.5%. The benefit of 1.25 lakhs, the basic slab, and we move to the next slide, please. The benefit, go back. The benefit of 1.25 lakhs is only provided for capital gains from transfer of long-term capital asset referred to in 112A, where payment of STT is involved. And the rate of tax for income for the period 23rd of July 2024 to 31st of March 2025 of the given long-term capital asset not falling under 112A, where STT is paid, shall remain at 10%. So this is just to give parity in terms of the taxation rate between resident and non-resident. So this was the basic intent of making amendments in terms of Section 115 capital AD of the Act is concerned. Yeah. So with this, we are at least done with our slides. I'm more than happy to take questions or any point which the viewer uh, or the delegate wishes to deliberate a little more in terms of developments in international taxation, especially what is in store in the coming week in terms of new bill. But suffice to suggest, the broad highlights of this particular budget is the introduction of the block period for transfer pricing, the provisions of presumptive taxation dealing with electronic manufacturing facility, further incentivizing the IFC framework, the gift city framework for the ecosystem in terms of financial and tax concession. And remember, the rest of the world wants certainty in tax laws, and therefore they want provisions to be built in the tax law rather than uh, getting it relegated to the subjective determination of the assessing officer, which may vary from a particular officer to a particular officer, even in the faceless regime. So, all the amendments which you now find with regard to tax incentives being made available to non-residents or foreign investors, you will find some in most of the cases the amendments are being sought to be made or are seen to be made in the Income Tax Act in so far as if I can give you some reference also, the sovereign wealth funds which came from Middle East also made it a point perhaps to see that the amendments with regard to tax benefits are spelled out in the tax act itself by naming those funds so that there is no tomorrow there is no doubt or it is subjected to whims and fancies of a given particular officer or a given particular situation. So that's the kind of certainty which the world expects in the taxation framework. And to that extent, I think the yearly amendments which we see in the regulations, the tax regulations pertaining to operations of gift city is again to confirm to the rest of the world that, well, the enabling provision is in the act itself. You don't have to take recourse of treaties also. And if it is exempt under the act, the question of going to the treaty does not arise at all. And that's a settled jurisprudence. Uh, Similarly, the discussions which we had in terms of the amendments made with regard to change in the definition of capital asset, which impacts positively the taxation regime available for alternate investment fund CAT 1, CAT 2, and the IFSC denominated fund is a very welcome change. Now the particular taxation will be in the hands of not in the hands of the will be passed through and therefore will be taxed in the hands of the investor. And remember, each investor's taxation would be different from others. And if it is taxed not at the if it is taxed at the fund level, then the ability of the investor to plan his or her affairs may get a little more rigid, and he or she may not enjoy that flexibility because every investor's taxation varies from the other person. And once it is going to be taxed at the investor level, then he or she knows that what is the tax treatment or the tax outflow of this particular investment, and he or she can plan his or her overall tax outflow for that particular fiscal year. If it is going to be taxed at a fund level, then regardless of my individual situation, I will have to follow that taxation and either claim more refund or pay more taxes. So it may not give me a very bespoke solution, so to speak. So I think to that extent it is a very welcome move. The first amendment, proposed amendment with regard to tinkering with the exclusions under SCP is more or less to bring it aligned with business connection. But then you have the larger safeguard of tax treaty available before the exposure of significant economic presence does keep in place. I think the rules with regard to facilitating the block transfer pricing audit for that given period will make a lot of difference to figure out how tax friendly it is going to be. So these are all in all changes. If there are any questions, more than happy to take.
Thank you, sir. Thank you so much for this insightful session. There are a couple of queries.
Yeah.
There's one query in the in the chat box.
Can you read it out, please?
Yes, sir. I understand that TP block selection will be a cure any transaction. So, in a situation where the SSC has more than one international transaction and selects one or more and not at all the transactions, how will this block work practically?
Yeah, I think the viewer who has posed this should need to wait for a little more time just to see that what kind of prescription the CBDT were to come up with, whether they allow the entire reference of that particular year to be included in block, or the taxpayer will get more elbow room in terms of picking and choosing some and some not, because the underlying intention is to avoid a repetitive exercise, so to speak. So I think let's wait for the amendments in the rules, so to speak, and which they have said that they should bring it within less than period of 3 months. Yeah.
Okay. The next is, will the provisions using presumptive taxation for non-resident with respect to the tax received from sale of supplies also covered in the calculation for applying the presumptive tax?
Well, it's largely hovers around services with regard to sale per se. I think why would you, at the first instance, why would you expose an offshore sale to an Indian tax? All along, the non-residents have been espousing the cause that if the sale has been consummated outside India, then it should not be subject to India, subject to the anti-fragmentation rules which are applicable in some treaties pursuant to MLI. Largely, the call of the non-resident community with regard to sale is that it is being fructified outside India, unless yours is a case where it is getting consummated in India, and therefore there is a tax exposure around this. So I would rather suggest that you should go back to the drawing board and look at it. Otherwise, the helpful jurisprudence of the LGs of the world and the IHIs of the world would are the Lindays. I mean, all these are pronouncements which have withstood the test of time. Yeah.
Thank you, sir. There are few more queries. Should I take it?
Yeah, because we just have few more minutes. I want to fill up before you have your next panelist. Otherwise, there'll be an outage. So let's
Yes.
take one or
Yes.
two more.
Yes, sir. The another is, do you think the government should reduce compliances and simplify provisions for issues related to international taxation?
Yeah, of course, why it should, and therefore, at least international taxation helpfully is out of the faceless ambit, which gives more opportunity for taxpayers to have a interactive, in-person sort of interaction with the tax department, and even the tax department is very cognizant insofar as dealing with non-residents is concerned. The only area of concern or sort of some sort of advisory I have on the table is the fact that the general thought process is that the information sought for does not come very quickly from the non-resident taxpayers, or there is a hesitancy to share information. So remember, when unless it is not deliberate, I don't think it serves any purpose, because if the general impression given during the course of your interaction is such that, well, you are hesitant to share information, then of course you will be viewed not with certain amount of circumspect, which is very natural or human, so to speak. So my suggestion is that please share as much as you can upfront, because more often than not, when the matters are litigated and they travel to the superior appellate forums, at that point in time, everything comes up. Even my own experience of dealing with matters is that more often than not, at the tax tribunal stage, we are filing additional evidences which suggest the fact that this information must have been available or could have been made available at the lower stage itself. And then there is no choice but for the superior appellate authorities to remand the matter back and relegate the matter back to the files of the TPO or DRP in transfer pricing or international tax matters cases concerned. So please share what is relevant. The challenge which we have found is when you share so much that most of the relevant information is lost. So either there's a hesitancy of not sharing, or when it is shared, we share in abundance. So we miss the woods for the trees. Any other question we have, Divya?
Yes, sir. They are, but they are journal ones. The
We
another
can
is
take maybe one more because it's 41 by the watch you have.
yes, sir. The focus of the government is to simplify the Income Tax Act. What, according to you, should be the focus of new income tax bill government will introduce in coming days?
Well, I think it should be user friendly. I mean, it's like buying a sophisticated electronic equipment with a user manual which is easy to read. And it's if the provisions of the Act are user friendly and are aligned with global best practices, which are Indian customized. Remember, not everything which is followed in Western world can be blindly aimed and copied in Indian situation. If it is, if the global practices are transformed in let's say make in India kind of situation or made for India. So if keeping that in mind, just because the world is doing something else, we should also run after it, which the present government did very I think it was a great thought in terms of not pushing the button in terms of legislating the pillar one, pillar two tax proposals in the scheme of the statute. They waited, they wanted to see how the world is reacting. They never jumped the gun. It was a very wise and conscious thought. So if the act takes care of personal taxation, which more or less sounds attractive, the Act takes care of SMEs, focusing on SMEs, a part of the Act, and the part of the Act takes care of its interaction with the international laws. And then you have penalties, prosecution provisions. So each aspect of the Act, if it can concentrate, SMEs require a real facilitative mechanism in terms of understanding of Act. If SMEs can be taken care of, I think it'll be a great achievement, so to speak.
Thank you so much, sir. Thank you so much for covering everything in detail. Uh, we are sure that everyone has learned so much, a lot from this session. Thank you so much.
Thanks. Bye.
Bye, sir. So we are now almost halfway through our marathon, and I am delighted to welcome Harshal Bhutta, partner at PR Bhutta and Company, for our next important session on IFSC and startup. Harshal is a renowned FEMA international tax and transfer pricing expert, a fellow chartered accountant, and with an advanced diploma in international taxation from UK and an LLM in international taxation from Vienna University of Economics and Business. He has delivered over 100 lectures and masterclasses at professional forums. Mr. Bhutta has co-authored FEMA compounding orders. He is frequently quoted in leading media such as Economic Times, Hindu Business Line, Live Mint, CNBC for his insights on complex tax matters. Welcome, sir. How are you?
Yes, thank you. Thank you, Divya. Thanks for the kind introduction, and thanks to Taxmann also for inviting me to share my views on the budget. So, yes, I think just let me present my screen. 1 second. Yeah, my screen is visible, right?
Yes, it is visible.
Okay.
Okay, over to you now. Thank you.
Thank you. Yeah. So the topics that have been allocated to me are the budget proposals in relation to IFSC and startups. So what we are going to do is we are going to go through all the proposals. I made a index, 1 second. Yeah, IFSC and startup. This is a beautiful picture of IFSC. This is an actual picture of IFSC. Yes, so this is all that we are going to cover today. So majority of the proposals that have come in IFSC are extension of the due dates, which were prescribed for beginning operations in IFSC, and there are, a few proposals that actually remove certain bottlenecks that were there, some inconsistencies that were there. So, a lot of things go in the background before, the budget. So, for example, if I talk about the recent change where, if you see this serial number 4, exemption to capital gains and dividend for ship leasing. So this may have been, as a result of recent interactions by the gift authorities with the Greek shipping industry. Okay. So that could have been a reason for the introduction. So as I told you, a lot of background interactions keep happening with different stakeholders, which then result into these amendments. With that, so all these changes, I wouldn't call them path-breaking, but yes, they are definitely changes in the right step. It's towards more and more liberalization of the IFSC regime, bringing, more and more incentives, trying to onshore a lot of industries here. So that's the end objective. But I am little skeptical, at least as far as Pillar 2 goes, because there is a MAT of 9% in IFSC, whereas Pillar 2, we all know that the global minimum tax is going to be 15%. So this interaction between Pillar 2, GIFT City, etc., that has not been dealt with much by any of the documents that may have been issued, or India's position basically at the global forum. So we'll see, I think very soon how that will come out, and how that will actually interact with the GIFT City regime, and will it really impact the government's intent to make the GIFT City regime a world-class regime and as comparable to other tax jurisdictions. See, if there are other tax jurisdictions which also will be affected by Pillar 2, then maybe, we have some kind of cushion there where we can still, give some incentives and then let it prosper. Okay, so these are the line items that I'm going to cover. Introduction to IFSC. So for those who are uninitiated, IFSC is a regime that has been specifically created as a financial services regime where services are offered to non-residents as well as residents. So why do I talk about residents? Because so you would have seen, resident individuals being able to open LRS accounts in IFSC. So it also offers certain services to residents. It's not open much yet to residents because, we don't want to create a disparity between domestic investments and investments by residents into IFSC, etc. IFSC is typically, focused on non-residents. Okay, so we want to onshore them, we want to provide services to them and make it as world-class as any other financial service regime like Singapore, Hong Kong, etc. are there. Okay. One important point that you need to bear in mind is that, all the transactions need to take place in foreign currency. Okay. No transactions can take place in INR. So that is important. Okay, let's go to the different proposals for IFSC that are there in this. So these are all the proposals where only the extension of due dates have been made. So these are all that are listed down. So ATLA 2D is where, if there is an income from transfer of a aircraft or ship itself, okay, it's not concerned with transfer of shares, it's transfer of the subject aircraft or ship or their engine also, because that has also been defined. Okay. So if there's a transfer by the IFSC unit which has leased it, then in that case, if the IFSC has a buffer to start the operations by now March 2030. So earlier the provisions were that they had to start, the operations by 31st March 2025. Now it is 31st March 2030. So, here is where you see that they are kind of promoting this at a very grand scale, because earlier we used to see in the budget proposal that no, every year, year by year for 1 year extension used to be given, but now a block extension of maybe 5 years is being given. So that's kind of a posturing to the foreign investors that yes, please come over, we will facilitate this, we are serious about the IFSC business here. Okay, so that is the first one. Second one is 10(4)(d). 10(4)(d) is where income is arising of the offshore banking unit. So there also the offshore banking unit had to start the operations by 2025, that is 31st March. So this is basically where the offshore banking unit is earning capital gains income. Okay, so that is from sale of IFSC listed assets. Okay, so that have been given in 47(6) AD, if I'm not wrong. Yeah, 47(6) AB. Okay, so what are those capital assets? Those capital assets are bonds, ADR, GDR, rupee denominated bond, derivatives, etc., which are listed on IFSC stock exchange only. It's not a domestic stock exchange, it's IFSC stock exchange. And for those who don't know, offshore banking unit is nothing but a branch that banking branch that is set up either by Indian banking company or a foreign banking company in IFSC. Okay, so if they have any income arising from transfer of these different capital assets on the IFSC stock exchange, then that will be exempt. So they have to start operations by 31st March 2025. That has been updated, extended till 31st March 2030. 10(4)(f) is again, dealing with aircraft leasing and ship leasing. Okay, so this is where, if any non-resident is earning royalty or interest income, okay, from the lease. Why do I talk about royalty or interest? Because here it's talking about lease, because the regime itself allows both operating lease and finance lease. Okay, so therefore finance lease income would amount to interest, operating lease income would amount to royalty. So therefore, both are covered here, and exemption has been given, provided to the non-resident here, in case they earn royalty or interest from IFSC unit which has leased these assets, which are aircraft and ship. Okay, so here again the IFSC unit, the leasing unit had to start the operations by 31st March 2025. That has been extended till 31st March 2030 now. Okay. Then we go to section 10(4)(h). So section 10(4)(h) is basically when at the moment, so till now the budget proposal, this was basically for aircraft leasing, where if any shares of the domestic company which was engaged in aircraft leasing, those shares was sold by either the non-resident or another IFSC unit. Why would there be another IFSC unit? I'll come to that in subsequent slides, because certain liberalization has happened there also. So either a non-resident or another IFSC unit which is engaged in aircraft leasing business sells the shares of an IFSC unit which is engaged in aircraft leasing unit, then the capital gains on the transfer of those shares is exempt under section 10(4)(h). So here again, the IFSC unit engaged in aircraft leasing, whose shares are to be sold, that unit had to start the business by 31st March 2026. So then that has again been extended till 31st March 2030. Okay. And the last one is 47(a)(d). So here is where, again, so the entire fillip to IFSC was for the fund industry. Okay. So the Indian government wanted onshoring of the fund industry from foreign locations like Singapore, Mauritius, Cayman Island, etc. So that is why capital gains exemption was specifically granted, that when you onshore to India, okay, so that's called as a relocation. When you relocate to India, and whatever capital gains event takes place in the hands of the shareholder, unit holder, interest holder, depending on the type of the fund, and in that case, those capital gains will be exempt. Okay, so your onshoring was allowed till 31st March 2025. Now that has also been extended till 31st March 2030. Obviously, all these are proposals likely to be passed. I don't see any challenge in these extensions. Okay, so these are the set of due date extensions that have been given. Next one that we come to is the insurance policies that would be issued from IFSC. Okay. So as of now, there are some insurance companies that are set up. Big names also, HDFC, Tata, AIA, AIG, both. And then I think ICICI is also there. So all this list you will find on the IFSC website. So these have already set up shop. Okay. But them offering ULIPs are not so prevalent as of now because of these caps that were there in section 1010D. We all know that, section 1010D has certain caps. Okay. In order to avoid misuse, because ULIP, as we know, it is a dual purpose product. It offers life insurance also and also investment. So there were certain limits that were there. So the limits are that for ULIPs, if the amount of premium exceeds 2,50,000 rupees, that is INR, in any particular financial year, and life insurance policies other than ULIP, okay, there it is 5 lakh INR. Then in that case, you won't get the benefit of section 1010D, which exempts the payouts. Now, payout could be, surrender value, payout could be actual insurance payout, bonus, etc. Okay. So in order to give a fillip to insurance companies who have set up shop in IFSC and they want to, popularize the issuance of IFS policies to non-residents. In that case, what has been done? So the limit, these two limits that were there, that is 2,50,000 INR and 5 lakh INR, that have been removed. See, if non-residents were to take insurance policies outside India, they may have got this benefit that yes, whatever sum that I receive, either on maturity, as I said, surrender, etc., that would be exempt. Then why would they invest in India when they have this cap? Okay, so for foreigners, you have jumbo policies where the premium amounts may be very large. Then in that case, what happens is they may not want to invest. So this is an opening that has been given to them that yes, please come and put in or obtain life insurance policies. The advantage there is that whatever investment that the insurance companies may do, that may be in the Indian sector, and that may earn better returns than what foreign markets may give. Okay. But another point that has been missed in this budget is that the 10% threshold has still been retained. In my view, that also should have been received if they want to bring it at par with insurance policies issued outside India. So what is this 10% cap? This 10% cap is, if the premium in any year exceeds 10% of the sum assured, then in that case, again, you don't get the benefit of 1010D. I hope that, they realize that this is also something that needs to be liberalized because this is intended for non-residents. Now, the question can come up here that, so IFSC, can the IFSC insurance companies or insurance intermediaries issue policies to residents? So under FEMA, that is allowed. We all know that IFSC is a region under FEMA that is treated as a jurisdiction outside India. So therefore, whenever an Indian resident has to make any remittance to IFSC, etc., that's counted as an outbound remittance. If it's an individual, it is LRS. If it is an Indian company, then that is counted as either ODI, OPI, depending on the situation. Now, when Indian residents want to obtain these insurance policies issued by the companies set up in IFSC, that will be treated as a LRS transaction, and further that requires RBI permission. So I'm not sure what is the policy intent here. Will they extend to residents or they still want to restrict it only to non-residents? If they want to extend to residents, then maybe we'll have to see whether RBI relaxes this condition of prior approval if a resident individual wants to, obtain ULIP from IFSC offices. Okay. The next one that we go to is exemption to capital gains and dividend from ship leasing. Okay, so here is where I was talking that a lot of things go in the background before the budget. So this is a provision that has come in to extend the aircraft leasing tax benefits to ship leasing industry also. So they realize that ship leasing business has not taken off that much. You can compare the list of companies that have set up shop for aircraft leasing versus ship leasing. Okay, aircraft leasing is multifold than ship leasing. So here what happens is in the ship leasing, aircraft leasing both. So the intent of IFSC tax benefits is that you want to onshore these companies and let them do business in India, let them lease it out to Indian companies or even offshore. That's okay. So whatever income that they earn in India, tax benefits have been given on them. Okay. Now this has been extended to ship leasing also. So it could be a non-resident who has set up SPVs in India for each ship. Okay, or that could be a holding company also in India, and then below the holding company there are different SPVs that are there. So therefore, whenever maybe you sell a ship, you want to reinvest, that was subject to capital gains till now because Section 10 4H benefit was not for ship leasing industry, it was only for aircraft leasing industry. So that has been exempted. So let's say if a non-resident or if IFS unit, that's a holding company that wants to sell the equity shares by itself, not the direct ship, because direct ship anyway benefit is given under 80LA. If that entity ship leasing entity is selling, then it gets. But this is one layer about that. So non-residents or the IFSC unit which wants to sell the equity shares of the actual IFSC unit who is engaged in aircraft leasing, then in that case also it will be tax exempt. Second is the dividend benefit. But here again, if you see the dividend benefit, that has been given only when one IFSC unit declares dividend to another IFSC unit. I am not sure what's the policy intent in not giving this benefit to non-residents. So as of now, as it appears, and so whenever ship leasing or a aircraft leasing IFSC unit declares dividends to the non-resident, then in that case they are taxed at 10%. That concession has been given under 115A. Otherwise, for non-resident it is 20%. So it has been reduced to 10%, but it has not been done away with. Next, we go to removal of the deemed dividend taxation for inter-group financing. So inter-group financing, this is just a background here. What is a treasury center and what does it do, etc. So treasury center basically is set up for a centralized treasury function. Okay, now treasury functions could be investments, could be intra-group financing. It could also extend to a lot of other things like corporate M&A strategy, etc. Okay, so all of these basically would be housed at a global clearing center. That is also a term that a lot of MNCs give, and a treasury center is a term that is there under the IFSC regulations. So it is coming under the finance company regulations that have been issued by IFSC. This is one of the core activities that they can do. So finance company is nothing like, so it's as good as an equivalent of an NBFC in India. Okay, so one can set up a finance company in IFSC and do a lot of things. So treasury functions are also permitted by the IFSC finance company regulations. Now, why are these there? Okay, so let's say, so I hope everyone would be aware about the deemed dividend regulation, section 222E. When the subsidiary gives an advance to the shareholder, okay, maybe the parent, etc., that is treated as a deemed dividend and that is taxed in the hands of the shareholder. So in case of intra-group financing, there's a lot of intercompany dealings on the debt side that are carried out. And mind you, 222E also covers group companies. It is not only the shareholder. It also covers a company where my shareholder has a substantial interest. Okay, so it also covers that. So Therefore, there are then restrictions in India when one wants to set up a treasury center. Obviously, this is again targeted for non-residents. So as of now, you will see there are three entities that have set up shop as treasury centers. Two are Indian based, but they are overseas companies, ONGC and OIL. So they are overseas companies are set up, and there is a third entity also that has set up. So a lot of times there are restrictions practically that, if you provide short-term finance, working capital lending finance to a group company outside India, then in that case, that group company can come under the clutches of the deemed dividend taxation. So realizing this, they have actually removed this burden from the treasury centers that have been set up in IFSC. So let's see what are the conditions here. There are two conditions that have been given. Okay. One is where an entity is a finance company or a finance unit in a IFSC acting as a global or regional treasury center. It is but natural because you are wanting to give the benefit to treasury centers. Okay. Second is the parent entity is listed on the foreign stock exchange. Okay. So if one really reads this proposal, there could be some kind of confusion where one may read it as these are the two group entities. So let's read this. Okay. So just one moment, let me remove this using clause 3. Yep. An advance or loan between two group entities where one of the group entity is a finance company or a finance unit and the parent entity or the principal entity of such group is listed on the stock exchange in a country or territory outside India other than the country or territory outside India as may be specified by CBDT. Okay. So if you read this closely, one gets the impression that it has been worded in a manner that these are the two group entities. One of the group entity is a finance company or a finance unit and the parent entity or the principal entity of such group. So one may consider that as a second group entity, but this is not the objective. The objective is that any intra-group dealings between sister companies, etc., by the treasury center in India and the other group companies, that will not come under the purview of deemed dividend taxation. These are only the two conditions that you need to satisfy. Okay. The second condition is that the parent entity should be listed on a foreign stock exchange. Okay. So this is similar to what is there under 222E also. So under 222, if you see, it talks about a company in which public are not substantially interested. And if you go to the definition of a company in which public are not substantially interested, there even a subsidiary company of a publicly listed company is covered. So therefore, I think that is a kind of similarity that they have brought in while extending this benefit to intragroup financing in treasury centers in IFSC. Okay. So this is okay. Next, we go to the fund managers regime. So this is actually a relaxation which is not only restricted to the fund managers who have set up in IFSC. It is extended to all. Okay, so it specifically mentions whether or not they are eligible fund manager are based in IFSC. Okay, so therefore it applies to all fund managers set up in outside IFSC in India and fund managers set up in IFSC also. Okay, it's not that a lot of conditions have been relaxed. If you really see section 9A, humongous, so many conditions have been given that it becomes too restrictive. So one of the conditions has really been relaxed here. What was that condition? The condition was that resident individuals' participation cannot exceed in aggregate of 5% of the fund's corpus. Okay. So now what has been done? What's the relaxation per se? So 5% has not been relaxed. It is only when you have to count when this 5% applies that has been relaxed. So earlier, if we see section 9A. Okay. Yeah. So, yeah, section 983C, it talks about the aggregate participation or the investment in the fund directly, indirectly by persons resident in India does not exceed 5% of the corpus of the fund. No time limit was given, so therefore it was assumed that at all points in time it cannot exceed 5%. Okay, so now they may realize that yes, what if there are HNIs who have invested in their fund outside India, so they are not able to relocate to India because of this condition. Okay, there are a lot of HNIs who have invested in foreign FPI, so foreign funds basically. Okay, those may be India focused, those may be foreign focused. If it's India focused, again there's an issue. You would have read in the news, sometime back that ED had issued notices to these HNIs who had invested in India focused funds but domiciled outside India. But leaving that apart, it is never the intention of the RBI that Indian resident individuals invest in foreign funds who again invest into India. So therefore, here also the condition is that 5% cap is there. So at all points in time that was applicable. Now what has been relaxed is this will be tested twice in a particular previous year. When would this be tested? This would be tested as on 1st April and as on 1st October. Okay, only on 2 dates. So in between, I think it should be fine if you are exceeding that, but obviously that is again not the intent. And if on either of these dates, okay, so this testing has to be done annually. If on either of these dates you are not able to meet this 5%, then now additionally a grace period has been given. What is a grace period? Grace period is 4 months from the date when this threshold is to be determined. Okay, so 4 months from 1st April, 4 months from October. Okay, so as I told you, this is not only for funds that are fund managers that are based in IFSC. This is also for funds where the fund managers are based either in India or the IFSC. Okay, so that is it. Another amendment that has been made is with respect to the relocation. I think that is there. So this is coming out of this coming out of section 9A, subsection 8A, where relocation had to be completed by 31st March 20. I think it was 25 earlier. Just let me check that. 2024. Achha, so that day had anyway expired. So under 8A, the central government has the power to relax any of these conditions. So now they have relaxed it to 31st March, again 2030. So maybe because of the increasing, global competition, they are extending this time so that, the foreign domiciled funds have more time to relocate to India. Okay. Next, we go to the tax exemptions that are now being offered to the participatory notes. Was the earlier term that has already been changed and now defined as offshore derivative instrument that are issued by FPIs. Okay, so what was this provision really? So those who do not want direct exposure to India or those who cannot have direct exposure to India. So as on today, under FEMA, if a foreign citizen who's not a OCI wants direct exposure to the Indian stock market, there is no way they can directly do the individual capacity. They have to come through an FPI. They can become a constituent of FPI. That's fine. Or they can maybe subscribe to the participatory notes issued by FPI if they don't want to become a part of FPI. Now, offshore derivative instrument is an instrument that is issued by FPI for those who don't want to become a constituent of FPI or those who can't directly invest into India. In either case, FPIs or even an offshore banking unit. So till now, this section 10(4)(e) exemption was given for the offshore derivative instruments issued by an offshore banking unit. That has been extended to FPI. So these offshore banking units, they issue these derivative instruments to non-residents. The underlying would be the Indian listed stocks or Indian securities, etc. So what happens is there are two things that come up here. One is where capital gains could be there for the non-resident on the transfer of these offshore derivative instruments. Second is the income that they may earn. This is the passive income. So let's say, it's a derivative. The underlying is equity. Now, equity share earns dividends. So if these dividends are passed on to the non-resident because of their ownership or subscription to the participatory notes, and in that case, there could have been double taxation. The offshore banking unit was taxed under Section 115 AD. Again, at the time of distribution of that income, the non-resident was also taxed. So therefore, Finance Act 2023 first, it removed this double layer of taxation, but that was only and only for a offshore derivative instrument, OTC derivative, or NDF. NDF is typically in currency derivative. So only that was exempt. Now that has been extended to the participatory notes that can be issued by other FPIs also. Okay, but the fund has to be registered as an FPI. The fund is not registered as an FPI, then if they issue the offshore derivative instrument, then they are not allowed to. They are allowed to obviously issue, but then they are that they earn from this. So this is as far as the offshore derivative instrument is concerned. Second last provision that will be covering. So again, this is not a major event, at least as far as the budget proposal is concerned. Obviously, the intent is very nice in this, that the retail schemes and exchange traded funds. Okay, now we are targeting them to relocate to India. Okay, so earlier it was basically the private funds. Now it is retail schemes and exchange traded funds also, that we are now encouraging them to relocate to India, and then whatever capital gains arises on the transfer of the units of these funds in the hands of the unit holder, etc., that will be exempt under Section 47 AD. So I think this is the relaxation that has been provided here. So this is basically to target again, NRIs who want to invest in India focused funds, which are right now domiciled outside India. Okay. So please bear in mind that, whatever amendments that have been brought in the IFSC regime, there could be only 2-3 objectives. One is to provide services to non-residents, and second is onshoring them into India when investments are made, at least in the Indian market, in Indian economy. Okay. This is the last provision that is there. Again, not any change in the provisions of Section 80 IAC. It is only that, extension has been given for the startup that had to be incorporated before 1st April 2025. Now that has been extended by another 5 years. Now the startup has to, commence its business operations before 1st April 2030. So under this, there's a benefit that has been given that, certain number of years out of a block period, there will be a tax exemption that will be granted to the startups. Okay. I think that is it. Not many proposals as far as IFSC are concerned. Let us see if the new finance, the income tax bill that is going to come up. We'll see, if there are any more relaxations that have been given. Unlikely, because under the budget they've already given. But if you it will be interesting actually to see if any path-breaking changes are brought in order to give a huge fillip to IFSC. So let's see if we have any questions here.
Thank you so much, sir, for this amazing session.
Yes. Thank you. I don't see any questions. I think there is one
Sir,
coming.
we do have a couple of queries. I will brief it. Just a second.
Okay.
The first one is in this budget, it is announced that monetary cap of the premium amount for exemption under Section 10, subsection 10D won't apply to the policies from IFSC-based insurers. Are monetary caps applicable to foreign insurance policies also?
Okay, so let me again clarify. Let me go back to my slide. I think I will have to maybe explain in greater detail what this is about. Yeah. So here, basically, when the IFSC insurance, units are issuing the policies to non-residents. So this is obviously targeted non-residents. They have not specified right now whether it is policies to be offered to resident or non-resident. But I would largely believe that this is targeted to offer policies to non-residents. This is from IFSC offices. If a non-resident is subscribing to a foreign policy outside India, then in that case, this provision does not apply. So therefore, I think that answers your query that does it apply to foreign policies. So if non-residents are opting for foreign insurance policies, and Section 1020 doesn't apply.
Okay. Okay. The next is, why is an Indian resident participation in offshore funds checked twice a year under Section 9A?
So I think this I dealt in very great detail that the objective of onshoring is for foreign funds. Okay, it's not Indian funds who are encouraged to change their domicile to IFSC, etc. Foreign funds getting onshored into India. So RBI has never encouraged Indian participation in foreign funds which have India focus. So I think that is the reason why that 5% threshold limit is present under the law.
Okay, let me check. There are some more questions. Just a second, just a second. Will Section 9A apply if an offshore fund pools money from Indian resident to invest in crypto and their participation exceeds 5% threshold?
So again, practically I have not seen this, but theoretically, at least, under FEMA, you may not be even allowed to invest in a fund that further invests in crypto. So I'm not sure practically how this will work. Yeah.
Okay. So there's one question in the chat box that is any changes of government promoting similar IFSCs in other cities in India?
As of now, I don't see any intent that has been laid out by the government. But yes, the Maharashtra CM was very upbeat that yes, we would want to replicate something like GIFT City in Maharashtra. But I think only time can tell this, because earlier, when GIFT City in Gandhinagar was being looked at that point in time, there was serious competition by BKC in India. But eventually, yeah, IFSC could not brought in, the regime could not be brought in Mumbai, and then it shifted there. So I think that may be a political statement, but on ground, if you ask me, I don't see much chance of that happening, because we first have to see the grand success of IFSC regime booming. Maybe after that, government can consider a similar regime in other cities.
Okay, so there are a few more questions. Should I take it?
Yeah, I'm fine with that. I'm obviously subject to the next speaker.
Yes. There's one more query, that is, should the government introduce more incentives for startups in the coming years? What is your take on it?
So honestly, yes, a lot of things have to be simplified for startups. It is not only the tax regime. Okay, there are a lot of other laws that need to be simplified, because the startup is already struggling to scale for business. It should not have to worry about regulatory regime also, that which regulations do I have to take care of, and they should not be scared of the regulatory regime is what I would feel.
Okay, correct. The another is, what are the retail funds and why government is promoting their reallocation to IFSCs?
So as I told you earlier, the focus was on, relocation of private funds that were there. Now they want to expand the basket by, encouraging even retail funds to relocate to India. In my opinion, this is clearly targeted towards, NRI investments in retail funds having India focus. Why should they be domiciled abroad, when the focus is on the India markets?
Okay, correct. So there's one general question that
Right.
how would you read this budget as the government proposed on 1st February?
No, so as we all know, this was only an interim step towards, the income tax bill that is supposed to be, placed. I don't know if it's going to be placed today or tomorrow because 2 days are only left in this week. But therefore, we really, did not expect a lot of changes. We knew that the income tax bill is going to be, placed very soon. We didn't know that it's going to be in this week though.
Okay, let me check uh, quickly if there are more queries or not.
Yes.
Anybody, please drop your queries, if any, in the chat box.
Yes, there is a query that is coming. Please share which insurance company issued policy from IFS unit for NRI. I think, at least as far as I know, there is one insurance company that has issued ULIP, or one or two maybe. One is, I think, HDFC, and second is India First. I am not too sure, but these are the companies who have introduced ULIP in IFSC.
Okay. Any other question? Anybody want to ask? I think there's no more questions. There's one last question. Can an Indian resident takes policy from IFSC-based insurer?
I think this is something I already dealt with RBI approval. Yes, you may be able to opt for that policy, but without RBI approval, you cannot.
Okay. Okay. Thank you so much, sir. It was a great learning. Thank
Yes.
you.
Sorry, there's one more question from someone. Can investment in cryptocurrency be made from bank account opened in IFSC? I don't think practically you would be allowed to do that under LRS already, it's a question mark whether you can do, but banks don't allow you to do. So from IFSC bank account also, the bank will not enable you to do that. So practically it may not be possible. Theoretically, we can keep on debating under FEMA whether cryptocurrency investment is allowed, not allowed, etc. In my view, it is not allowed. So I would advise, not to take an adventurous interpretation and go ahead with it. Yeah.
Uh, Thank you, sir. So I think there's one more query in the chat box. Will the provisions using presumptive tax for non-resident with respect to income received from sale of supplies also be covered in the calculation for applying the presumptive tax?
No, so you are talking about, I think, the proposed section 44 BBD, right? So I'm not sure, but I presume that, the query relates to that. So the query, I think, itself answers the question that, what is proposed to be covered under 44 BBD is the, income from provision of services by the non-resident for the electronics manufacturing facility. So therefore, certainly service income is proposed to be covered under 44 BBD.
That's all. Thank you so much, sir.
Okay, thank you very much.
It
Thanks
was,
for a patient learning. Thank you.
thank you, sir. Thank you so much. So now we move on to the seventh session of the day for the proposed changes in transfer pricing, and I hope everyone remains as energetic as they were in the morning. Joining us, we have Mithilesh Reddy, founder and CEO at Steadfast Business Consulting, as a subject matter expert. Mr. Reddy, Mr. Reddy brings over 15 years of with specialized experience in transfer pricing, advising multinational enterprises on three-tier documents, litigation support, and complication intercompany transactions. His expertise spans transfer pricing structuring, controversy management, global benchmarking, compliances, and strategic advisory related to advanced pricing agreements, mutual agreement procedures, and base erosion and profit shifting. Mithilesh has served a diverse client base across the technology, industrial, pharmaceutical, financial services, and consumer goods services. Welcome, sir. How are you?
Hi everyone. I'm audible.
Yes, sir, you're audible.
Okay. So shall we start?
Yes, you can start.
So hi everyone. This is Mithilesh here. So there are almost around 3 to 4 minor amendments, I would say, but one major amendment which is pertaining to transfer pricing audit as such, in terms of the overall perspective of conducting the transfer pricing assessments in India. But the major revolutionary change that I would talk about is the bulk transfer pricing assessments that they have started introducing. The fact is that most of the assessments in India are being done from 2 years down the line from the end of the relevant assessment year, which is a fact that they have added the specificalities in terms of updation of the ALP or the documentation during the course of assessments, which will bring everything on a comparative mode or a equitable mode. But the point that was always lacking from certainty perspective was plugged in by safe harbor rules or APA or dispute resolution mechanisms of DRP and MAP proceedings, etc. But ultimately, if you compare global versus us in terms of what exactly are we intending to do right now from the bulk TP assessments or the block TP assessments that I would say is effective from AY 26-27. They are going to propose a 3-year period. 1 year ALP, which is proposed by the TPO, would be applicable for the next 2 years, is the proposition. This aligns with the global best practices or the major jurisdictions, transfer pricing jurisdictions. But the fact is that the block TP assessments of the globe have been on backward basis. They take a 3-year or a 5-year period, which is of the past. But we are talking about a forward period of 3 years because of the fact that we are on a timeline basis 2 years slower than what we were supposed to be in that I would say. But this is a very good amendment, especially from certainty perspective, especially from captive units perspective, where there's not much change in the functionality. So globally, it's a very widely used practice, the block TP assessments. But in India, compared to the earlier 3/2016 notification, which talks about the specific reference to the TPO versus a certainty model which is being adopted right now from a block TP assessment mode, would be that the CPC, when it picks up a particular case for a scrutiny and sends it to a TPO or a transfer pricing authority, there was earlier a notification or a risk parameter based assessment which was being followed. Under this specific notification, wherever there were transactions which were not disclosed, wherever transactions which were not adopted to be at arm's length from the disclosure standpoint is concerned, or wherever there is inconsistency between the numbers or a comparative mode as per the RPT schedules, or there is complete misalignment of the transaction itself, it was the prima facie pickup. But during the course of search or any specificalities, wherever search and seizure proceedings or survey proceedings were happening, the prima facie underlying evidence or the prima facie underlying transaction based on which the search and seizure was initiated were the cases that were referred to the TPO. Now, it's with the assessee to choose that he wants to get assessed for the next 2 years with the ALP that is determined by the TPO in the first year. In the block of 3 years that starts from AY 26-27, the assessee can select and adopt the same ALP for the next 2 years. It looks, very exciting and, it looks very rosy, but there are a lot of ifs and buts in this process, or there are a lot of questions, unanswered clarifications that might be answered during the course of this bill presentation or during the course of the notifications that they might announce. So yes, it's a welcome move, but there has to be a specific procedure, timelines, and the methodology with which the guidelines have to be announced and implemented. So hope I'm clear with the prima facie aspect of it. Now just take a move back and see how the global TP audits and the India block provision analysis is being done. So as I told you, global TP audits are basically focused on the risk-based or the parameters that I was talking about. Specifically, if they are picked up for a block, they would go back specifically for a period of 2 to 4 years or 3 to 5 years max. So even in the recent TP jurisdictions like Saudi Arabia or UAE or any other jurisdictions which have come up with the TP provisions of late, there has been a 5-year period that we have kept in the ZACTA guidelines as well. But the point that I'm trying to tell you is, we were always the single year assessed country, or a single year assessment proviso was there in the under 92 CA, and the specific arm's length determination was also done on year by year basis. But in comparison to the global guidelines or the global methodologies, they have adopted this block assessment, but global goes backwards. We are going 3 years forwards. Now, the overall perspective with which they have done and the methodology with which this is to be implemented and the effectiveness and efficiency levels compared to the global are to be ascertained. Now, if you see what exactly will be advantages or disadvantages to the assessee, is the fact that it reduces the time burden and the costs incurred for a 3-year period, where the documentation, consultant fees, and the entire burden of running around would not be there. But from a year-on-year perspective basis, and from an applicability of the same terms and conditions, the functional analysis and the comparability, arm's length perspectives being determined from overall basis have to be kept ready by the first year assessments, and we need to have a compliance readiness as well. So the compliances pertaining to TP documentation have not changed. They have not removed any or amended any of the 3CB, TP report or master file or CBCR threshold limits. They have only kept the assessments, clubbed for a 3-year period. So now this brings us to a specificality to look after the ALP being determined. If I can go back to 2015 notification, where multiple year data was taken into consideration for the updation of the comparables or the arm's length price determination, there was a 3-year period for which you need to arrive at the comparable arm's length price in the documentation itself. Earlier, there was a single year period with which we used to do, but after 2015, that is effective from 2016 onwards, there was a 3-year multiple year data and weighted average and a range concept that was introduced into the Act on percentile basis. So they are slowly adopting the global methodologies and making sure that the 3-year period brings to the light the entire forward assessment and keeps the tax collections also certain. And there is no doubt that this is a welcome move, but the administration, implementation, and the way in which these adoption and evaluation mechanism will be done is the question. So from an assessing officer standpoint or a TPO standpoint, he would be required to check the terms and conditions. He would be required to check the functional analysis with the same associated enterprise is what is being mentioned in the Act now. If at all he adopts the same transaction with a different associated enterprise, it's not clear. They've just mentioned the same enterprise or the same associated enterprise in the entire language of the amendment. So if the same transaction in a different jurisdiction is being adopted with a group company or an associated enterprise, it would not be covered in this adoption. So from overall period perspective, there are certain expectations, there are certain timelines based on which these amendments are required to be implemented or the questions would be answered. So we have kept 10 to 12 pointers on screen, which would be the determination aspects or the evaluation aspects that are to be clarified from various angles. So the declaration filing deadline has not been mentioned, but the TPO, once the assessee adopts this methodology or goes for a block assessment and adopts after the first year TPO ALP determination, TPO has been given 30 days timeline to decide and evaluate the next 2 years as well. But the timeline for the adoption of block assessment on the first year end, the assessment year 26-27, the first year end would be 31st January 2029. So by that time, they have to analyze the next 2 years and whether the TPO ALP that is being determined as on that date can be adopted for the next 2 years. Assessee has to take a call, he has to adopt, and then the overall perspective with which the TPO has to evaluate and give them the orders is the next 30 days itself. So this procedure needs that clarity from a timelines angle from assessee standpoint. From TPO standpoint, it is 30 days. What is the withdrawal of excised option? Is there any form and manner in which I am adopting and the TPO is rejecting my adoption and says that there are changes in the terms and conditions, there are changes in the functional analysis, or the assessee himself wants to withdraw, or is there any appeal mechanism with which the rejection of the adoption is to be done? All these aspects are yet to be clarified. From a TPO examination standpoint, from an overall subsequent year perspective, as well as the parameters and critical assumptions perspective, if we see APA, the year on year at which the annual compliances after the APA is being signed, we kind of file the terms and conditions or the adoption assumptions with which the APA has been signed are being followed or not to the TPO. Is there anything of that sort that they will come up with on a parameters perspective that the TPO will establish in the first year TP order, and this will be followed for the next 2 years? Is the specific question that is still unanswered. Now, from a single transaction, from a multiple year transactions is concerned, if it is a captive service provider from services segment is concerned, it can only be a single transaction or an outstanding receivables at the max. But if there are multiple transactions or if there are n number of related parties in multiple jurisdictions, when the ALP is determined for each of these aspects from aggregation versus segregation angle is concerned, each transaction is being determined with a specific ALP, then the confusion really enhances. So if I am adopting this methodology only for a single transaction among my multiple transactions, will the TP reference or the 3/2016 apply for the rest of the transactions? Am I still going to be assessed for the rest of the transactions for the next 2 years? Or how the partial selection of this risk-based assessments will still go on is yet to be clarified. So this part is the most vulnerable aspect of among the transition period is concerned. Once the first block is completed, after that, I think all these questions and the relevant aspects of single versus multiple period, updation of comparables, and the TPO perspective of how the critical assumptions are going to be evaluated will be clarified. So pending APA cases, say suppose I'm still due, I'm about to file 2 APA cases application, and by the end of 29 or by the end of 30, I am having the last year that is being covered by the APA. So I have not yet got APA signing done. For such kind of cases, if I go for a block assessment, then my entire APA period that was pending or partial period that was not being covered by the APA, is it still going to be assessed or not assessed? Or how long will it be kept open from a going back perspective is concerned, even under search and seizure proceedings, is the vulnerable aspect. From various scenarios, if you consider these questions, the most interesting part will be, say suppose the TPO has selected or adopted a 17% arm's length, and this particular arm's length, the assessee has said that I am going to implement this for the next 2 years, and he has applied for this adoption. Now, the assessee is at 16% for the second year and 17% for the third year. For the second year, if he's going to do a voluntary adjustment kind of a scenario, whether he's required to bring in that secondary adjustment and clubbing of these provisions or the amendment to the respective provisions of the secondary adjustments and the differential updation of income tax return, or the specificality of adding that particular differential component also would be required to be analyzed. Comparison, where from a block assessment provision or from a TP compliance provision, an APA and safe harbor, we have done a tabulation at the end. I will come to this point at a later part of the presentation. But overall level, there are certain minute questions that would be really interesting when gets triggered during the course of this implementation. From an impact assessment standpoint or a pending cases at a higher forum standpoint, if at all I'm going to adopt any of these ALPs that are being determined for the future years, is there going to be anything that will be seen as a precedent by the appellate tribunals or the commissioner appeals or any other higher appellate forums? Will be specifically required to be subtly mentioned that this precedent, this should not be taken up as a precedent and it should not be impacting any of the past forums. So this analysis on the overall basis will be the key, and specificalities being amended for each of these provisions are the most important provisions that are expected to be announced. From an updation of benchmarking, I just said that single year versus multiple year, and also the assessee was allowed to update his benchmarking during the course of TP assessments. Whether this particular aspect will still be required to be done for the next 2 years, where the TPO would be implementing the same ALP, whether he's going to do or run the search process for the next 2 years, whether the assessee himself has to provide the basis of that 17% being correct for the next 2 years, or how the updation of the benchmarking is required for the justification also needs to be analyzed. Whether this is required or not required, that subtle change or mention is required by the government. Now, from a TP documentation requirements is concerned, yes, there is no change in the compliances, but whether the revision of a TP documentation or updation is required or not is the same point. Now, from a compliance of assessment standpoint, till now, there has not been much of a sound or a, evaluation that has been conducted by any of the master file filings or the country by country assessment is concerned. From overall global assessments from India driven angle is concerned, either from an inbound or outbound perspective. But from this block TP assessment perspective is concerned, whether there is going to be any sea change that is required to be adopted for the master file assessments, or is there anything that the government is looking at changing the entire portfolio of assessments from these two evaluations is concerned for bigger portfolio of companies which are applicable for master file and CBCR provisions specifically. So these are the points that still require guidelines or clarifications, and there are multiple angles with which these questions needs to be analyzed. So if you take a small example of when the compliance would start of this block TP assessments and how the specificality with which the action points are required to be taken up for evaluation, the timeline for adoption of TPO ALP and the period and procedure of adoption of this ALP are the key questions. So if you see in the example, AY 2627, the form 3CB or the ITR, if it's filed by November 30th, 26, receipt of the first notice, let us assume from AO or TPO, starts with July 2027, and the exact timeline for the TP assessment ends at 31st January 29. Whether during the course of this period, the adoption or the specificality with which the TPO order will come out, whether this period is itself the indication that you can adopt and go for the adoption of this procedure of block assessment is the question. So the possible request of the multiple year assessments is before the appellate proceedings timeline of AY 2627, or he should do it during the course of the TP assessment of the first year is the question. So from that time, 30 days timeline to the TPO has been provided. But when the adoption of this particular block TP assessments is to be adopted and intimated to the TPO is not specifically provided anywhere. So from the 3 years angle now, if it is being looked at from an overall basis, so continuing with the same example, if say suppose my AY 26-27 gets concluded at 31st Jan 29, and assuming that the TPO ALP we got to know on 31st January 29 for the first year, I like the ALP and I want to adopt it for the next 2 years also. But second year is decent enough where I am already closing my books and providing the ITR and 3CB by 30th October 27. So by 31st January 29, while I get the TP order for the first year, I would have closed my books and I know my margin that I maintained as on 30th October 27. So by that timeline, I know whether I can go for the TPO ALP or not. But for the third year, I'll have to do the 30th October 28 filing, and immediately by 31st Jan 29, that 3-month or 90-day timeline, I have to do the compliance. So for all the 3 years, I will be knowing my margin by 31st Jan 29. And the reason and the timeline with which they have kept this intention is now currently AY 22-23 just got finished by this January 29. So there is another 2-year period within which the TPO assessments will be completed. And AY 26-27 and moving forward will be the specific year, 26 financial year, or after 26-27 may be the period in which the next 3 years block will be over. So for whomever are adopting these assessments, they will have to take a call within that brief period on and around the 31st January 29. So the books closure of the second year and third year and the margin at which the TPO is determining by 31st January 29 are the key dates that are required to be kept in mind. So for the second year, I will be ready with my books. For the third year, I'll be ready with my books and filing by 30th October 28 itself. So they have kept the intentional provision of the next 2 years by the 31st Jan 29 is the interpretation that many of them are evaluating. And this is the specific example that was discussed among the PCIDs as well from a TP assessment standpoints are concerned. But overall level, if you see the 92 CA 3B amendment is clearly intimating a certainty among the block assessments of the transfer pricing. But the block rate or the ALP at which you will be knowing by the end of 31st January 29. So you have to adopt a margin as and when you are already experiencing the TP assessments or already knowing what would be the magic number that would satisfy the TPO or fall within the arm's length range, and the exact median with which the TPO is going to propose the ALP from a TNMM perspective is concerned would be the key indicator. So this requires a lot of analysis, and specifically for people who are planning to go for a block period of 3 years, your range indicators and the specific margin with which you are going to file for the first year and planning to do for the next 2 years also will become a key perspective. So the evaluation would be done for 3 years at a time, and margin adoption and implementation, books closure, everything has to be done by 30th October 2028 to go for this block assessment and implement it after 31st January 29 on in and around that date. So it's only a 30 days timeline with which you can push the entire 2 years also. So if you look at the overall perspective with which these parameters are generally being looked at, safe harbor rules, advanced pricing agreements, the regular scrutinies that were happening from TP assessment standpoint right now, and what is the proposed block period assessment period is concerned, the biggest advantage is certainty. Yes, low cost, because people were going for either a 1-year safe harbor. Earlier, the safe harbor rules were also for 3-year period around 2016 in the first block that they have announced, but they restricted the adoption to only 1 year, specifically for the reason that they are not knowing what is happening in the second year and third year. And it has come to the notice of the most of the TPOs that whatever margin that they're giving and adopting in giving that block safe harbor rules, they've kept it specifically for 1 year from a definition, from functional analysis standpoint and the coverage standpoint and the volume of the transaction standpoint. They had to do it, but after the end of the books closure or the compliance. So immediately after you file your 3CB for any year, you are given a specific timeline of 30 days, 60 days for you to go for the safe harbor regulations. And the TPO is required to give back the answer, or if he doesn't give the answer, the safe harbor rules will be deemed to be implemented. That is the current state of safe harbor rules right now. So earlier it was 3-year period. Now it is only 1 year. This specific amendment was brought only because of the reason that what would happen to the next 2 years, how are we able to decide right now was the question. Now, whether or not the same question will come in the block assessments also is the key question that is required to be evaluated between safe harbor rules amendment that was brought in during the 2016 to 2019 period is the key question that many of them are asking in the analysis programs that we are conducting. But from a overall perspective, this is a welcome move because if you know that there is not much of a change in the functional analysis or in the terms and conditions or with the same AE you are going to do, the certainty will easily improve. And in comparison to the cost, timelines, and the effort and the entire administrative wastage that is being done among the APA provisions versus the block period of 3 years, it will be a very good program, provided how is the methodology of assuring the next 2 years prospective period is the key question that requires to be answered from a comparative perspective of safe harbor rules versus the proposed assessment of block period. So if you see the last point, the negotiation standpoint was never there for safe harbors, which will be the same if you are adopting for the TPO ALP directly, of course. But APA will still have this advantage of proposing your benchmarks or proposing your working capital adjustments or the specific amendments that you want in the APA agreement. So that is the only advantage the APA is left with when compared to the overall evaluation is concerned. So APA would generally cover a 9-year period, 5 years forward, 4 years backward. But other than that advantage of 9-year block and the negotiation aspect being on the table, there's not much of an advantage that I'm looking at people going for APA anymore if they are going to make this block TP assessment provision successful. So this is the comparative that we could think about from overall perspective of different programs or assessment standpoint is concerned of the past and the future. From a certain seizure standpoint, most of the questions were coming. When does a specific case get referred from the central circle or the search and seizure assessment block period is concerned to the TPO? And when it is referred, whether the income that is being evaluated, whether the arm's length that is being provided by the TPO is to be considered under the normal provisions, or it is to be considered under the special provisions of 60% or any other higher tax brackets. Now, the amendment which is brought about specifically is the fact that the evidence during the search was the specificality before the amendment. Now, they have specifically included the word income from the international transactions, and they have made sure that this income which is being evaluated and brought to assessment should be taxed under regular provisions. It's a very good amendment, and this was being subjected to a lot of confusion during the course of the search and seizure proceedings, especially when the underlying transaction was international SDT. But the overall period with which the block assessments of the past versus the block assessments of the TP future 3 years is still a different concept altogether. 1+4 backwards, the search TP block search assessments will be conducted, the block assessments. But going forward, block TP assessments are for the future of 1+2. So 1 year for current 26-27 and 2 years going forward is the key. So timelines wise, the specificality tax bracket wise, and the inclusion and exclusion angle and specific provision of income and not the evidence is the key parameter sea change that they have brought about. So from overall perspective, if you see earlier from a risk assessment standpoint is concerned, 3/2016 specifically used to mention the last phrase I would read out, wherever search and seizure proceedings have been carried out under the provisions of the Income Tax Act and findings regarding transfer pricing issue in respect of international domestic transactions or both have been recorded by the investigation wing or the AO. That was the specific mention in the notification. So wherever there is an underlying transaction and there is a record that the investigation authority is mentioning that this is the major reason and there has been an escapement and there has been an intentional non-disclosure is the fact that they would refer, the reason for reference would have been this specific point. But now the reference point is not specifically being changed, but the impact with which they are going to change and the inclusion, exclusion, and where you are going to subject it to a tax rate are the key changes that have been proposed as a clarificatory note. From a safe harbor perspective, it was mentioned in the speech or by the by the speaker, Honorable FM, that the safe harbor rules will be rationalized in terms of expansion of the definition, in terms of expansion of the coverage of industries, or the intention is to rationalize the margins as well. But the question that still gets unanswered is the reduction from 3 years to 1 year of the safe harbor earlier versus 1 year to 3 years of TP assessment are the key changes of how the government is going to justify is the key question on the overall coverage of block TP assessments angle is concerned right on the day of the first year end. But from issues being identified or the relevant representations being made, there are several industries or the definitions which are making it as an obstruction to this program overall. So if the definition part is being evaluated only from a intercompany agreement coverage is concerned, that would be a wrong aspect, and maybe they're going to announce a site visit angle also is being discussed, and maybe it will be clarified by the bill or any other provisions of the amendments to the 92 CBA or the Rule 10D. From a faceless assessment standpoint is concerned, there were a specific deadline with which the implementation of the TP assessments, faceless TP assessments were also being implemented, or 31st March 2025 was a specific deadline, but they have removed this deadline in the specifics, and they made sure that the intention of moving TP assessments toward the faceless scheme is no more, and it might be a hybrid or it might be a complete physical thing is yet to be clarified, but it is clear that they're not going to change it to a faceless scheme. So I think I've covered all the aspects of TP assessment or the TP provisions amendments in this budget. So handing over to you, 𝐶𝐻𝐫, Taxmann team.
Thank you so much, sir. It's a pleasure having you.
Yeah, thank you.
So there are a couple of questions. Should I take it?
You have time, you can take it. No problem. Yeah.
Yes. The first one is, can SSC change the TP method in next 2 years once he exercised the option of newly proposed safe harbor rules?
See, they've only mentioned that TPO ALP that is being determined for the first year will be adopted by the SSC. So it means that there may not be a specific flexibility in changing the method as such when they are specific to sticking on to the ALP being determined by the TPO. I think it should be the same approach with which the TPO will determine. So it's not our methodology that we are going to present. So we are going to stick to his ALP, and the way in which it might be done also mostly was intending towards TNMM. So I'm not seeing any other method intention coming in. RPM can also be a specific intention, or PSM can also be a specific intention. But the point that I'm trying to tell you is they made the language as ALP. They never mentioned anything specific to method as such. So there is not much of a flexibility that I'm expecting. So it will be the TPO's methodology that you have to replicate for the next 2 years.
Okay, correct. The next query is, do you think the advanced pricing agreements will lose their shine after the introduction of safe harbor rules in TP?
See, APA was always a very good program, intended program by the government. If you see in comparison to the global APA versus the Indian APA methodology, we are, having almost around, 100 plus or 200 plus cases only pending from Hyderabad, which are yet to be, adjudicated. But the point that I'm trying to tell you is the methodology requires administrative support. So there is not much of a support that is being announced or provided by the government. So that's the only reason. And the cost was very high. And the timeline at which the closure or the rate of closures were also being, very, very slow. So the rate at which they are going to announce the APA after 3 year, 5 year period of the efforts are also very high. So these were the limitations with which it lost its charm. But I'm definitely sure that the safe harbor rules, rationalization, and 3-year block period will hit the number of APA applications for sure. So it's going to be a good impact to the APA. So they're going to be a setback is what I would see.
Okay. So there's one question in the chat box, that is, in a block assessment, if a SSC has say 5 different international transactions and opts to go for a block assessment for 2 of them, given that the same are ordinary or repetitive transaction, can the SSC choose to go for APA for the remaining 3 transactions?
So that's what I presented during the clarification that are yet to be announced. So single transaction versus multiple year transactions, whether you are allowed to do a partial block assessment and adoption for a few transactions among multiple is the key question that is required to be answered. I think they will come up with the clarification. It should be made available to the SEC.
Okay. Let me check. Is there any other query? Anyone, please drop your queries in the chat box. Sir, there's one general question, that is, the focus of government is to simplify the Income Tax Act. What, according to you, with a focus on the new income tax bill, will be introduced by the government in the next coming days?
The overall idea with which they are going to announce the new bill and the implementation might be to simplify it, but there are a lot of implications from international tax angle and DTA angle that are revolving in the international tax and TP professionals. Is the fact that how are we able to justify the MFN clauses or the DTA provisions in comparison to the Income Tax Act and all the agreements that we have already signed globally, and how is it going to be rationalized in terms of the language angle is concerned is the major question. So there may not be a sea change in the way in which they are going to administer the law from tax collection or tax rate angle is concerned, except for reducing the tax rates and making it easy for the public. But from administrative angle and assessments angle and transparency angle, certainly this government is going to make a major change is what is the expectation. So overall, they made sure that deductions and other incentives, wherever the lacunas are being removed, and they're rationalizing the tax rates. So that's the good area. But the uncertain area is how are we going to clarify still the interpretational issues or the jargons and the way in which the law is being interpreted by the tax authorities would only come from practice of the law that is being preached. So we have to wait and watch.
Okay, so there's one more general query, that how would you read this budget proposed by the government recently?
See, it's a very good budget as compared to the last 9 years or 8 years that this government has done, so especially from the personal taxation angle and the deductions angle is concerned, or the rationalization of tax angle of the middle class is concerned. But overall level, if you see, they are moving towards the global practices. They are adopting the global methodologies on one side. They're also making sea changes in the personal taxation and making the public also happy. The mid part in terms of the collections or the VSV schemes, which are being implemented every 2 to 3 year period, is also an indication that they want to close all the pending assessments and the overall period that is being allowed for the tax litigation angle is concerned. So they're not interested to keep so many cases pending. So the deadline with which they are intending to close the overall process is very, very commendable. But the way in which the tax authorities or the department angle or the bureaucratic angle is being implemented from faceless mechanism is concerned has a mixed review. But specific to TP and international tax, if you ask me, this is a very good perspective with which they have done the amendment. So I have mixed reaction, but this budget specifically is a very good budget in compared to the last 9 years.
Okay, perfect. So there are a few more queries. Should I take it?
Yeah, you can. If you have time, you can, please.
Okay. So another is, what are your suggestions on transfer pricing for the upcoming new income tax bill to government?
So I would say most importantly, the safe harbor would be the key for me, because we have to be very clear for the global companies or MNEs that are coming to India, and there has to be absolute certainty with which you are going to implement the law. If you see in comparison to UAE, which is very recent for transfer pricing assessments or TP provisions implementation is concerned, they have given a very detailed guide on each and every aspect of law. We do not have that. So the point is, when you keep the provision in few pages and leave it open for interpretation, it leads to this litigation. So why don't we create the general guidance and expectation very clear by giving a guide by the government itself and making it very clear on what the intention is and what's the coverage. And there should not be a absolute, it should be very clear from an interpretation and execution angle is concerned, and thus it becomes certain. So that confusion angle should never be there is what my idea is. So wherever all these confusions or expectations will come and are going to come should not be there. There should be an absolute deadline with which they come out very clearly on the transfer pricing guide. And I hope to see it very soon, if at all they are going to consider all our queries or the expectations or the recommendations. I think it will be fantastic.
Okay. So there's one more query, which is related to personal taxation. Can I take it?
I'm open, but if you want me to take this, I'll take it. No problem. Yeah, please.
Okay. So as the government is focusing on new tax regime and coming up with the new tax bill, do you think the old regime will be scrapped off in the coming years?
Yes. I'm open, but if you want me to take this, I'll take it. No problem. Yeah, please.
Okay. So as the government is focusing on new tax regime and coming up with the new tax bill,
I think there were some problems in here. I think Sandeep sir is already.
okay. So as the government is focusing on new tax regime and coming up with the new, I think there's some network issue. Let me check.
I think Sandeep sir's mute was the problem.
Yes.
I think you can take over for Sandeep sir now. Yeah, please. Yeah.
Okay.
Thank you.
Thank you so much, sir. Thank you so much. It's a great learning from you. Thank you. Moving further to our next session on the changes in merger and acquisition, we are pleased to welcome Sandeep Jhunjhunwala to provide his expertise analysis. Mr. Jhunjhunwala leads the Corporate and Merger and Acquisition Tax Division and Emerging Law Practice at 𝐁𝐝𝐲𝐽 in India, bringing over 16 years of international tax and strategic advisory. We are pleased to welcome Sandeep Jhunjhunwala. I think, let me check once. Yeah, it's fine now. Let's start it again. Mr. Jhunjhunwala leads the Corporate and Merger and Acquisition Tax Division and Emerging Law Practice at 𝐁𝐝𝐲𝐽 in India, bringing over 16 years of international tax and strategic advisory experience from top Big Four firms. He oversees key relationships with global partners, particularly in the USA, UK, and Ireland, and is integral to Ederson's technology, real estate, and employment law group. Mr. Jhunjhunwala advises on corporate international tax, cross-border structuring, and controversy management, often working closely with the regulators to shape policy. A frequent speaker, columnist, and broadcaster, he has served as an honorary member and authored Decoding RERA, a guide on real estate. Welcome, sir. How are you?
Hey Divya, hi. Thank you for the introduction. I hope I'm audible.
Yes, sir, you are audible.
Okay. Good evening to all the participants. I'll just share my screen as we speak. Divya, can you please confirm if this is visible?
Not. Yes, sir, it is visible now.
Sure. Thank you.
Okay.
So good evening, all participants. I think in this segment of the Taxmann Marathon Budget 25 related discussion, we are going to talk a little bit about the policy announcement that was made in respect of fast track mergers and a key amendment, though it's on the detrimental side, for M&A related activities. So and a third one, which is in terms of a clarification that has come from the government, to clarify what position should be taken as far as characterization of income is concerned for transfer of any securities by AIF. So these are the broad three topics that we are going to discuss through this M&A segment of the budget marathon. Now, coming to the first one, as I said, this is more of a policy announcement, and Honorable Finance Minister, as a part of her budget speech, I'll just read that out for the benefit of the audience here. She said that the requirements and procedures for speedy disposal of company mergers will be rationalized. The scope for fast-track mergers will also be widened and the process made simpler. So this comes as para number 101 in the budget speech of the budget 2025 by the Honorable Finance Minister. So it's more of a policy announcement. There is, it's more directional in nature. There is nothing tangible at this point in time. But let me take a moment here to, apprise the audience about what kind of pendency are we looking at the NCLT level when it comes to approval of various matters, which goes through NCLT for multiple applications. So, NCLT technically gets matters from two different statutes as I speak. The first is the Companies Act, where Section 230 to 232 dealing with matters related to, say, for instance, compromises and arrangements, corporate debt restructuring, capital reduction. Those kind of applications are under Section 230 to Section 232 of the Companies Act. And then we have Section 233 of the Companies Act, which deals with fast-track mergers. So under the Companies Act, these are the two streams, and definitely a larger, influx of the matters as far as approval is concerned goes to NCLT from the IBC-related cases. So if we look at the published statistics, what we see is, what is depicted as the chart on the table is the kind of pendencies that we have at the tribunal level. These are based on the applications received and considered by the regional directors. If we look over a period of time, both in this segment, which deals with 230 to 232, as well as in Section 233, what we find is that technically the opening, the opening burden of the cases doesn't get sorted. So this 490 is the opening here. 841 represents the matters received during the year. 819 is the disposal. And then 512 is the applications pending at the end of the year, which technically remains the same across, right? Even in 233, if we look at the fast track cases, and the last year as an example, for instance, for the purpose of this discussion, we had 173 as the opening, pending application at the beginning of the year. Almost 450 applications were taken up during the year. Disposal is around 508. And technically, we are left with almost the same set of application as pending at the end of the year. Also, an important fact here is that if you look at the NCLT caseload based on the data published by the NCLT, interestingly, it says that 95% of the cases are disposed. Now, I'm not too sure because what we have been seeing is that at least from a disposal standpoint, NCLTs are taking nowhere less than 1 year to 18 months. So 12 to 18 months is the minimum timeline that we are seeing at NCLT level for matters to get disposed as far as Companies Act applications are concerned, whether it be under 230 or 233. But the NCLT website tends to probably give a picture where it says that starting from 2016 until October of 2024, there were close to around 18,336 cases which were taken up, and around 17,324 cases which were disposed, which means that the cases pending are only close to 1,000, giving it almost a 95% strike rate for the disposal of the matters. As I said, maybe the statistics is not quite clear to me here, but there's a definite need for simplification and the rationalization of the overall merger and the reorganization process, a part which the FM also acknowledged as a part of a budget speech this year. So all this will bring is maybe enhanced efficiency, attracting investments, ease of doing business, boosting the economic activity, etc. If at all the process is made a little more efficient. Now, talking about the fast track merger, currently under Section 233 of the Companies Act, a fast track merger is available only for limited segments. For instance, if it is about a merger of two or more small companies, a small company being defined as a company where the paid up capital doesn't exceed 4 crore and the turnover as per the immediately preceding financial year doesn't exceed 40 crore. So this is the threshold for a small company, which is defined under the Companies Act. The second avenue is when it is about a merger between a holding company and its wholly owned subsidiary. The third is about a merger between two or more startup companies. Startup companies is again, defined by the DPIIT. There's a notification that was issued in 2019 to define what are the startup companies. There are certain segment of companies, say for instance, if a company has any foreign asset or a liability, if it is a subsidiary of an overseas company, those categories of company are specifically excluded. And the fourth category is a merger between one or more startup companies with one or more small companies. So these are the only four broad segments which gets eligible for a fast track merger. Now, as I said, as a part of the FM speech, she mentioned that the scope for fast track merger will be widened and the process will be made a little more simpler. Now, we have been taking some steps, toward widening the scope of fast track merger. In September last year, there was an announcement to, make that process a little more simpler, where it was stated that NCLT approval will no longer be required for cross-border mergers, and it will work only with the RD approval along with RBI. So NCLT approval will was no longer made as a requirement for cross-border merger, in the case of a merger of a foreign holding company with a wholly owned subsidiary in India. Now, this obviously was, intended to promote the trend of reverse flipping of structure, the inbound flipping, which we had seen in some of the cases which I have tried to highlight on the slide. Say in the case of Pepperfry, PhonePe, Grow, Zepto, these are all the cases where we are seeing companies which had actually set up outbound structures externalized in the past. They are now looking at flipping back, internalizing, and coming back to onshore in India. Now, definitely some steps are already being taken, and maybe post this budget speech or the budget announcement, the government may possibly look at widening up the scope. And I think it's important that we look at some of the recommendations that were made by the Company Law Committee and some of the industry recommendations to, ensure that the scope of the fast track merger is broadened a bit more. So what were the key recommendations? They first said that the merger of a holding company and any of its subsidiary, whether then it's a wholly owned subsidiary or otherwise, should be covered under fast track. The mirror demergers for listed companies should get covered under fast track. In fact, I mean, the last bullet point, which is the merger of two or more unlisted companies, the ask was that only listed company related mergers should go to NCLT for approvals. Other than that, if it is a case of merger of two or more unlisted companies, which are typically private limited entities, then it should not even be subject to NCLT approvals. Having said that, all of these are recommendations which have been made by the Company Law Committee and from the industry at large, but we have to wait and see for more concrete discussions and maybe announcements by the government to show all these recommendations the light of the day. This slide talks a little bit about what are the existing challenges in the NCLT merger process. As I was trying to highlight at the beginning of this discussion, we only have 16 benches, including the principal bench of the NCLT. So technically, if we look at the per bench caseload, it's quite high. In fact, some of these benches are not even operational. So 16 benches are the one notified, and not all of them are operational. So technically that also creates a block in terms of efficacy when it comes to dealing with this kind of matters. Obviously, most of the NCLT needs to be digitally improved when it comes to improvement in digital infrastructure. Setting up some of the standards, say for instance, some template-based submission schemes, orders, etc. I think those are the issues that definitely needs to look at. And again, as far as declogging the NCLT is also concerned, there were certain recommendations which were made in the past. Like for instance, today, if we have a company where the jurisdiction of both the entities which are undergoing merger needs to approach the NCLT in their respective jurisdictions. Now, a ask there could be was it should just go to the NCLT of the transferee jurisdiction and not add up to the case also for the transferee jurisdiction. There were also recommendations in terms of use of technology, use of certain procedures, standard templates, submissions, etc. The reduction in the consent thresholds, because end of the day these are privately held companies, so the existing the threshold of 90% possibly could have been reduced to say 45 to 75% of the value, or maybe a 50% of the shareholders representing 50% of the total value of the shares in the company. So all these recommendations have been made in the past, but we'll have to wait and see when it sees the light of the day. So this is on the first policy related announcement related to merger of the companies, where the FM acknowledged that there is a need to make it a little more efficient, and we'll have to there is finally given implementation. Now, coming to the most debated topic in terms of carry forward of losses in the cases of amalgamation, the change which was brought in Section 72A and Section 72AA of the IT Act. Let me just take you through a little bit of history of Section 72A first, and then we will deal about what are the amendments. Now, 72A typically deals with succession of business in the case of say a merger or amalgamation, where the loss of a predecessor entity is allowed to be carried forward and utilized by the successor entity. And this was introduced way back in 1977. So it's almost a 5-decade-old provision. And what surprises me is that probably it took 5 decades for the regulators to ascertain that this is an area which possibly requires an amendment. In fact, 72A and 72AA are pari-materia sections. 72A applies to undertakings which have manufacturing setups, which owns a ship or a hotel, etc. Whereas 72AA applies to banking companies as well as government companies. Now, otherwise, the basic structure and the construct of both these sections are the same. They carry a specific anti-avoidance rule in the section itself, which says that the eligibility for carry forward of losses under Section 72A is to be given only if there is a business continuity and there is a book value of the fixed asset which is continued to be carried over by the amalgamated company. So therefore, technically, 72A in itself carries a specific anti-avoidance clause. It also says that the company should probably be undertaking this amalgamation or merger only for genuine business purposes. There is also a Rule 9C which is related to 72A, which has certain conditions additional to what is given under 72A, which includes that there's a requirement to reach a 50% installed capacity before 4 years of whatever was the capacity before 4 years before the amalgamation, and continue till the end of the 5th year with that at least 50% of the installed capacity. And there is also a requirement to file a Form 62, which is issued by the principal officer of the amalgamated company, and verified by a chartered accountant. So therefore, a question comes up is, was this amendment really required to be put in place? Because all this while the government has been saying trust first and scrutinize later. But I really don't understand why this, amendment was really brought into place. Now, if you look at the explanatory memorandum to this, which is very important for us to understand as to why this this amendment was brought in, it says that in order to bring clarity and parity with the provisions of Section 72 of the Act, it is proposed to amend Section 72 of the Act to provide that any loss forming a part of the accumulated loss of the predecessor entity. So technically, what they are trying to say is that this is brought to bring clarity and parity. And it also says that the proposed amendment is aimed to prevent the evergraining of the losses of the predecessor entity resulting from successive amalgamations. And we will talk about how this evergraining of losses happens. Now, in the example here, we have a company A where, say, for instance, the company A in assessment year 13-14 has incurred business losses and it is carrying it forward. Technically, as per the requirement of Section 72 of the Income Tax Act, it can be carried forward only for 8 successive assessment years. So we started with assessment year 13-14, can be carried forward as per Section 72 up till assessment year 21-22. Assume that the company A merged with company B in assessment year 19-20, right? So as per the current Section 72AA, there is a reset at this point in time, right? And therefore, the reset allows company B now to carry forward the losses of the predecessor entity, and the 8 year will be now counted from AY 19-20. So from 19-20, again, I'm allowed to carry forward the losses from 19-20 up till 27-28. Now, assume that there is a second merger that happens between company B and company C. This reset again will happen here, and then I can again carry forward the losses here from here for the next 8 years. So technically what we are seeing is the losses which originated from company A here, which technically should have lapsed only in assessment year 21-22, is now allowed to be carried forward, indefinitely. Now, this could be a case where there could be a successive merger happening and the loss never lapses, right? So this is what the government felt was a problem statement. We also have a ruling in the case of Supreme Industries, which has blessed this position. They have in this ruling clearly said that there is a reset and there is a fresh lease of life given to the business losses. And, therefore, the losses never lapses in this kind of transactions. So therefore, the idea was to include an amendment in the finance bill, which they have done now. They have now said that the losses cannot be carried forward beyond what the original section, which is 72, permits them to do. They have now inserted a subsection 6B in the main section 72A. So as far as 72A is concerned, they have inserted subsection 6B. As far as 72AA, which deals with banking companies and government organizations, they have inserted this by way of a proviso. Now, what kind of structurings are covered by this amendment? Amalgamation, succession of a private company or an unlisted public company by LLP, and the succession of a firm or proprietary concern by a company. We spoke about the rationale. First is clarity and parity with Section 72. Second is evergreening of losses has to be, prevented. But I mean, I really don't know why a 1977 introduced act, a section took so long for the government to decide that this kind of amendment is required. Another aspect is that there was a carve out for demerger, which was made in 72A in 1999 by introducing subsection 4. So in the case of a demerger, actually, the demerged entity doesn't get a fresh lease of 8 years, and it has to be carried forward and utilized only as per the basic construct of Section 72, which is 8 years. But Even at that point in time, it was not thought through. And now possibly the government feels that, maybe based on some of the transactions or the volume of transactions that may have been happening recently or of late, they felt that this restriction is required to be brought in by way of an amendment. So let's take the case of a merger. We have a company A. We are talking about assessment year 2021. Business loss can be carried forward for 8 years, which is 28-29. Up till 28-29. We have a merger of company A happening with company B in assessment year 26-27. Now, technically, as I said, the losses of AY 2021 can be carried forward only till AY 28-29. I will not get a fresh reset of 8 years at this point in time. And therefore, the entire losses will lapse if not utilized by end of AY 28-29. Let's take a case of a successive merger. Company A, assessment year 15-16, losses can be carried forward for 8 years. So 15-16, we can carry forward to only 23-24. Let's assume that there was a merger of company A and company B in AY 21-22. I can actually carry it forward only till 23-24. So for some years, some of the losses can be carried forward because AY 21-22 is before 23-24. But as per the earlier provision, there should have been a reset here, which will not happen. And the losses can be carried forward now only up till AY 29-30. So therefore, this is what the business loss of company A for AY 15-16 can be carried forward only till 23-24. And company C will not be able to utilize the losses which are pertaining to the original predecessor, which is company A in this case. So therefore, one thought is that if merger of company B with company C had not been taken, then company B could have carried forward and utilized losses up to 29-30. As the merger of company A with companies B is affected prior to April 1-25, and therefore the current reset related restriction would not have applied in this case. So this is how my successive mergers will get impacted going forward. We have given an example by way of a tabulation. I'll help you decode how this table is. We are talking about 4 consecutive mergers happening. These are 4 successive mergers. This row talks about assessment years. We have first event, which is company A merging into company B. Then we have that company merging into company C. Then we have that company merging into company D. And the last merger is with company E. So merger 1 relates to merger of company A with company B. Merger 2 relates to this company merging with company C. Merger 3 relates to this company merging with company D. And merger 4 relates to the final merger, which is D into E. So this is how the interplay of all the numbers would be. These are the different assessment years which are listed out. Let's assume that the company A has been incurring losses to this extent, which is 20, 25, 15, 20, and 10. So therefore, on an overall basis, I have a cumulative business loss of 90. I have a company B which has, a loss of 20. And in the year of merger, I have a loss of 10. So this 100 comprises of 90 and a 10, which is a standalone merger of. So 90, which comes from here, and the 10 is the standalone loss of company B, right? And similarly, we have case where, company C also had, losses on its own, company D having losses on its own. The total pooled loss, if we look at it, is 310. Now, the question that arises is that after implementation of this new subsection 6B, which has been inserted in 72AA, is company E entitled to take this cumulative 310? Because this 310 is a number which is cumulative of all these past year losses of the predecessor entities. Now, the answer to this situation is here. The accumulated losses aggregating to 170 crore will lapse post-merger in AY 26-27. So this company A related loss will fully lapse. So this green is the 8 assessment years that we're talking about. We are in assessment year 26-27. I can go back 8 years, and therefore I'll have to stop here. So any losses which are beyond this will all lapse. And this is what the answer here is. Company A losses 90 crore will lapse, B's 65 crore will lapse, and company C's 15 crore will lapse. Loss of assessment year 18-19, which is 25 crores, could be set off against the income of 26-27. So this is the benefit that one gets only, for the year in which that, utilization has to be done. And the accumulated losses from 19-20 onwards, which is a cumulative of 115, can be carried forward to 27-28 and subsequent assessment years, subject to the 8-year limitation limit. So this is how this entire thing will, work out. So it just makes the entire problem a little more complicated for company E, because if section, subsection 6B was not there, then company E need not even look at all these breakdowns of losses assessment year wise, and for the predecessor companies, it could have easily just taken over this 310 completely and utilized it for 8 subsequent assessment years. So this is how maybe mergers, successive mergers going forward have to be dealt with, to see which are the losses that lapse and which are the losses which can actually be carried forward and utilized by virtue of section 72 of the Act. Another important aspect is here, it says the way the finance bill reads out, it says that this 6B will be applicable to amalgamation or business reorganization which is affected on or after 1st of April 2025. It uses the word affected. Now, the word affected is not defined. So therefore, one view is, will I look at the date of the order sanctioning the merger, or will I look at the appointed date, which is the date from which the order is effective? So technically, the view is that, say, for instance, there's a company A where assessment year 2021, you have a business loss here. Loss can be carried forward up till 28-29. Now, view 1 is that if I look at the date of order sanctioning the merger, if the order date, say, for instance, is October 1, 2025, it falls into the next year. And therefore, as per view 1, the loss can be carried forward only up till 28-29, which is up till 8 year. The view 2 is, if I go by the appointed date, if I mean to say that the word affected would mean appointed date, then 6B itself doesn't apply. The new amendment doesn't even apply on this, because the appointed date is prior to the date on which this amendment has been made, and therefore loss can be carried forward for fresh 8 years, starting from the date of the appointed date. So technically here also in the case, there's a ruling in the case of Marshall Sons, and that ruling is from the Supreme Court. It's a 1997 ruling from the Supreme Court in the case of Marshall Sons and Company. They have clearly laid out as a part of the ruling that every scheme of amalgamation has to necessarily provide a date with effect from which the amalgamation shall take place. The scheme concerned herein doesn't provide the date. It is true that while sanctioning the scheme, it is open for the court to modify the said date and prescribe such date of amalgamation or transfer as it thinks appropriate in the facts and circumstances of the case. If the court so specifies a date, there is little doubt that such date would be the date of amalgamation or the date of transfer. But where the court does not prescribe any specific date, but merely sanctions the scheme presented to it, as has happened in this case, it should follow the date of amalgamation or date of transfer as the specified date in the scheme, which is nothing but the appointed date. So we'll have to wait and see if there is any more clarity which is given by the department on what will be seen as a date from which this could be seen as being affected, whether it is the date of the order or whether it is the appointed date. Another important aspect that comes here is the way 6B has been written out. It says that, it gives reference to the original predecessor. It says that the deemed loss of the successor entity to be carried forward for not more than 8 assessment years after the assessment year in which the loss was first computed for the original predecessor. They use the word original predecessor. Now, there are 2 ways of interpreting the word original predecessor, and it has not been defined so far, not even under the finance bill. If I look at the literal interpretation, then the restriction on the carry forward of the loss should apply only to the accumulated losses of the first predecessor entity. Whereas if I look at the purposive interpretation, then it should apply on all the losses so far. So let's look at a quick example here. That we have a company A where there was a loss of 100 crore pertaining to assessment year 13-14. This loss could have been carried forward for 8 years up till assessment year 21-22. Assume that there's a merger of company A with company B in AY 1920. And this company B also had its own loss of 40. So we have a loss of 100 and we have a loss of 40, 140. Assume that there is one more merger which is happening with company B with company C, which is in assessment year 25-26. And company C has its own standalone loss of 50 crore. And then the fourth merger is happening between company C and company D. So we have to decide what will be the eligibility of company D to carry forward the losses by interpreting the word original predecessor in this case. Now, whether the restriction of the carry forward up to 8 years will apply to the accumulated loss of company A, which is only 100 crore, or will it apply to 100 crore plus 40 crore in this case? So this is the question that we have to wait and see. In my view, it should apply to all the, all the losses which gets accumulated prior to the last merger that we're talking about. And therefore, in my personal view, a purposive interpretation is more suited in this kind of scenario, but we'll have to wait and see if the government comes up with any clarification on this kind of situations. The second amendment is in terms of, deciding the taxability arising on account of transfer of securities for AIF. All this while there has been an ambiguity in terms of the characterization of income when it comes to transfer of securities by Category 1 and Category 2 AIF. Positions were taken in a divergent way. Some of the AIF were considering that income as business income, which was taxable in the hands of the company or the LLP, in whichever way that AIF was structured at the normal rate. Or if it was structured in any other legal form, then it was taxable at MMR. In the case of a capital gains, the taxability was in the hands of the unit holders on a pass-through basis. But things were not very clear and it was leading to some sort of a litigation. So it has been now clarified that any security which is held by a Category 1 or a Category 2 AIF, that will be considered as a capital asset. They have brought in by way of amending the definition of the capital asset in section 214. And accordingly, any income which arises on account of transfer from, from the transfer of securities will be characterized as capital gains. Now, this position is actually consistent in terms of the earlier CBDT circulars that we have. There are actually 4 circulars that one can read. One is a 1989 circular. The second one came in 2007. The third one came in 2016. And there's a fourth one which came in 2016 itself in May. Now, all this while, it was made very clear that for unlisted shares, income arising on transfer of unlisted security will always be considered as a capital gain, irrespective of the period of holding. But what was important is if there is a transfer which happens with transfer of control and management, then it may still not qualify as capital gains. Now, one thing to note here is that in the case of CAT 1 and CAT 2 AIF also, this transfer of securities could happen with or without transfer of control and management. But now with this overarching clarification coming in, I think this ambiguity goes away, at least in the case of AIFs, and the income has to be taxed as capital gain itself. So the way it will work going forward is that it will be taxable in the hands of the unit holders. So if it is a short-term capital gain on listed equity shares, it will get taxed under 111A. If it is a long-term capital gains other than listed equity shares, it will get taxed under 112 and under 112A for the listed equity shares, and at normal tax rate for any other securities. Because it's about transfer of securities, it will cover equity instruments as well as non-equity instrument, which could be convertibles, etc. So this is going to provide a lot of tax certainty, at least to the AIF CAT 1 and CAT 2 segment. as far as the taxability on account of transfer of security is concerned. So these were some of the key amendments that have taken place in the sphere of M&A. I hand it back to the Taxmann team just in case there are any questions. We can possibly take it up now.
Thank you, sir. Thank you so much for this insightful session. Let me check if there are some queries.
Sure.
Anyone, please drop your queries in the chat box. So there's one query. How simplification of fast-track merger will benefit startups?
See, I think the time that overall is taken for disposal of applications at the NCLT level in itself is, quite overwhelming. So I think the way it will, positively impact the startups is that the moment it falls under a fast track scheme and things are ironed out and made more efficient the way we spoke about, that possibly can get reduced to 3 months or 6 months maximum. So the way to look at it is it will benefit the startups maybe by reducing the timelines and maybe a little bit of lesser documentation that may be looked at by the government, specifically for startups, for them to be looking at a fast track being made more attractive to them.
Okay. Let me see. Is there any other query? Just 1 second. So there's one a general one. That is, how would you rate this proposed budget?
See, I think the budget definitely has been quite balanced. From a common man personal income tax standpoint, definitely it has been a blockbuster, right? So if I were to rate it from a corporate standpoint, maybe nothing which catches the attention for the corporate world. So maybe a 6 out of 10 on that. But when it comes to personal income tax, maybe 10 out of 10.
Okay. So there are a few queries in the comment box also. Let me take this also. Will these provisions also apply to reverse mergers?
No, this will, at least 72A will not apply in the case of a reverse merger. This will generally apply in the case of reverse mergers. If it is a domestic reverse merger, then possibly yes. But if it is, when you're saying reverse merger, it could also be about a foreign company merging into an India entity, then possibly not.
Okay.
I think I can see the second question. It says, any impact on carry forward of depreciation? No, the answer is no. This is only about plugging in the business losses under Section 72. Unabsorbed depreciation can be carried forward indefinitely.
Okay. Let me check others also. Is there any query? So I think there's no query. Thank you so much for this session.
Thanks.
Thank you so much, sir.
Bye.
So before we proceed to discuss amendments in other laws, we have last crucial session on income tax covering block assessment, appeals, and capital gains. To guide us through the recent amendments, we are joined by Darshak Shah, partner at S&P Company. Mr. Shah is a chartered accountant and partner at S&P Company, leading the corporate tax advisory and business analytics practice. Having previously worked with KPMG and N.S. Shah Associates, offers extensive commercial and legal practice. His focus areas include corporate and HNI tax, litigation, international tax, capital gains, personal taxation, business automation, and analytics, and estate planning. A recognized speaker and author on tax topics, Mr. Shah has guided over 100 SMEs in scaling to large-scale enterprises by leveraging businesses analytics and structured data. Welcome, sir. Over to you now.
Hi, how are you?
I'm good. How are you?
Absolutely fine.
Uh,
Yes. Shall I start the presentation?
yes.
Okay. So very good evening to all of you. And today the task which has been given by Taxmann to me is related to assessments and related topics to assessment. So what are we going to cover are basically the changes which has happened in block assessment. So that's one of the major change, or what the changes which has happened is only in relation to block assessment. So that's what we are going to discuss today. The second thing what we are going to discuss is about change which has happened in updated return. And the third thing what we are going to discuss is capital gain. Block assessment. So in block assessment, what one change which we have been able to notice is that previously this particular block assessment was supposed to be completed within 12 months from the end of the month in which the last authorization is made. So now what the change which they have done is that instead of completion from the month, it is from the quarter. So 12 months from the end of the quarter in which this particular uh, completion of block assessments is supposed to be made. The next thing which they have brought out is what is that? So they have this is something which is already there, where in case if suppose the time for the
Hello.
time, yes,
I'm so sorry to interrupt in between, but your screen is not shown, the PPT.
you're not able to see the screen.
No, your PPT is not visible.
Okay, just give me 1 second.
Okay. Now it is visible.
Okay, just give
Yeah,
me 1 second.
yeah, but it's gone again.
Okay.
Uh,
Hmm.
do we share the screen, or you will share the screen?
I am trying to share the screen, but maybe I'll just start the presentation. I'll at least brief about what is the outcome, because what we are going to discuss about is on the amendments, and I will be able to share this even without the screen. However, my team is going to connect me on with the screen, so it may take 1 or 2 minutes, but till
Yeah,
that time we
perfect.
can at least go ahead with the presentation.
Yeah, sure.
Yes.
You want us
So,
to share the screen? We can do that also.
so even you can do it. Then I'm absolutely fine, ma'am.
Okay. Just a second.
Yes.
Is it visible?
Yes, it is visible.
Okay, perfect.
Uh, yes. You just need to take me to the next slide, please, ma'am. Okay. So, it is visible. Okay. Thanks, Sanjeev. Sanjeev, thank you very much. So the first amendment which is there is in relation to the time limit. So as we are aware of, 12 months is the time limit within which the assessment needs to be completed, the block assessment. So they have said that 12 months, previously it was 12 months from the end of the month. Now they have extended it and they have said that 12 months will be from the end of the quarter. So once the search is getting completed, the last authorization has happened. From there, the quarter ending, and from there, 12 months is what the time which will be available. So just as an example, let's say the 1st January is the starting period and 31st January is a closing period. Then the quarter ending is March, and therefore the time limit which will be available will be March 26. Now here there will be one extension. So in case if supposed to hand over the documentations, etc., if they have taken time, if the investigation team have taken time in handing over the documentations, which is to the extent of, let's say, the 180 days, not exceeding 180 days, then that particular period will also be included and it will be extended. So there will be a 3 months extension which will be provided if suppose there is a delay in handover of the documentation to the assessment team. Can we go to the next slide, please, ma'am? Ma'am, can we go to the next slide, please? Uh,
Just a second.
yes, ma'am. Okay. From the computation perspective, so what is basically the change which has happened is that in case of undisclosed income and normal income. So previously, if we see the computation, I'll just connect you to the next slide. So ma'am, I would request you to go to the next slide of the presentation. Yes. So this is an important slide. Now, if you see what is the provision which was there and what is the amendment brought out over here. So previously, the provision was saying that if the total income is it is the returned income, it is an assessed income, or it is an income which is disclosed under 115, 100, 158 BC. So that particular income will be considered any amount which is identified during the course of the search, that will be also included and that will be considered as undisclosed income, right? So the tax which is going to be calculated, if you see this particular example, the example is saying that 65 lakh was my returned income, my assessed income was increased by 5 lakhs, so 70 lakh is my 70 lakhs is my assessed income. Now, that 70 lakh, when I have filed my block return, so block return, I have increased it to 75 lakhs. So 75 lakhs is my total income. In that, what is my undisclosed income? So undisclosed income is 55 lakh. So how will that be calculated is that in the block return, I have filed 5 lakh rupees as an additional income, which is in my block return, which is my block return, plus plus 55 lakh is the amount which I have not declared or I have not disclosed and which is found during the course of search. So 55 lakh plus 5 lakh, 60 lakhs will be my undisclosed income, and on that 60% will be my tax rate. So that is something which is already there in the last budget and the last law where this was provided for. On that, there will be a penalty. So penalty of 50% will be only on the undisclosed income. So the amount which I have already declared in my return under 158 BC, on that there will not be a penalty. The penalty will be on an amount which is not disclosed, which in this example we are able to see it is 55 lakh. So as a sum, if we see this chart, it is saying my returned income will be a normal income. My assessed income will be a normal income. The income which I have disclosed in my return will be a part of my block return. So block income, and the income which I have not disclosed, but it is additionally there, that will be also a part of my block income. So this total will be considered as undisclosed income as a part of my block assessment. Now, what is it trying to then say? It is trying to say that what is the amendment? The amendment is trying to say that during the period when the search was going on, right? Let's say in this example, we are saying that income from April to June, because the search was initiated on 30th of June. So from 30th June till the time the search has got completed, which is 30th of July. So here it is before the date when the return is supposed to be filed. So that particular period will be excluded. It will not be considered. Okay. One more thing, the amount financial year 24-25. So in this example, what we are saying is the search was executed on 30th of June 2025. Okay, the search was completed on 30th of July 2025. That is all before the due date of filing the return of income for financial year 24-25. Now, this particular, because it is before the end of the financial year, so 24-25, because there is a time available for me to file the return of income and I can disclose my income, therefore it will not be considered as a part of block income. It will be considered as normal income. That's number one. Number two is the period from 1st April till June is also not will be considered as a part of block income. That will also be considered as separate income, because it is, for me, it is possible for me to file the return of income and disclosed it. So this is the rationale because of which they have said that this will be considered as a part of normal income and normal provisions will apply. And the amount which is prior to that, and if that is something which is undisclosed, that will be considered as a part of block income. So this is one difference which has been brought out in current budget, which was not there in the last budget. Yes, can we go to the next slide, please, ma'am? Yes. Now, what are the questions which may arise from this particular budget? So what happens if the transfer pricing assessment for 2 years for the block period have already been closed? So because the transfer pricing assessment has already been closed and there is no new material being found, because if there is a new material being found or there is some material which was not there as a part of my assessment or my calculation of transfer pricing income, anything new has been come out, then it is a different scenario which we will be discussing across. But let's say something which is not newly found or not unearthed, in that particular case there cannot be any assessment in relation to that particular thing. What will happen if the transfer pricing assessment for the block period are still open in appeal. So even if it is open in appeal, the question is whether any materials have been come across during the course of search, which is going to have an impact on my assessment, on my TP assessment or my block assessment. Both the principle remains same. So if that has an impact on my assessment, then of course that is available for doing an assessment. Now, what also has been provided under this particular budget is that transfer pricing will not be considered as a part of block assessment. It will be referred separately to the transfer pricing cell, and they will do the arm's length benchmarking exercise. So it will not be part of the block assessment, which otherwise was used to be till last time. But now it is clear that it will be considered separately, and the transfer pricing cell will consider it or do the benchmarking exercise. Now, this is in relation to materials which have been unearthed during the search. If the materials are not, any new materials have been identified, then of course the assessment which has already been closed will be considered as final. Will there be a separate transfer pricing audit for block period? And is taxpayer required to submit a transfer pricing report? Answer is yes, it will have to do it. Because if the transfer pricing additional documentations have brought out certain new transactions which were not reported for, then of course there will be a benchmarking exercise which will be required to be done, and that will be considered for the transfer pricing assessment. Will the transfer pricing assessment be limited to transactions identified during the search, or will it include other transactions as well? So as we are aware of the reopening principle, the reopening principle functions on the basis that when the assessment has got reopened and the basis of the reopening is valid, then the matter is open and the assessing officer can look into various aspects of the assessment related to it. So the same principle will continue. So answer is yes. If the transfer pricing if the transfer pricing assessment has been opened from a perspective of materials found additionally, and it's a valid matter of verification or reopening, in that particular case, yes, the officer has the right to get into the transactions. The same older principle which was available or which has been followed over the years, the same principles will continue. Okay, the reopening principles. Now going to the next point, as per the proposed changes under 158 BB, income from international or specific transactions for the year in which the search is concluded shall be excluded from the block assessment due to complexity arising in arm's length calculation for the part period. So that will not be considered as a part of block assessment. That will be separately calculated, as I said, by the transfer pricing officer for doing a benchmarking exercise. Now we move to the next point. The next point is trying to say that in case of a block assessment, let's say there is one search which has got executed. Okay. And the search has still not got, so the search has got completed, but the assessment of that search has not got completed. But because there was some other search at some other on some other person, because of which also there is another search which has got executed to the same assessee as a second search, and then there is an assessment. So this is the scenario which we are trying to cover over here. Principally, it is just trying to say that if one search has got completed, now we are moving to the second search, then the assessment, though it is considered as pending, it is actually not only pending, it is required to be done. So there is no notice which is already issued and therefore it is pending. It is required to be done, and therefore the wordings which have got changed is that if the search is completed, assessment has not happened, and there is another search, so thus another search will be completed, and then there will be an assessment which will be getting executed. Since this states that the income will not be a part of block, which means that it will be calculated separately by the transfer pricing appealer, what will be the tax rates and applicability? So that will be considered as a part of normal normal income, and the calculations will happen accordingly. So it will not be forming a part of block income. It will be considered as a separate income, and the tax calculation will happen as per the normal income tax rates, and penalties will be applied accordingly. So this is about the block assessments. Principally, what they are trying to say is that number one, any amount which is identified during the course of search for the years which is prior to the financial year for which the return is not filed. Okay. And the due date is still alive. So it is not that we have passed the due date of July or September. And if the search has got executed and any new materials have been found, in that particular case, the taxpayer has a power and has a right to disclose that particular income as normal income. However, for the previous years where the due dates have got completed, for that it will be considered as block income only, and it will be assessed as a block income, and the tax will be applied accordingly, which is 60%. Now, for the period where the due date has not expired, the due date for filing the return, it is expected that the taxpayer will include this particular income and include it in the return, and he will pay the appropriate taxes and interest on that. The second situation is where the due date has got expired, but the due date for last belated return filing is not expired. So it is 139(1) which has got expired, but belated return due date has not expired. In that case, what will happen? So the law is saying, and they are referring to section 139(1), which means the date which is July and September. So if before that, if the search has got executed, in that particular case, financial year, in our example, 24-25 financial year, you will be considered as normal income if whatever has been identified for that particular year. But if the due date has expired, let's say the search has got executed in the month of November or in the month of December, still you have the time to file your belated return, but that will not be considered, and it will be considered as undisclosed income or income of the block assessment. So that is the difference which we need to notice or keep in mind as far as the block assessment or the search provisions are concerned. Now let's move to the next point. Ma'am, can we go to the next point, please? Yes. Now we are going to updated return. So what is there in the updated return is what we analyze. So now, as we are aware of, previously the updated returns were supposed to be 2 years, but within third and fourth year respectively. So previously it was that you are supposed to file, you can file your updated return, and the updated return are in relation to where you want to increase your income, or when you want to reduce your losses, or when you want to which is resulting into reduction of refunds. Okay, so which is in favor of paying higher taxes. Okay, those are the one which are eligible for updated return. Now what they are saying, to keep it simple, they are saying that for the financial year, let's say from any financial year, you have 5 years till which by which you are able to update your return. So year one, let's say if we take financial year 21, then 21, 22, 23, 24, 25. So these are the years in which you can file your updated return. So from the financial year, it is 5 years within which you can file your updated return. To keep it simple. Now, the tax rates which they have applied is different. So initially it is tax rate plus 25% penalty, then it is 50% penalty, then it is 60% penalty, and then it is 70% penalty. So the proportion of penalty is increasing as the way we move forward on the path of time limit. So 21, 22, 21 financial year 2021, if you are getting it done in 22, then the penalty is 25. If you're doing it 23, the penalty is 50. If you're doing it in 24, the penalty is 60 and it is 70. So that's how your penalty will increase if you are filing your updated return later, right? So that's one thing what we need to keep in mind. But at least this window has got open, which is mainly for, let's say, if you have forgotten or if you have by mistake not considered an income, and if you want to go back and file your updated return, then this is the provision through which you can update your return, you can make a compliances and be out of the non-compliances provision. Nowadays, I am noticing that there have been inquiries from a non-resident Indians who used to file their return in India, but and have executed certain transactions, but they have not filed their return, or where they have filed the return, but the returns have not been filed appropriately. Now, because non-residents are very clear and clean in compliances, so therefore they don't want to have any non-compliances, and therefore they come forward to disclose this income. Now, initially it was only 3 years for which you were able to do it, because now they have extended it, so that window has got open and now you are able to do for more number of years, and you can update the return. So that is what the provision is trying to say. Now there's one case scenario which we'll be discussing across. So let's say Mr. Raj has filed a return for 21-22 declaring 3 crore. However, in 2024, he realized that there is an underreported income of 1 crore, which was not disclosed in the original return. It was not disclosed. It had a misreported 50 lakhs by claiming inadmissible expenses. So these are the two situations. Now let's say what will happen and how to analyze what should be done in such scenarios. Let's go to the next slide, please, ma'am. Yes. So here, if we see what is going to happen is tax. If we see the tax on additional income of 1.5 crore is 45 lakhs. Penalty for unreported income is 50%. Penalty for misreported income is 200%. And 5 lakhs is the interest cost. The total tax outflow, if it is getting caught in the course of assessment, then it is 155 lakhs. Secondly, there is non-compliance also. So the other way of doing it is, if you go for an updated return, then you're paying 45 lakhs as tax amount, interest amount of 5 lakhs, and the total tax outflow will be additionally 60% of 45 plus 5 lakh of interest. So in total, and of that 60%, because you're filing it in fourth year, so 60%, and therefore 60 lakhs, 80 lakhs would be your tax outflow. So as an example, we are able to see that because of this provision, even if you want to, even if you want to pay taxes, you are able to pay off the taxes by reducing your penalty component to the extent of 60%, right? Move to the next slide, please, ma'am. Okay, there is one more slide related to capital gain. Yes, can you please go to that slide, ma'am? Yes. So under this particular slide, what is the change? So we all are aware of that in case of insurance premium. So if your insurance premium was 2.5 lakh for a ULIP plan, or 5 lakh rupees for an insurance life insurance plan, then if it has been below that amount, then you are exempt from paying taxes when the money is received back. But what in a situation where it is an investment link fund, where you are able to earn higher, when you are able to earn higher by investing higher. So when you are investing as a premium of more than 2.5 lakh of rupees, then that is not eligible for exemption when you're getting the money back. Now there was a gray area in relation to whether this will be considered as income under other sources, or it will be considered as income under capital gain. So they have made it very clear that this particular transaction where the amount invested as a premium is more than 2.5 lakh of rupees at one go, then when the money is received back, it will be considered as capital gain, because the transaction, the asset will be considered as capital asset. That's number one. Number two, it will be considered as equity oriented fund. So therefore, if you are holding it for a longer period, then in that, for which is more than 12 months, which of course generally has been the situation. So in that particular case, the tax rate would be 12.5%. If you are holding it from a short-term perspective, then in that case, the tax rate would be 20%. So because it's an equity oriented classified asset, the tax benefit will be available, which is rationalized tax rate of 12.5% will be applicable in that situation. Also, one thing is that if, because this particular asset will be considered as equity oriented fund and capital gain, so if you have bought some property in relation to it, then even the benefit of 54F will be available to adjust the capital gain amount which is used, which is invested into the residential property. So that's something which we need to keep in mind in relation to the amendment related to the ULIP plans. Ma'am, can you go to the next slide, please? Yes, I think these are the elements which are introduced. There is not too many amendments which are there. There are no major other amendments which are related to assessments or appeals or capital gain, and therefore the limited amendments which has been brought up is something which I have got the privilege to share it with you. If you have any questions or any doubts, you can of course touch base to Taxmann. You can even touch base to me on darshak@snco.in, where I will be happy to answer your queries. I will also be happy to answer the queries if it is coming out in the chat box currently. With this, I'll just hand over the floor back to ma'am.
Thank you so much. It's always a pleasure to have you. Thank you. Anybody please drop your queries in the chat box.
Ma'am, since there are limited amendments, I don't see there are going to be any major queries coming.
Yes.
I think we need to have one more round of presentations once the uh, bill is introduced.
Yeah, yes,
The
sure.
new bill which he is referring to.
Yes. What are your thoughts on the new bill? How it will be?
I think my view is there are a couple of things which are there. One is uh, when we compare it with some developed countries, okay, there are clarity. So one thing which I'm no, seeing is that there will be a clarity. Second, there will be provisions which are going to be related to uh, the inflow of funds. How do we attract more funds into India? So that is going to be the second thing which I think should be there. And third thing, it is the current law, the current bill, the current act. As we are seeing, it is complex. I see that there will be a lot of simplicity for us to analyze the law. So these are the three things which I'm anticipating from the bill.
Perfect. There are some couple of queries.
Yes.
Number one is ULIPs that do not qualify for exemption under Section 10, subsection 10D shall be included in the definition of an equity-oriented fund. Is this amendment applicable only for ULIPs to be taken on or after 1st April 2025? If yes, what will be the tax treatment for ULIPs purchased before that?
So this is basically more of a clarificatory nature. So even if something which is before this will also be considered, because what they have tried to classify is that all the ULIPs which will be classified as an equity oriented fund. So even the funds which are prior to this will also be considered as equity oriented funds.
Okay. Another is the amendment to Section 115UA regarding the taxation of long-term capital gain from listed shares is effective from assessment year 2026 and 7. However, the omission of reference to Section 112A under Section 115UA was unintentional error. Do you think its amendment should be applied retrospectively?
Can you please repeat this question? Can I see
Okay.
this question, which is there on the chat box?
Yes, I'm sharing it on the chat box.
Yes. Okay, no problem. You can repeat the question.
Just a second, just a second. I've shared it in the chat box.
The amendment is 15UA regarding the taxation of long-term capital. No, I've lost it. Can you, ma'am, please speak about the question?
Okay,
Can you
I'm
narrate the
repeating.
question, please?
Sorry?
Can you please narrate the question?
Yeah, sure. Just a second. The amendment to Section 115UA regarding the taxation of long-term capital gains from listed shares is effective from assessment year 2026 and 27. However, the omission to the reference Section 112A under Section 11UA was an unintentional error. Do you think this amendment should be applied retrospectively?
So, something which has got completed as an assessment year. So I don't see that, okay, now you will be able to make it retrospectively, and that is not something which is the intention. So I believe that has to be applied prospectively. So whatever was taxed at 10% previously will continue. Now it will be 12.5% from the henceforth. So when the bill is getting passed, from then onwards, it should be considered. So though it was unintentional, but something has got passed is passed.
Okay, continuing that question, what challenges might unit holders of business trust face due to prospective application?
So I think the prospective application, the trust will be formed, whatever capital gain which is now going to arise, because the business trust are a pass-through entity. So the provisions, the date from which the provisions are going to be applicable. Prior to that, if there is any capital gain, that will continue to be at 10%. And now onwards, whatever is going to be the, now onwards, I mean to say from the effective date, whatever is going to be the capital gain, that will continue to be at 12.5%. So implication wise is going to be on the pass-through status to the unit holders, and that's how it is going to be applied.
Okay. There's some questions in the chat box. One is regarding Section 10, subsection 10D amendment. Is it applicable for all ULIPs issued earlier?
So I'll do one thing. I'll since the question has repeated back, and I believe it's from the same audience. I will do one thing. I'll have a cross check on this particular point, but that is my view. Yes.
Okay.
So what I would request to the viewer who has raised this question for the second time, if you can just put me an email at darshak@snco.in, I will give you a confirmation of that particular question.
So there's one more question that what we had paid would be considered capital receipt, and what more received will be considered as capital gain.
Okay, so answer is yes, and that's always been a situation that when you pay it, let's say even for other assets, when you pay it is a capital receipt, right? Because that's not a deductible expenditure at that point of time. It's always been a part of the balance sheet. So it's a capital asset answer, capital receipt, capital payment. It is right. When you are receiving it back, okay, it is now qualified that it's not other income. It's a part of your capital gain, and therefore whatever is paid is going to be getting deducted from this.
Okay, perfect. There are some more questions. Another is the block assessment provisions were recently revised in the current and previous year's budget. What simplification can we anticipate in block assessment under the upcoming new income tax?
I think one thing which I can notice is basically see, one thing which was anticipated is this particular thing where currently what they have already brought in, which is in relation to income, which is not considered as a part of or something which is the due date for filing return has not got completed. So problem was that though my due date is pending, but I was still considered as a culprit and I was charged as a block income. Okay, and I had to pay higher tax. So they have made that claim very clear and they have brought it as a relief that that portion for which the due date for filing return is still there, that will be considered as normal income. So I think that is already brought in. So I don't see any new amendment to be and not anticipating that, because if that would have been there, it would have been covered into the block changes which they have brought out over here. Yeah, there can be a possibility of some simplifications which they may do so that you are able to interpret it well, you are able to make it simple to understand the law. That could be there, which is the overall objective. But specifically from the amendment perspective, it is something which is already included.
Okay. There's one more question. Under Section 158BB, if the due date for filing the return under Section 139 hasn't expired, does both the Sections 139 and Section 158BC returns to be filed for the income disclosed to be treated as disclosed, or is the income only under Section 158BC sufficient?
Can you please repeat this?
Under Section 158BB, if the due date for filing the return under Section 139 hasn't expired, does both the Section 139 and Section 158BC returns need to be filed for the income disclosed to be treated as disclosed, or is the income only under Section 158BC sufficient?
So I think here for the period which is related to your normal income, you will be filing a normal return. For the period for the block income, you will be filing under 158 BC. So the income calculation will be different for two different returns, and that's how you will be filing it. Because the normal income, when it is considered as normal income, you will be filing your normal return, and that is what the objective is. That since you have the time limit to file your normal income, it will be considered as normal income, and you will be able to file your normal return under 139. For the block income, you will be filing under 158.
Okay. Perfect.
So there will be two returns which will be getting filed, is what I'm saying.
Okay. I think that's all from our end. Thank you so much for
Most welcome,
such in-depth analysis. Thank you so much.
Thank you, ma'am. Thank you very much, and always happy to share my views on Taxmann. Thank you very much, ma'am.
It's always a pleasure to have you. Thank you.
How many sessions are left, ma'am?
2 sessions are left now.
Chalo, very good. Some more people to share their views.
Yeah.
Chalo, bye bye. Take care. Thank you very much. Thank you, audience.
So now moving to the changes in other laws, we proceed for the next session on amendments in corporate law. We are privileged to welcome our visiting speaker, Vinod Kothari, Managing Partner at Vinod Kothari and Company. Mr. Kothari is an extreme authority in company law with over 35 years of experience, a fellow member of ICAI and ICSI. He has contributed as specialist editor to Ramaya's company law and authored several influential work, including Understanding Companies Act 2013 and Guide to Independence Director. His publications span corporate governance and securitization, and he regularly advises leading companies on complex legal tax matters. A sought-after speaker on related party transaction and CSR, Mr. Kothari has delivered lectures in the USA, UK, Italy, Germany, UAE, and India. Welcome, sir. How are you?
I'm perfectly good. How about yourself?
I'm really good, sir. Thank you.
So that's so nice to hear because it's been a marathon session. And as in case of every marathon, what matters is people who last the longest. Not necessarily people who run very fast, but people who last till the end. So Divya, you have been lasting throughout the day with
Thank you, sir.
blast of speakers one after the other. And you still seem to be absolutely fresh and of course energized. So that's very commendable.
Thank you, sir. Thank you so much. The stage is all yours now.
Thanks, done. So do I start straight away?
Yes, sir.
Excellent. So welcome to all the participants who have been part of this marathon session for the day today. And it's indeed nice to see that several of you are still staying back through this extremely long day, full of deliberations by various speakers. And what I'm going to do over the next half an hour or so is to give a view of the amendments, the changes which would affect the corporate sector, the financial markets, and may lead to a long-term change in the country's economy over time. Now, before I begin, I must just give a quick view of what's the state of the economy in general. And as I'm sure everyone would agree that we are facing global headwinds because of the geopolitical tensions in certain parts of the world, but more significantly, more recently, the economic policies of some leading countries in the world. And therefore, the times to come may not be quite smooth for the economy because to an extent there might be disruptions. Well, every challenge brings an opportunity as well. And we are happy to have a leadership which is able to capture challenges and convert them into opportunities. So let's be optimistic on that front. But generally speaking, when it comes to financial markets and the corporate sector in general, the growth rate this year for the part of the year has been lower than expected, particularly from the manufacturing sector. And that apart, in the financial sector too, the default rates seem to be going up, at least in context of personal loans and microfinance loans. And as I'm sure everyone would be aware that recently the banking sector had increased its penetration towards the personal loan segment. The proportion of personal loans has been increasing on bankers' books, and default rates continue to increase in the personal loan or personal loan or microfinance segment. It would present a challenge before the banking sector. So we are all braced up for the challenging times to come. In the past, the country has faced several such challenging occasions. The country has come up quite well through these challenging periods as well. And I'm sure even now the country would be able to cope up with the challenges posed by the new environment. Now, in terms of the changes proposed in the budget, now, budget typically does not tinker with corporate laws. It normally tinkers with Income Tax Act. And this time, even when it comes to Income Tax Act, there are some segmental changes here and there, but the finance minister clearly says that she will be presenting a new income tax bill in this very session of the parliament. So maybe in the coming week, maybe this remaining part of the week, or maybe in the coming week, we might be seeing the introduction of finance bill. And that would be a lot of fodder for discussion in time to come. But let's maybe leave that aside and talk about what is the finance minister proposing for the corporate sector, financial markets, and capital markets in general. Last year's budget, though it was for the part of the financial year, which presents several interesting proposals relating to providing credit support to MSMEs and so on. Now, automatic question that comes is that these announcements were made as part of the budget, but what happens to them? What is the state of implementation of the proposals or the announcements made in last year's budget? Every year's budget, I'm sure people may not be seeing it so very carefully, but there is also a statement on implementation status of last year's proposals. And if you go through the implementation status of the proposals made in budget 2024, in most of the significant proposals, you would find cabinet note under preparation, cabinet note being finalized, or the meetings being held and so on, which essentially would mean that for many of the proposals contained in the last year's budget, action has still not been taken. The action still seems to be work in progress. Now, that is a little disappointing because from this particular government, at least what the nation expects is that it means action. It's not someone who would merely talk but walk the talk. This is the government which is supposed to be walking the talk and not merely talking. Now, if we get continued budget announcements which are still stuck somewhere in the process of bureaucratic decision making, then we are in a situation of what is called policy paralysis, and that is definitely not healthy for the country. So, in many respects, action is still expected. That's a very important point because as we talk about what are the proposals in this budget as well, many of them will require action. Many of them will require concrete action. For example, something called partial credit guarantee. I'm going to talk about this as I speak now. It's been in the works for nearly 3 years now. Similarly, for development of securitization market in the country, it's something which is in the works for last more than 3 years. So these are things which are continuing for quite some time, but action on these is still not yet to the expected levels. So I'll be today talking about the following proposals, some of which probably might be overlapping with what other speakers might have discussed. Perspectives might be different, therefore please bear me out. I will not be exactly saying the same thing which other speakers might have said. Number one, I'll talk about the proposal for increasing foreign direct investment in insurance sector. What does it mean? What are the conditionalities? What impact does it have for the country? Number two, I'll talk about partial credit guarantee scheme, whereby a specialized All India financial institution called National Bank for Financing Infrastructure Development, NAFID as it's very commonly called. NAFID will provide partial credit guarantee for bonds issued by infrastructure entities. What does this PCG scheme actually imply? What are the challenges towards giving of such guarantees? What impact might it have for the infrastructure sector of the country? And once again, while I talk about this, it's very important that last year's budget, one of the highlight points of last year's budget was, if people recollect, there was a number called 111111, many ones, 11 lakh, 11,000, 1100, 11 crores of rupees was the outlay for infrastructure sector. Once again, I'm repeating, there were several ones, and the finance minister made it it was received with thumping noise in the parliament. 11 lakhs, 11,000, 1111 was the outlay for the infrastructure sector in the last budget. Of that outlay of 11 lakhs odd, how much has actually been spent? If you look at the actual spending number, the actual spending number is actually down by more than 1 lakh crore rupees. In a sense, therefore, infrastructure, which is the most important component of the country's economy, that's something which doesn't require much of elaboration, because this country's economic engine is all dependent on the spending that we do in infrastructure sector, and therefore active energizing infrastructure entities, facilitating their access to capital markets, facilitating their access to funding remains extremely critical for the country. Therefore, this point number two that I'm going to talk about today, partial credit guarantee for infrastructure entities by NAFID, that becomes a very important point to discuss. Number three is, I'm sure, something that might have been talked about by earlier speakers, but I'll have some perspective to share on that, which is the end to the evergreening of losses in a case of amalgamation. This is something which, from a point of view of corporate restructuring, always remains interesting. We will be talking about that. In addition, I'll also talk about, there's a mention in Finance Minister's speech about facilitating fast track mergers. What does it actually imply and what implications might it have? I'd like to talk about that. It's an important part of the country's promise to international investors to popularize the International Financial Services Center, IFSC, as also quite often called Gift City. And there are several proposals to further attract investments in IFSC. And therefore, there are some proposals that I'd like to talk about. Number one, in case of leasing transactions out of IFSC, part one. And part two, there is something called Treasury Center activities out of IFSC. I'll maybe briefly talk about that as well. There are some other changes about fund management entities out of IFSC, but that's something that, as I can see from the agenda, there are other speakers who might have talked about that. So I will therefore not take your time on that. And then there is a change on crypto assets. There's a widening of definition of crypto assets, virtual digital assets. I'll briefly like to talk about that as well. And finally, regulatory reforms. Now, this is most important. I would say this is one of the most important topics to discuss, because if any of you might have gone through the economic survey this year, the theme of the economic survey was very clearly deregulation. It very clearly dwelt on the theme of deregulation, because this country's economy currently where we stand, it's very important to let the government get out of the way of business to the extent the government can, that is without compromising on social justice, without compromising on equity, without compromising on basic safeguards which any government has to take. The economic survey very clearly throws a signal that the government has to get out of the way of the business. Get out of the way, meaning let the business run its own course. You can lay basic guardrails, you can lay basic rules of conduct, but don't continue to regulate business in every micro aspect, which is what is seemingly happening today, because as I'm sure everyone agrees, compliance burden for businesses has tremendously increased. Not only are compliances getting more and more granular, the cost of non-compliance has gone up multifold. While we talk a lot about decriminalization, but decriminalization that's the monetary aspect, that you'll probably not be put to punishment, you'll probably have to pay penalty and get out of the matter. But the issue is that the penalties itself have become quite large, quite huge. Number two, it's not all about paying the penalty, it's the consequence of having been punished under a law. Because today, if you have faced a penal consequence under any law, subsequently as you go for any subsequent business proposition, and you are asked to explain, have you been punished under provisions of XYZ laws? If the answer becomes yes, it becomes a crime mark, it becomes a sort of bad spot on the career of either an individual or a company for years to come. So that's very important to ensure that we have reduced compliance burden, business becomes competitive, business is allowed to continue without micro intervention of the policy maker. That's a very important point on which, well, the government needs to take tangible action. Let's see that the action is taken and taken soon enough. So that's a very important proposal, to have a high-level committee for regulatory reforms. I'll talk about that as well. Let me first start by the first proposal, which is foreign direct investment in the insurance sector. Now here, what's the proposal? The proposal is, as of now, the country permits up to 74% foreign direct investment in insurance sector. Insurance sector, I'm sure everyone realizes, is a very significant sector for the country's economy. Insurance, unlike rest of the financial services sector, financial services, for example, let's say non-banking finance companies, how much FDI is allowed? 100%. In the banking sector, of course, FDI allowed is up to a limit, but when it comes to non-banking financial services, 100% FDI is allowed. But when it comes to insurance, once again, the country has taken a very careful route of not permitting FDI to the extent of 100%. So till 2021, the permitted level of FDI in insurance sector was only 49%. 49% only was permitted. And if, in other words, the maximum cap, what is called sectoral cap on foreign direct investment in the country for insurance sector was so far until 2021 was 49. This 49 was extended to 74% in 2021. So as of now, we have up to 74% cap on FDI in the insurance sector. What's the country now proposing? Now we're proposing to increase the cap, remove the sectoral cap and take it to 100%. That doesn't mean the sectoral cap becomes irrelevant. We will still have some conditionalities, but now up to 100% investment by way of foreign direct investment in insurance companies would be permitted. So let's first of all realize that does that mean the insurance companies can now be completely owned by non-resident shareholders? Answer seems yes. In addition, can there be a foreign portfolio investor participation as well? To that also answer is yes. When it comes to sectoral cap of FDI, not only are we including what is called direct foreign investment, we are also including foreign portfolio investment. Even the investment made by foreign portfolio investors, FPIs as we call them, even that is captured as a foreign direct investment for the purpose of sectoral limit. So when we talk about 74% limit as existing now, it includes foreign direct investment, that is direct holding of capital by non-residents, as also portfolio investments made by foreign portfolio investors. So now the proposal, therefore, the budget says the default percentage would still be 74%. The investment is permitted subject to conditionalities. I'll talk about what the conditionalities are. At the same time, the finance minister also says that the conditionalities and guardrails will be reviewed and simplified. What will this review or simplification be? We don't know as of now, but I'll talk about what are the guardrails and what are the conditionalities as existing as of now. Now, the extent of investment, foreign investment in insurance companies is governed by two sets of rules. Number one, the normal what you call FDI policy, non-debt instruments, investment in NDI instruments, rules pertaining to investment in non-debt instruments, which is actually equity instruments. That's part one. Part two, there's another set of rules called Indian Insurance Companies Foreign Investment Rules. You can see these are the rules we mentioned in the Indian Insurance Companies Foreign Investment Rules 2015. These rules also lead, number one, the limits, and number two, they lead the conditionalities. Also, to an extent, the provisions of the Insurance Act also become relevant because the Insurance Act also contains certain conditions about foreign investment. So first of all, Section 27E of the Insurance Act prohibits insurance companies from investing the funds of the policyholders outside India. It says whatever funds an insurance company garners from policyholders, it has to be invested 100% within the country. And Section 27C allows an insurers to invest not more than 5% in aggregate of its controlled funds or assets in companies belonging to promoters subject to conditionalities. So the condition of investing back the proceeds of policies is a part of the statute. Are we meaning to relax this condition? I would actually think no. In other words, the existing conditionality of investing back the proceeds of the policy within the country being a part of the statute, quite likely that conditionality will remain. It will not be tinkered. Now, what about the other conditionalities? The other conditionalities which are laid in the investments in insurance companies foreign investment rules 2015, the conditionalities relate to primarily corporate governance. And these conditions say that number one, the majority of the directors in the insurance companies must be Indian citizens, not just Indian residents, Indian citizens. Majority of the directors must be Indian citizens, number one. Number two, it says majority of the KMPs must also be Indian citizens. Key managerial personnel must also be Indian citizens. At least one among the chairman, managing director or CEO must also be Indian citizen. At least half of the directors should be independent directors. And any FDI in insurance sector is allowed subject to verification by IRDA. In other words, even as the investment limit is extended from 74% to 100%, the investment proposals into any insurance company would still be subject to IRDA verification. What does IRDA verification actually do? IRDA goes into the source of funds. As I'm sure you understand that one of the concerns right now the country has is investment from countries whose land borders are shared with the country. I hope you understand which country I'm talking about. So IRDA very carefully examines the source of the money, essentially to ensure itself that there is no concern about where is the money coming from. So IRDA will do its own DD on the investors. And it's only after the DD is done by RDA, the RDA is satisfied about the sources of funds, that increased investment in insurance companies will be permitted. Now, in context of this proposal, what does it actually mean for the country as a whole? First of all, let's understand that penetration of insurance in India. Penetration actually means what? Proportion of insurance premiums to the country GDP. That's taken as penetration. That is insurance premiums divided by the country GDP penetration ratio that actually declined in financial year 2024 from 4% to 3.7%. And this decline was largely attributable to decline in penetration of life insurance. Non-life almost remained constant, but life penetration came down. When life penetration comes down, what does it mean? That actually means the growth of insurance premium was not matched by the growth of GDP. In other words, GDP growth was faster than the growth of insurance premium, and thereby the penetration ratio marginally fell down. Now, if you compare this penetration ratio with the rest of the world, global average is upwards of 7%. That would mean where we are in the country today, we are at 4%, less than 4%. Globally, it ought to be at 7. So there's a long distance for India to travel still. In other words, there's a substantial scope for insurance business to grow in the country to come to par with how rest of the countries in the world are. And there is also a projection that the insurance sector in India I'm sorry about that. The insurance sector in India is expected to grow at 11% CAGR. CAGR means cumulative average growth rate, compound average growth rate. It's supposed to be growing at 11%, and India is expected to become the largest insurance market in next 6 years. This is a very important point to note. India is expected to become the largest insurance market by next 6 years. Now, at 11% growth rate is extremely, I would say, attractive growth rate, and India becoming the largest insurance market, which actually means what? There has to be substantial scope in the substantial expansion in insurance business in the country. So, in the past, the extent of foreign direct investment in insurance sector has not been extremely impressive. That's very important point to note that though in 2021, we increased the limit of FDI from 49% to 74%. Were there a lot of takers? In fact, from 2014 up to 2023, for a period of 10 years, the aggregate amount of foreign direct investment in insurance sector is only roughly about 54,000 crores, which means it's not been a very great segment for attracting foreign investment. But looking at the prospects of 11% CAGR, one hopes that there might be a significant interest, there might be significant traction among foreign investors to invest in insurance sector. So what is the likely impact of this proposal? Number one, it reinforces India as an FDI destination. Now, once again, India as a foreign direct investment destination. Are we doing great? I would once again say no, because in FY 24-25, the net foreign inflows in the country by way of FDI were roughly about 20 lakh crores. And sorry, 28 billion US dollars, 28 billion US dollars. And if you compare this with the number in the last peak year was 2020, in that year, the net foreign inflow was $64 billion. In other words, if you compare with FY20, that is 1920 pre-COVID period, we had a net FDI inflow of $64 billion US, whereas in FY24 we only had $28 billion, which means a substantially lower FDI in the country. Now, if you were to anyway compare that with China, we normally compare India's status with China. Our 28 billion compares with 163 billion for China. China is at 163, we are at 28, which means there's a huge scope, long distance for us to cover when it comes to foreign direct investment. So this change, hopefully, would reinforce the country's position as an FDI destination. That's part one. Number two, looking at the major scope for insurance business, one hopes that there will be attention of foreign investors in the insurance sector. And with the combined result of this, we hope that penetration of insurance, which, like I mentioned, dropped down last year, the penetration ratio actually picks up, goes up. So that was about the proposal to increase FDI in insurance business. We now come to the next part, which is partial credit guarantee for insurance for infrastructure funding. Now, let me quickly give a background first. What exactly is partial credit guarantee? We're talking about infrastructure bonds or bonds issued by infrastructure entities. Infrastructure entity, I'm sure anyone can realize that when it comes to infrastructure operators or infrastructure entities, let's say think of someone who is operating a P2P project, somebody is invested in a road sector project, somebody is, let's say, invested in rail sector project. All of these are long-term investment. The investment takes pretty long time to pay back. Payback period could range anywhere between 5 years to 15 years. And therefore, these entities, they need to look for long-term funding. They need to look for funding partly during construction period, and partly they need funding after construction, after the so-called commercial operations begin. So need construction period funding is mostly extended by banks. Banks are the ones who give loans during construction. The construction might take 2 years, 3 years, 4 years, depending on the project. And thereafter, it takes a long number of years to recover the money invested in the infrastructure project. So that's where the capital market funding comes. When the infrastructure becomes on stream, when it starts generating revenues, at that stage, you need some investors to come in to allow an exit to the bankers. The bankers who put in money during construction, they need to what is called take out or exit the funding by refinancing of the project by capital market source, which is where the issuance of bonds by infrastructure entities comes. As it stands, the biggest challenge for an infrastructure entity to issue bonds will be that the market does not accept, the market does not lap up lower rated bonds in the country. In India's bond market today, mostly people expect bond rating to be AAA or AA. Less than AA rated bonds are typically not picked up by investors. And most of these infrastructure entities, they don't have ratings equal to AA. Most of them might either be BBB, might even be less than BBB. So the ratings are not of a standard at which their bonds can be acceptable to investors in the bond market. That's a problem statement. We need huge funding in the infrastructure sector. That's very clear because the country's economy can only grow with robust infrastructure. We have the issue of funding because infrastructure entities would need capital market funding and their standalone rating will not be sufficient to attract capital market investors. That's exactly where we need someone who can support the rating of the bonds. Now, NAFED actually was incorporated with this objective. One of the major objectives of NAFED was to assist infrastructure entities to raise capital market funding. In what way can NAFED allow this problem to be solved? NAFED grants what is called, or NAFED may grant what is called partial credit enhancement. I've referred the word PCE there. Partial credit enhancement, which is in form of a guarantee. What's this guarantee? NAFED will take a part of the loss. if at all the bond in question goes under stress, under default, NAFED will contribute up to 20% of the money. That would mean if the insurance entity in question does not have sufficient money to pay back to service the bonds, NAFED will advance money to the extent of 20%. Up to 20% of the bond value, NAFED will contribute money. That's a kind of what is called liquidity support. With that, the bond issuer may continue to service the bonds so as to avoid a default. That's what is called partial credit guarantee. And that's one of the objectives of NAFED. So this is how a partial credit guarantee goes. Because of NAFED support, if you can see here, the issuer which issues its own bonds, the bonds may be lower rated. Let's say they might be rated BBB or higher before the guarantee. NAFED gives a partial credit support to the extent of 20%. With that, the enhanced rating might reach, say, A or AA, it might even reach triple. Mostly it would get a rating upgrade of 2 to 3, what is called 3 or 4 notches. It might go up 3 or 4 notches. That's the kind of support that NAFED gives or NAFED is supposed to give. This is very common. This is currently being given by banks as well, though there are no real life examples of banks having given such a credit support. It's permitted by RBI, but mostly banks have not so far given such partial credit guarantee. This guarantee is what you call subordinated to the claims of other investors, because investors will be paid first. NAFED will be paid only after the investors have been paid. And the support is revolving in nature, which means as and when the bond issuer needs the money again, if it has the money, it can pay back NAFED. Once it needs the money in future as well, it will be able to draw down on the facility once again. So it becomes a revolving liquidity facility given by NAFED to support the bond issue. That's what is partial credit guarantee. Now, currently, what's the issue? In the existing scheme of things, NAFED is existing for last 3 years. Is still not been able to successfully launch the partial credit guarantee scheme. What's the reason for that? The reasons are primarily two. Number one, somewhere in the NAFED law, NAFED regulatory framework, the fact that it can grant a partial credit support is somewhere not clear. There were guidelines of RBI issued long time back that talked about partial credit guarantee by banks. As of now, we assume that the same regulatory framework applies to NAFED as well, but that's, as of now, not very clear. So number one, lack of clarity. That's part one. Part two, however, a bigger problem is the capital required by NAFED for giving the guarantee. Now, this is a very little complicated thing, particularly for people who are from taxation stream. What's the meaning of capital requirement? Capital requirement for any financial entity, an entity needs regulatory capital. As per regulations, it needs capital. Capital is required by, as per the RBI guidelines for partial credit guarantee, capital is required for the extent to which the bond issuer is able to get a higher rating. Now, this is a little complicated, therefore, let me just try quickly to say that the capital required for an investor in bonds is connected with the rating of the bond. For example, the bond is BBB, the capital required might be 100%. If the bond reaches single A rating, the capital required might come down to 50%. If the bond reaches AA, it might come down to 30%. The bond reaches AAA, the capital required might come down to 20%. So from BBB, which is 100% risk weighted, the capital required may come down to 20 if the bond reaches a AAA rating level. So assuming because of NAFED's guarantee, the risk weight as applicable to the bond comes down from 100% to 20%. As a result, there's a significant reduction in the capital required by the investor. Investor in the bonds will need lesser capital because the bond is now AAA rated. So the question is, who will bring this capital now? That much capital, the extent to which investors would have got reduction in capital, that much capital has to be retained by NAFED. So NAFED will need as much capital as is the extent of capital relief or capital reduction in the hands of investors. That's the key requirement of capital as per the existing regulatory framework of RBI. Now that is still understanding. The bigger issue here is that though the bonds amortize over time, the bonds pay off over time, the bonds may partially pay down over time. However, this capital required by NAFED will remain constant right till the bonds are completely repaid. that is from the year of issuance till the year the bonds are completely repaid, NaBFID will still keep that regulatory capital. That really becomes a very big bottleneck because every time NaBFID goes and provides guarantee for the bonds, it has to shell out as much capital, and that capital will remain static even though the bonds come down. As the bonds come down, NaBFID's income will also drop because income is typically based on outstanding value of bonds. Income drops down, but the capital still remains constant. That is the biggest bottleneck in the partial credit guarantee scheme as of now. The finance minister has proposed that the finance minister will introduce a regulatory framework for that. I'm not sure what that framework would be, but if this problem of regulatory capital is not resolved, no matter what the FM does in terms of permitting partial credit enhancement, the structure is unlikely to be really working because the problem of regulatory capital will still remain. Let me now move to the next part, which is dealing with amalgamations. This is actually a tax change, but this tax change has a corporate law impact, and therefore let me just talk about that. As I do understand, this topic might have been talked about by earlier speaker too, but let me just refer to the relevant part of the Companies Act versus Income Tax Act when it comes to the proposed change. What is this proposed change? I think everyone knows that because of Section 72A, if the merger takes place as per the conditions mentioned in Section 72A, then the losses, including unabsorbed depreciation, are deemed to be loss or depreciation of the year in which the merger takes effect. That is, if the merger takes effect, say from FY24, irrespective of the vintage of the loss, the loss gets another 8 years to lapse. Therefore, there is a sort of an evergreen. And the finance minister says that the finance minister doesn't want this evergreening to remain. It would put an end to the evergreening. That would mean 8 years vintage will still remain even though the merger might have taken place. So with the objective of stopping this evergreening, the finance minister has proposed a change to say that with effect from mergers which are effected from 1st April 2025. Remember, mergers which are effected on or after 1st April 2025 will be governed by the new provision whereby the 8 years vintage for the loss or unabsorbed depreciation will run from the year in which the loss or depreciation actually arose and not from the year in which the scheme of arrangement was sanctioned. Now, this proposal takes effect from 1st April 2025, which actually means what? As I'm sure everyone knows, there is a distinction between appointed date and effective date when it comes to schemes of restructuring. Appointed date actually means what? When we have a scheme of restructuring, we define the appointed date. Effective date, as per corporate laws, is the date on which the filing of the order of NCLT is done. That's the effective date as per corporate laws. But from income tax perspective, the appointed date is the effective date because that's very clear in the income tax law itself. If the date as per the scheme appointed for the merger to take place is say 1st April 2023, even though the order is passed in 2025, if the appointed date is 1st April 2023, then the merger is effective from 1st April 2023. So though the finance minister has made this change effective 1st April 2025, please do understand the change as and when enacted will be applicable only for those schemes where the appointed date as per the scheme, not effective date, the appointed date as per the scheme is on or after 1st April 2025, which means we still have some time if there are genuine cases where an appointed date before 1st April 2025 might be put. You can still probably, at least for a year or so, continue to do mergers and avail the benefit as per the existing law, not the changed law. Let me come to the next point, which is speeding up fast-track mergers. Now here, the finance minister is actually saying that mergers need to be speeded up. As of now, there is a fast-track merger scheme under Section 232. And the finance minister says that the requirements and procedures for speedy approval will be rationalized. What is currently the fast track merger proposal? Currently, it's permissible either when the merger is between two or more small companies, or between a holding company and its wholly owned subsidiaries, or two or more startup companies, or one or more startup with one or more small company. When it's startups, if we leave it aside, then as of now, it's mostly relevant for small companies. Small company actually is 4 crores of capital and 40 crores of turnover, so that's actually very small. Or between the holdco and the subsidiary. The subsidiary also has to be wholly owned subsidiary. So these conditionalities are greatly curtailing the real life applicability of the fast track merger scheme. Actually, it's important to understand that ultimately, if the shareholders and creditors have given their okay, then the role for the NCLT in permitting a merger is very, very limited. And therefore, the entire process of mergers can actually be more and more creditor and shareholder driven rather than being driven by the NCLTs. And therefore, there's a significant scope for reducing the time gaps in approval of mergers. So I'm hoping that as the finance minister is talking about proposed change of law, the existing process of fast track merger will actually be expanded to include all holdings and subsidiary companies, not just wholly owned subsidiaries as the existing scheme is. Now, the next point I'm going to talk about is leasing from International Financial Services Center. And as this is something that people might generally be aware that as of now, when it comes to finance companies in IFSC, finance companies include an entity giving assets on lease as well, financial lease as well as operating lease. And as it stands, the IFSC finance company regulations include both aircraft lease as also ship lease. Now, what's the relevance of aircraft lease or ship lease from IFSC? Please try understanding from a holistic perspective. Why did India talk about IFSC and IFSC being a place for aircraft leases or ship leases? Existing practices of airlines across the world, including those in India, is to take the aircrafts on lease from overseas destinations. Most of the aircrafts that fly, you and all take flights into Indigo or Air India, whichever aircrafts. Most of them are acquired on, I think 90% plus of the aircrafts are acquired on lease basis. And most of these leases take place from Ireland. Ireland is the globally preferred jurisdiction for lease of aircraft. Years ago, there was a Ministry of Civil Aviation study group called Raftar Group. The Raftar, and I was a part of that group. The Raftar group made recommendation that it's time for the situation to change. There's no reason why India should be relying to such an extent on aircraft lease from Ireland. Remember, in situation of political disturbance, this can actually become it's hugely problematic issue for the country. Assuming the country undergoes tension with some other popular leasing jurisdiction from where the aircraft might have been acquired on lease, because many of them are actually funded by investors from a particular country. If that country's investors, let's say India is into some kind of tussle with that country, suddenly we find the aircrafts have been taken back. India has become completely immobile because the aircraft have been taken back by the respective lessors. This might be huge debacle for the country, so we need to reduce dependence on aircrafts coming on lease from international jurisdictions. So why not think of the gift city as the place? That was the idea with which this mission Raftar was started. And over a period of time, this has taken shape because now, as on 31st March 2024, the data is that 20 aircrafts, this is still a very small number, but the country is having few thousand aircrafts operating, but only 20 have so far been leased out of IFSC. 49 aircraft engines have been leased, 56 ground support facilities have been leased, and in addition, 4 ship leases. 1, 2, 3, 4. 4 ship leases have happened from IFSC till 31st March 2024. It's still, therefore, a developing idea, but the finance minister has tried its level best to give further relaxations to leasing from IFSC. So this budget, you find extension of the benefits of aircraft leasing to ship leasing from IFSC as well. In a sense, what this actually means is there are two proposed amendments, Section 10 by 4H, which is to capital gains by sale of shares of SIP leasing entities, and Section 10 by 34B by way of dividends from ship leasing entities. So, all in all, if there's a ship leasing entity out of IFSC, the income of the leasing entity itself will be exempt in 10 out of 15 years. That's usual exemption, 10 out of 15 years income is exempt. For shareholders or holding shares of such companies, they will not be liable to dividends, tax on dividends, and they will not be liable to tax on capital gains because both are exempted by virtue of Section 10 by 4H and Section 10 by 34B. In addition, I'm sure everyone realizes that there is no GST in IFSC and there is no basic customs duty on import of aircrafts into IFSC. I will not be talking at length on the treasury sentence, very, very narrow exemption, extremely narrow exemption. But let me straight jump to the next point, which is crypto assets. Now here, the definition of virtual digital assets in Section 2 by 47A is proposed to be amended by adding a crypto asset. So India is a part of the global framework, crypto asset reporting framework. So we are a part of the entire global community. Therefore, this change is in line with global definition. Definition of crypto asset globally is the same that India is proposing. There's no change in that. We are exactly falling in line with the rest of the world. But the big part is that by virtue of this change, even efforts towards tokenization, currently the entire world is talking about tokenization of real world assets, RW. Tokenization of RW actually means what? That we're trying to tokenize real estate, we're trying to tokenize financial assets into tokens. And that's a trend which is growing all over the world. But because of the definition of crypto assets, any such tokenization will also be taken as a virtual digital asset with two consequences. Number one, there will be a flat 30% tax on any profits. And number two, there will be a 1% deduction of tax at source on any payment made by a resident to another resident by way of on account of any virtual digital asset. I'll take another few minutes to talk about this high-level committee on regulatory reforms. I had mentioned earlier that it's become very, very important for the country to deregulate and to relax regulatory burden. Now, this has to translate into action. Mere committees and reforms, committee and committee recommendation do not help, but it has to actually translate into action. And therefore, the finance minister has proposed a high-level committee for regulatory reforms for all non-financial sector regulations. Remember, financial sector is kept out. That would mean SEBI, RBI, RDA will not be part of this. But other than SEBI, RBI, RDA, reforms in the certifications, licenses, permissions, regulations, this high-level committee will examine where all can we do relaxations. And that this is a very important noble task. Like I mentioned, the country's regulators have to learn to get out of the way of the business, allow business to proceed, barring such issues of ethics or good conduct of business. Businesses have to be allowed to stay and remain competitive by being as less regulated as possible. This is all that I had to share over the 40 minutes or so of my presentation. But should there be any interaction from any of the participants, Divyaji, over to you.
Thank you so much, sir, for this amazing session. It was really an informative one. Thank you so much. Sir, there are a couple of questions. Can I take it?
Yes, please.
Yes, just a second. First one is, how will startups ensure fair valuation in fast-tech mergers?
Okay, the rules of fair valuation exactly are the same as in case of any other company, which means exchange ratio has to be based on the fair value. Now, computation of fair value, this is not something where Section 11, Rule 11UA of the income tax rules applies. Therefore, here fair valuation is based on the valuer's own view on the intrinsic underlying value. Mostly in case of startups, the valuations are based on the discounted cash flows. Discounted cash flows incorporate assumptions on the growth rate of business. So if there's a startup merging with another startup or startup merging with a small company, the valuation of the startup would still be based on the discounted cash flows, which is estimated by the valuer looking at the growth potential of that. It's based on futuristic growth potential, not just based on past history. So the traditional net asset value approach does not apply in case of startups.
Okay. So one last question is, which additional type of companies might be included in the expanded scope of FTM?
So my expectation is that currently the structure is limited to 100% only on subsidiaries. But I'm guessing that now it might be extended to any subsidiary and not necessarily wholly owned subsidiary. That could mean if there's a holding and partly owned subsidiary as well, the benefit of fast track merger might be extended. In addition, the procedural simplification, because as of now, it still has to go for calling of shareholders meeting, creditors meeting, etc. So if there is a relaxation towards, for example, the meeting of creditors, that would also be helpful because mostly fast track mergers are stuck because of creditors meeting. Please, everyone understands that meeting of creditors here. It's not just one meeting of all creditors. There has to be meetings separately of each class of creditors. That would mean for every class, we call separate meetings and take the approval of every class. That becomes a problem in many situations. Therefore, a procedural simplification may involve dispensation from meetings of class of creditors as well. Hopefully, that's where the finance minister would bring up changes.
Okay.
Divyaji.
Thank you so much, sir.
Great pleasure. Thanks, Anand.
Thank you, sir. And now we came to the final and essential session of the evening, which is surely cannot be missed, to the amendments in indirect tax, GST and customs. We have with us Jatin Christopher, partner at JCSS and Associates. Mr. Christopher is a multidisciplinary professional, chartered accountant, cost accountant, and law graduate who has specialized in indirect tax laws since qualifying in 1996. An accomplished author and resource person for the ICAI. He has contributed extensively to post-qualification programs on indirect taxation and supported the development of various ICAI publication and research materials. Mr. Christopher also collaborates with government bodies to conduct training for practitioners, businesses, and tax officials. Since 2000, he has practiced at JCSS, a full-time service firm with pan-India presence. Welcome, sir. Good evening.
Thank you. Good evening.
How are you?
Very well, thank you.
The stage is all yours now.
Thank you very much. Good evening, friends. I realize that being a marathon session, everyone's glued to their screens to learn from experts who have addressed participants all day on various aspects. And as we come to the topic of customs law and GST amendments, there are some important amendments that have very immediate relevance to taxpayers' grievances and ease of doing business. We'll jump straight into some of the provisions in customs law before we spend time on GST. I know everyone's keen to look at the amendments in the GST law, but there are some important amendments in customs and central excise law which we need to touch upon. One significant thing that amendment that we see proposed in this finance bill is the introduction of Section 18A, which provides for importers and exporters to amend assessed documents or duty paid on self-assessment basis. This is so significant that I picked to talk about this amendment proposed first when we talk about customs law, because this is to supplement the provision in Section 149, where historically, I mean, this section has stood in the statute book from 1962. And today we have an amendment proposed to bring something that 149 has not been able to accomplish. Here is a provision that is proposed where the importer or the exporter can voluntarily revise and amend the assessment that was made in the past, whether it results in a higher duty outgo or a lesser duty outgo. Section 18A proposes to permit the importer or the exporter to put forward a correction in the duty paid and assessed already. This is so significant because there could be several instances where after the fact, after the goods have been imported, after duties have been discharged or exemption claimed, there are certain requirements for which taxpayer might need to go back and revisit the assessment done in customs. To give you an example, Rule 9610 had wreaked havoc as far as exporters are concerned, where they had availed even a very nominal amount of concession in import assessment, whether it is for one part of the year or for the whole year or for a year much earlier to the year in which exports were done, until 9610 came to be completely done away with in the previous budget. What we find that taxpayers were willing to return the duty concession they had claimed earlier. The only remedy available was to make amendment under 149 and make an application under 149 to amend the import assessment to be entitled to export refund, which was restricted due to 9610. Now, here is a provision, just one instance. There could be several other instances. For example, certain post-import conditions an importer is not able to comply, he can go back and sort of reset the clock as far as his assessment was done and that was completed earlier. I think 18A is going to bring in a lot of relief for strategically making decisions that now turns out to be decisions made earlier turns out to be not in the best interests of importers or exporters. So this is definitely a welcome measure. A few safeguards are provided here. For example, the time limitations, the form and the manner in which this revision is permitted will have to be prescribed. But the safety that is provided for in the law is that in case the revision is a downward revision, if it's a downward revision, the excess duty paid will be subject to review of unjust enrichment and the other conditions related to refund. But most importantly, the limitation that applies is not based on the date when the revision was made, but from the date when the original duty was paid, that now gives rise to a refund.
So I'm so sorry to interrupt in between, but your screen is not visible, the PPT you have shared.
There is no PPT.
Oh, okay, fine. I'm so sorry.
All right. So when we look at another interesting amendment made is to replace the settlement commission with a interim board for settlement that is to be constituted under 31A of Central Excise Act. Clearly, a swift move is being made here by the government to bring about a change in the settlement commission as far as customs demands are concerned. The interim board for settlement will be set up under the Central Excise Act 1944, which will also have responsibility in respect of settlement of all pending applications and matters to come up in the future. From 1/4/2025, this IBS will take over the responsibility of settlement of disputes. It will be manned by 3 commissioners who will review applications and dispose of those applications. With that, we've also touched upon the 31A proposed to be introduced in Central Excise, so that the statute under which this IBS will be constituted is not customs law, but Central Excise law. But consider, friends, that this provision is going to make room for now this, when we say the board for settlement, we understand a certain degree of permanence. But if you say it's an interim board for settlement, does it mean that this is going to be a short-lived board, or it's going to continue to do its service in the years to come, is something for us to wait and watch. Now let's quickly jump straight into the amendment proposed in in GST law. Friends, if we look at some significant changes that are being talked about to come into effect very soon, we've seen that the requirement to comply with input service distributor has been talked about a lot. I want to give this a few minutes to bring this to participants' attention. ISD registration is not mandatory from 1st April 2025. And before we jump into this topic, let's ask ourselves, what is this inward supply of services which for some reason the invoice cannot be directed to the branch that is consuming the services? Second, what is this service that is received, where the invoices are received at a central location and is not consumed by that central location to be distributed to the branches? I'll restate this for your consideration. Think of the inward supply of services that are delivered to the branches, distinct persons, but somehow the invoice cannot be issued to those branches. Friends, please bear in mind, it's not an instance of accounting hygiene or invoicing discipline. If the service is consumed by a branch, the invoice logically should go to the branch. But if someone were to say that, no, although the service is delivered to the branch, consumed by the branch, the invoice mysteriously cannot be sent to that branch. Now, it's one thing to say there's going to be centralized procurement. It's another thing to say centralized payment processing. We have to find inward supply of services that cannot be billed to the branch where the service is located. Secondly, let's also consider distribution of credit has its roots in dealer's invoice in central excise. Those who are interested to get some background, I'll encourage you to please read up about dealer's registration in central excise, the nature of that registration, and how it was operating as mutually exclusive from a manufacturing registration, a manufacturer's registration in central excise. It is either manufacturer or a dealer, but not both. Now we will come to GST law and look at this ISD registration. A place which is to be registered as an ISD location should not itself also be a fixed establishment, because if it is a fixed establishment, then it will be a location of supplier of services. If it's a location of supplier of services, then it will be a place of business attracting regular registration under 22. So I leave these 3 points for you to consider. Why do we need ISD registration? Please don't rush and get yourself ISD registered, because another registration will mean another area of compliances to add to with no incremental value. Now, if you see the amendment that is proposed in this finance bill is a matter of drafting cleanup. Previously, references to inward supplies attracting tax under 9394 were referred, and references to 53 and 54 IGST Act was omitted. That has now been inserted so that when ISD amended definition takes effect, then it will be including RCM liabilities also. Does it mean ISD location will also have to discharge RCM? No, an ISD incoming invoice will be received and distributed such that the branch receiving the distribution will not only receive credit distributed, but RCM liability to be discharged will also stand distributed. Keep that in mind when you get into the rest of ISD, because I think up to April 2025, ISD is going to occupy a lot of our reading material, access to conversations, discussions, debates, deliberations, and even some of the online content that we will get to read will sort of focus on ISD and its compliances. Moving on from there, we look at another interesting amendment that is to be brought in. It talks about a unique identification marking. We'll talk about this in detail when we get to 148A. That's a new section that is proposed to be inserted to make provision for this unique identification marking. What will it do? What will be its effects? Because this is traceable to the decision of the Council of track and trace. Government wants to track and trace movement of consignments to see how they can have even less government, but even more governance. When we look at some significant amendments, we've seen amendments being proposed to drop Section 12.4 and 13.4. What were these two provisions? They basically talked about time of supply in respect of vouchers. Friends, government has recently issued a circular explaining the treatment of vouchers. And I was very encouraged when I read this circular because it talked about vouchers that represent stored fiat currency and vouchers that don't have stored fiat currency. Very quickly, I will tell you what it is and let you go through the circular and grasp the contours of how it applies. If you have to pay fiat currency, that is the legal tender, if you have to pay money to get a voucher, to get credit for it in an electronic form, then that is a stored currency. It's a form of money itself because the definition of money says any instrument recognized by Reserve Bank of India. Which is a statute under which such digital currencies are recognized? That's the Payment and Settlement Systems Act 2007. So therefore, if it is stored value, then it is money. It is not voucher. But if it is value to use, that is, there is no stored value, you download an app, 50 rupees will be credited into your account. No one is increasing the money in circulation. They are offering something that will behave like money and be accepted as consideration. The third aspect I want to mention is when you look at store value to use, that is where there is no fiat currency stored, it's only a value which you can use. Always look for, is the issuer the redeemer? What is the difference? The one who will give you the points, let's not call it 50 rupees because it tends to create in the mind, blur the lines as far as stored value and value to use. If it is 50 points, 1:1 or 1:0.5 as the redemption ratio, the one who credits those points to your account is that same person going to redeem it on a future occasion when you make a purchase. Here is a case which is called the issuer is the redeemer. The second one is the issuer is not the redeemer. You go and do something, you will earn some points from one entity and you are permitted to redeem it in a different entity. Now, how will the redeeming entity entertain this value to use? Because the money consideration to the redeeming entity will be paid eventually by the issuer of these points. I'll leave you with these thoughts. Please dive right into the circular issued by the government regarding vouchers. But the illuminating aspect of it is completely based on first principles of how stored value functions with value to use, and one is not, and both cannot be used interchangeably. The definition of voucher is also important to understand because it talks about voucher as an instrument with an obligation to be accepted as consideration. All very, very powerful, loaded expressions, deep with meaning and replete with a lot of jurisprudence on each of these expressions. So please be very, very careful. When you look at stored value, look for fiat currency that has been deposited. If it is, and is it being issued by a regulated entity? The next is, when it is value to use, ask yourself whether the issuer is the redeemer or the redeemer is a different entity compared to the issuer. Moving on from there, we look at the amendment that is proposed to 17(5) to set right all the confusion ostensibly arising in Safari Retreats case. We had a conversation earlier, I think twice we had this conversation. Once on the Taxmann platform about the effects of Safari Retreats decision. But friends, please bear in mind, plant or machinery was disjointed, and therefore Supreme Court had explained that they are not they're not referring to one single subject matter, but they refer to two different subject matters. Interestingly, to bring to your attention, plant or machinery, the expression which resides in central GST law, does not say so as far as three states I'm told. One is Rajasthan, J&K, and Pondicherry. These three state legislations have always contained plant and machinery. They have never had plant or machinery. CGST and all other states and UT legislations contained plant or machinery. Today, amendment is proposed to give effect to it from 1st July 2017, as if there was never any such expression, plant or machinery. Friends, please bear in mind, this amendment basically obliterates Safari Retreat decision. It does not even go back in time to the Safari of Orissa High Court. It goes back and obliterates this entire authoritative thinking that went behind rendering the decision, both by the High Court and by Supreme Court. So there is this amendment, and taxpayers will need to be mindful that now the amendment makes it in such a way that there never was any plant or machinery. There was always and will be considered to have always been only plant and machinery as the expression in clause 17(5), in clause D of section 17(5). Moving on from there, we look at certain important aspects where giving effect to credit notes. Friends, section 34, we saw last year, in the previous amendment, a provision inserted in section 15(3)(b). 15(3)(b) was inserted. Now section 34(2) also sees a replacement of the proviso. Friends, I was writing recently somewhere that credit notes will fall into disuse. People will stop issuing credit notes. Although business requires, accounting hygiene requires credit notes to be issued for two reasons. You will find that in this proposed amendment. First, credit notes, the tax adjustment of a credit note is permitted if and only if the counterparty has reversed the credit. We have circular very clearly stating, I think 212 talks about credit availed in respect of the original invoice to the extent adjusted because of a credit note should be reversed. If it is not reversed, get a CS certificate and what have you. But today, a proposal, the proviso to be inserted says that in order to get the tax adjustment, ensure that the counterparty has reversed credit. See, which one was a condition subsequent today has become a condition precedent. You issue credit note, you get the tax adjustment in this month's return that you file, and ensure a condition subsequent that the counterparty has reversed that credit. The counterparty may reverse the credit in the same month or the following month. But today what has happened is the tax adjustment itself is tied to a condition precedent that your counterparty should reverse the credit. How will we ensure a CS to behave like a CP is itself remarkable? But what is even more remarkable is the one seeking tax adjustment due to credit note is required to ensure that the incidence of tax is not passed on to any other person. So I'm telling you, friends, I'm greatly concerned about the proviso being proposed for the reason even exports where credit notes are issued may not be free from inquiry in respect of the tax adjustment. Now, why will there be any tax incidence on exports? Please bear in mind the definition of export of services is tied to repatriation of foreign currency as far as services are concerned. And as far as goods are concerned, Rule 96B makes it necessary to look at where refunds are claimed to examine subsequent repatriation. There is no question of not repatriating any foreign exchange and still not be affected by the GST implications of a credit note. What is industry able to do to address this? There are many, many instances where credit notes have to be issued. I'll place two aspects for your consideration. This comes out of a conversation, study group conversation we had here in Bangalore some time ago. A credit note cannot be routinely issued unless there is in fact a return of goods or the quality of the services or goods provided is deficient, and the other reasons are not fact-based, that is more error of issuing the invoice. Now, please examine goods can be returned. How can services be returned? Services cannot be returned. I gave you tax consultancy. You're not happy with it. You don't want to pay my invoice. If I issue a credit note for it, it means that you're returning back the tax consultancy. See, services don't get returned like goods. But then there are instances, FAQs, that credit notes can also be issued for services with the cancellation of contract, etc. But please consider, I'll give you an example in the context of goods to bring home this point as far as how it should be examined in the context of services. When goods are sent out, the goods may have a shelf life longer than November 30. The goods may have a shelf life longer than November 30. If you issue a credit note, you should issue a credit note before November 30. After November 30, if you have a return, what should be done? The counterparty must issue an invoice with the same HSN value, rate of tax, so on and so forth. What if the shelf life is less than November 30? Can you issue a credit note? Absolutely not. Just because statute permits November 30 as the drop dead date does not mean you can issue credit note unmindful of the reality of the product, because once a product passes its expiry date, its HSN classification cannot remain the same. Take all sorts of articles. Especially items of food, which is affixed with an MRP, items which of let's say medicines, variety of instances you will find in the context of goods where expiration of the product's life sooner than November 30 will itself act as a bar on issuing credit notes. Let's not just look at November 30 as the all-powerful date to issue credit note. Credit notes will come in for enormous scrutiny. Next, when someone issues credit note, who is responsible to demonstrate satisfaction of 15.3b, satisfaction of 13.2 proviso, 34.2 proviso? Who's going to prove all this? It's not revenue, it's taxpayer. Taxpayer has the burden to prove, because 103 of the old evidence law very clearly says information within the special knowledge of any person, burden of proof rests on that person to substantiate the position they're taking. And here is a case where credit note effectively means suo motu sanction of refund. So therefore, that aspect has come in for sharp consideration in the eyes of the government. So therefore, we have to be very careful. Take a simple instance: an invoice is issued and the whole invoice is found to be contain some error for some reason. The way to cancel an invoice, whether it's a e-invoice or a regular invoice, the approach is to issue a credit note to the full extent of the invoice. Having issued an invoice and a credit note, immediately, not more than the month in which the invoice and credit note came to be issued, another invoice must be issued. And this is where areas of review and verification will be taken up extensively to find out why is there an interval of time between credit note and the follow-up invoice. And if the follow-up invoice is obviously not the same value as the original invoice, that will come up for added scrutiny. Friends, please be mindful. It's not that credit note scrutiny is only limited to 65 or 67. Credit note scrutiny can even come up in 67 because 15(3)(b) and 34(2) now says that it has to be established. Why will this not fit within the terms of a discrepancy in the return? Because there is no method by which prima facie satisfaction can be provided. Now we look at the IMS that was introduced on 1st November. IMS permits acceptance or rejection of credit notes by the counterparty. Keep credit notes pending is not permitted. And if the rejection is not done, it is deemed to be accepted. Can we say that that is sufficient? If that was sufficient, why do we have this proviso in 34(2)? So credit notes needs deep understanding to examine the tax effect, because credit note having been issued, the counterparty has already adjusted it and paid the remainder of the invoice, but here the tax adjustment is still up for grabs until it is satisfactorily established. 2 amendments in the context of appeal in the time that we have. I'll bring this to your consideration. When we have pre-deposit, if you look at the language, we've seen under 107(6), pre-deposit is a precondition to file appeal, because 107(6) begins with the expression no appeal. That means it's not like an appeal can be filed and then pre-deposit made. The language is the appeal is non-est if pre-deposit is not made. Today there's a amendment proposed to 107(6) as well as 112(8) to say that where the demand is wholly for penalty, then 10% of such penalty will also be required to be deposited. Now, where will the penalty alone apply? Where will penalty alone apply? 122(1), 122(1)(a) also, but we won't go into those things, because those persons who indulge in carousel trading and mischief, they are not to enjoy support and encouragement from any quarter of any of the professionals. So we let that be. Instances where penalties are on standalone basis imposed, for taxpayers to litigate that, they'll have to make a 10% pre-deposit of such penalty. Where tax and penalty, this is the old central excise provisions, where tax and penalty is imposed, that will remain under the main provision. The proviso only says. Now my question is, should pre-deposit of penalty be made in cash only, or can pre-deposit be made in credit? My view is that pre-deposit is not payment of the tax. If you see circular 178 para 6, it says penalty, late fee, interest, fines have to RCM have to be paid in cash ledger only and not through credit ledger. But all others can be paid through credit ledger. Therefore, once we call it pre-deposit, and pre-deposit does not have character of penalty or late fee or interest or RCM, pre-deposit can be paid through credit ledger, which taxpayers need to be diligent about. Now we have this concern about how will persons charged with penalty, let's say the key management people in legal entities, if they have an incidence of penalty under 122(3), what will happen to their remedy for appeal? Today, temporary login credentials practice is in force, but it is very transient. It's usually for e-way bill interception, e-way bill discrepancies. There's an interception and there is a penalty imposed. To make online payments of those penalties, temporary login may be given. But today, if there are so many use cases for temporary login, and if there is a manager of an organization who's fastened with a penalty under 122(3), not only because the quantum is not substantial, but the principle itself that the person is not liable, he may want to agitate it, and he needs to now go through the motions of getting himself a temporary login. I would definitely like to see the government create a subset of registration which is only for purposes of unregistered persons, without forfeiting the character of an unregistered person. If a person were to engage on the platform, they should be allowed a system of getting a login credential that is not transient, that will stay for as long as the appeal is required, and even longer to get the refund of any pre-deposit paid. Next, The expression here we find in the proviso that is proposed, provided that in case of any order demanding penalty without involving demand of any tax, no appeal shall be filed against such order unless a sum equal to 10% of the said penalty has been paid by the appellant. What about fine? What about fine? Is fine penalty? Fine under 130 subsection 2, is it penalty? Answer is a vehement no, because it's a fine in lieu of confiscation. And that fine will be in addition to penalty under 122. So therefore, MOB 11 orders to be carried in appeal can be carried without any pre-deposit. Is this a slip? Is this going to be fixed in the next amendment that is to come in, similar to the ISD amendment of 5354? We don't know. But as it stands, no change as far as this provision is concerned. Penalty will continue to be agitated. Again, any appeal on late fee, no pre-deposit, because late fee is not penalty. If it is penalty, then it is not late fee. Similar amendment is proposed in 112(8), that is when tribunal appeals have to be filed. As far as the talking points are concerned, it's the same aspects under 112(8), but today when taxpayers have suffered an adverse order either in adjudication or in appeal, before Finance Number 2 Act 2025 proceeds further into and gets enacted, corresponding provisions in state legislation is also amended, no pre-deposit on penalty. But once this amendment is notified, from then onwards, pre-deposit will be required. Now let's look at what happens when there is an adverse order in appeal and taxpayer is hoping to carry the matter to tribunal. Tribunal is not yet formed. Circular 238 very clearly says that in para 4, that pre-deposit has to be paid along with an undertaking to keep recovery action under 79 at bay. So therefore, if once this amendment comes into effect, we're also hoping that the tribunal will be set up anytime soon. Government is working tirelessly to get that off the ground and implemented at the earliest. Why, as things stand today, tribunal is not operational. If anyone has an adverse order, please expect that pre-deposit, after all, pre-deposit anticipating tribunal appeal is still only through the circular, not in the statute, because unless limitation starts, there's no need to make any pre-deposit. But circular seems to impose pre-deposit pending to keep recovery action at bay. Taxpayers should also expect that even this proviso could get implemented through 79 and circular 238, because after all, the compliance with pre-deposit is in anticipation of what is going to happen. Once tribunal is set up, by which time the law will have got amended, so filing those appeals will require 10% penalty. Interesting is that if you look at the proviso to be inserted in 112(8), it talks about 10%, sum equal to 10% of the said penalty in addition to the amount payable under proviso to 1076. Now, if someone's going to tribunal and has never paid any penalty in first appeal because the amendment was not in effect, will they have to only pay 10% or 10 plus 10? Because it says in addition to the amount pay a bill under 1076 proviso, not paid. As the law then was, you did not pay any pre-deposit. But as the law now stands, once it is enacted, what about the penalty payable under one? My concern is that penalty cases will attract 20% penalty when you carry the matter to tribunal straight away, so that what was missed in 1076 is made up in 1128. Very interesting the way drafting has been done, and that's the beauty of the way the law gets, the policy decision gets translated into legislative language. Amendments proposed insertion of new provisions to impose penalty in case of UIN non-compliance. Now we talk about 148A, very interesting 148A. Government has proposed this track and trace system. What government is trying to do is in 148, friends, I'm very keen to look at the placement of a section. Why is this unique this UIN being located in 148A and not elsewhere? Because clearly this is a provision regarding administration, and therefore it is going to be imposed in a very serious manner. What it requires is government is going to notify goods, persons, or class of persons. Goods will be notified, persons will be notified, class of persons will be notified who deal with such goods. It could be transporters, it could be warehouse keepers, it could be recipients, it could be suppliers, it could be job workers, it could be manufacturers. Please pay special attention to the language employed in 148A1A and B to say that this section will apply to those goods and those persons. Those goods and those persons. When we say persons, the entire person is covered. All distinct persons covered. Class of persons, a subset can also get covered, and the rest of that person may be excluded. The requirement is to provide a three-step process for responsibility. Affix, furnish, pay. Affix, furnish, pay. What will you do? What will you have to do? Affix this unique identification marking, furnish such information as required, furnish details of the machinery installed at the place of business, and pay the charges for this unique identification marking system. UIM system will cost taxpayers. This will be a very sophisticated system. Agencies will be nominated to offer this service, and goods, persons, class of persons will be notified to whom. Once these persons are notified and those goods identified, they will have to comply with the requirements. Detailed rules are to follow, but it's very interesting that a full set of code is being introduced. There's an amendment in introduction of 116A as a definition provision under section 2. 122 capital B is introduced to identify penalty imposition in case of non-compliance, and a detailed code laid down in 148. I find this is going to be very interesting, challenging, but this must be welcomed because diligent taxpayers have to comply and deal with the compliance responsibilities so that those who are non-compliant will be compelled to fall in line or get out of the system and not indulge in any malpractices. This is a very anti-abuse provision. And when you look at anti-abuse provision, please bear in mind substance prevails over form. Where it is not dealing with abuse, it is always form that prevails over substance. As long as it's the bona fide form of a transaction, the bona fide form will get the tax treatment. 148A is an anti-abuse provision. Next, Schedule 3 talks about an amendment. Again, amendment is retrospective to bring about an important refinement in Para 8. We've seen Para 8 get introduced to say that supply of goods in a warehouse in Para 8A. Then we're talking about SEZ, 8B. Today, a proposal is to insert 8AA. Again, interesting, the placement. Why is it in 8A and in between A and B, not as 8C? Very interesting. If you see the explanation that is being inserted, an explanation is being inserted to say warehouse for purpose of 8A will be as defined in Customs Act, but a SEZ, FTWZ as defined in 8AA will be as defined in SEZ Act. So friends, please bear in mind, within the zone or between units within two zones, if they have any transactions inter se, they will also not be treated as a supply. Two aspects to consider. This proposal will take effect from 1/7/2017. Anyone who has discharged tax in the interim period till this proposal takes effect will not be entitled to any refund. Those who have been resisting any demands will get a complete resolution of those demands in respect of the transactions between in SEZ unit and FTWZ units, supplies occurring between these two units. When we look at the provisions that are being given effect, we will have to bear in mind that amendments to Central GST Act will not take effect immediately. Keep your eyes on the slowest runner when you're looking at a relay team. Which is that state that will will pass amendments last? Because this is a legislation that has to get implemented uniformly throughout the entire country. So therefore, keep your eyes on those who are slow to bring about these amendments, central GST will undergo amendment, won't get notified until the last of the states or UTs bring about their amendments. Once everything is amended and enacted, it will get notified on one fine day. So therefore, please consider the effective date wherever the legislation, the proposal says it will take effect from 1/7/17. Whenever it gets enacted, it will take effect from 1/7/17. We find that there are remarkable changes. Budget is not normally a time for GST because we have many budgets. Every time the council has a set of agenda lined up and they make important policy decisions, and then to give effect to it, legislations will be amended, rules will be notified, notifications will be issued based on those recommendations. But still, budget is a time where we have found that decisions taken are given effect through finance bill proposals. So therefore, all central legislations will go through amendments during the budget time. So therefore, budget is a time for us to, without the same, I see the conversation we've been having throughout this day on the Taxmann platform regarding all the other proposals in this finance bill. But today we will find that GST proposal also find an important place here, because this is the time to round up all the changes needed to be made, because it's not going to take effect immediately, but it will take effect soon. So therefore, budget is a good time for Parliament to convene and include these changes in the central legislations. We find that government is looking at making very significant changes, because we don't find a large interval of time between decision and implementation of the decision. Decisions are swift. Implementation is trying to keep pace with the decisions being made. And we find this year a number of amendments introduced that have very progressive effect, for the reason that it addresses immediate needs. Budget is a time to put forward policy thinking. But as far as GST is concerned, we are finding policy thinking takes place first. Implementation is the time for budget. And we have seen customs also try and keep pace with the progressive approach being seen in GST, that anything that helps ease business, government is prepared to swiftly move amendments to make it all happen. And I think Taxmann is a wonderful platform where members can come in and hear what is it that the government is going to make it all happen, and as quickly as we see the need in trade. I thank Taxmann for this opportunity, and all participants for joining in on this platform and spending the entire day listening to various experts who have come in and shared their views. And I'm privileged to be amidst such experts. Over to you, Divya.
Thank you so much, sir, for all the insights and in-depth analysis. Before we end up, there are a couple of queries. Can I take up?
Please, please.
The first one is, will the amendment in section 17(5)(t) in the phrase plant or machinery will effectively nullify the Supreme Court decision in safari retreats, and how it would impact trade and industry?
I would encourage the querist to actually go back and view the extended deliberation we had on Taxmann platform on the implications of Safari decision. As soon as the decision came out, and after that, when we had another follow-up in November to explain what will happen with the implications, my reading of this amendment is this amendment was inevitable, because even the learned ASG submitted before the Supreme Court in, I think, para 16D to say that this was a drafting error. However, it was not entertained by the court, and the court went into examining the difference between and or, and rendered that decision. Today, this amendment is the last word as far as that controversy is concerned. To be able to claim credit, there are only two carve-outs in 17(5)(d). One, it must be on others' account. To be able to, the building must be on others' account to claim credit. And second is, it must be plant and machinery to be able to claim credit. A third exception, if you will, can also be that if it is not capitalized. So those instances we're not looking at. So therefore, yes, this amendment seals the deal as far as losing credit on construction services.
Perfect, sir. So there's one more query regarding GSTR 2B. After the introduction of IMS, a major amendment has been made in GSTR 2B also, which will not be remain static now. How it would impact taxpayers?
See, as far as taxpayers are concerned, it is dynamic, but it will become static as soon as we elect in IMS invoices that we approve or invoices that we keep pending. So it is in taxpayers' hands, more power to taxpayer to pick the invoices that he wants to accept, reject, or keep it pending. Only if it is accepted will 2B get populated. Because if you see, if you go back to instruction number 1, 7th January 22, government board itself very clearly says people have been lackadaisical as far as reporting their invoices on GSTR 1. We are finding invoices appearing on our 2A at that time, which has nothing to do with this taxpayer. We are finding our own invoices which are not even appearing in this. So therefore, the recipient, some control is being handed to the recipient to now distill the data flowing in and pick. Because if you pick wrong, you are now going to be held accountable for it. So therefore, 2B is dynamic, but it will become static based on how we deal with it in the IMS platform to accept, reject, or keep invoices pending.
Perfect. So in respect of IMS only, as IMS is an optional functionality right now, do you think that it will be a mandatory mandatory functionality in future?
Of course, because today the IMS platform is what? It's a tool in the hands of the recipient. Originally, if you see GSTR 2, there was this functionality where we could report missed invoices, we could reject unknown invoices. That essentially is here in IMS platform, and IMS as a default feature is accept. So therefore, it has already become mandatory. Since it is a tool, we don't have to look for direct statutory provision for introduction of IMS. IMS, after all, can fit well within, subject to such conditions and restrictions as may be imposed. That is liberally used throughout the statute that can accommodate IMS.
Okay, perfect, sir. So one last question is there any difference between local fund and municipal fund, where local fund is for panchayat area and municipal fund is for metropolitan or municipal area?
No, there's definitely a very profound difference. If you see the 11th and the 12th schedule of the Constitution, very clearly the jurisdictions are separate of a municipal and a panchayat. The local authorities operate differently. And today the definition, the refinement in the definition being brought about is only to not restrict it to the municipal itself, but the municipal fund can be residing separately. That will also get covered within the scope. So therefore, yes, between local authority and municipal authority, there is a very clear definition and demarcation traceable to 243G and W in the Constitution.
Okay, perfect. So let me just cross-check quickly. Is there any other query? There's one last query is unique identification marking a QR code that would be scanned at different locations, thereby giving updated location at suitable intervals? Is it or some kind of a digital chip device that can enable fully live tracking of the goods?
See, I don't want to hazard a guess as to what shape and form it might be. I will only say it is going to be sophisticated. It is going to be very innocuous. It's not going to make your product look ugly, and it's going to be something that can be traced. So therefore, it is going to be it's going to be digital. It will track and trace. So therefore, throughout the journey, it is going to record information that is going to be very valuable. That's all I will hazard as a guess is concerned. We can expect it to be not just sophisticated today, but it's also something that's going to get upgraded as newer and newer technologies become available for the government to accomplish what is set out in 148A.
Okay, sir. Perfect. Thank you so much, sir. It's a pleasure having you.
Thank you all very much. Thank you.
Thank you, sir. As we approach the end of this insightful and enriching budget marathon 2025, I want to express my heartfelt gratitude to everyone who made this event a success. First and foremost, a huge thank you to our extreme speakers, Vishal Anand, Mrs. Aarti, Dr. Manoj Fogla, Suresh Kejriwal, Tarun Kumar Madaan, Raghav Bajaj, Aseem Chawla, Harshal Bhutta, Mithilesh Reddy, Sandeep Jhunjhunwala, Darshak Shah, Vinod Kothari, and Ejiten Christopher. Your expertise, analysis, and deep insights have truly made our day an invaluable learning experience for all of us. We deeply appreciate your time and efforts in sharing your perspectives on the budget in its implication. A special thank you to all our participants. Your engagement, enthusiasm, and thought-provoking questions have played a significant role in making today's session dynamic and interactive. A big appreciation to my team at Taxmann for their dedication and efforts in organizing this event seamlessly. I, Divyajan, sign off for today with these insightful words of a very famous person. Education is learning what you didn't even know you didn't know. Thank you so much. Goodbye. See you all in the next edition.